I determined that I was going to wear the most flamboyant tie in the room so I'd have your attention. Is it working, Professor? It is. You can thank my wife for that. My name is Moses Rudende, and I am co-MC today. I'd like to welcome you all to the 3rd annual Alternative Investments Conference 2025, or as I like to call it, the one room where everybody will use the words blockchain, e-mobility, and patient capital before 9 a.m. Usually an opening joke elicits a laugh. Now, I'll admit, I'm not an expert on financial matters, but I believe, like many of us, in the power of ideas, in the energy of people gathered to solve big problems, and possibly in the hope that someone will finally explain to me what a tokenized asset is. Didn't land. Jokes aside, today is not just a day to talk shop. Today we are here to explore how Uganda can unlock 10 times economic growth in 15 years. Pause for applause. And that is not a slogan, that's a vision. So everything from green investing to digital assets, food security to fintech, it's not just finance that brings us here today, it's nation building. We have the brightest minds in private equity, venture capital, fund management and beyond, some of whom can read a 30-page prospectus without blinking. And then there's some of us who are wondering if the Wi-Fi is free. It is, by the way, the code is on the table. Allow me to invite my co-MC. She is somebody who knows these things very, very well. Please put your hands together for the portfolio manager at the Deposit Protection Fund of Uganda, Lisa Betty Oyela.
Thank you, Moses, and welcome everybody. It's good to have you here, and we're looking forward to learning together. Learning never stops, so yeah, thank you.
Speaking of learning, maybe there's something you can help me with. When it comes to alternative investments, are we talking about goats and border borders, or is it a billion-shilling type of party only?
So most of us have this belief that alternative investments is just private jets, hedge funds, multi-billion-dollar projects like you've mentioned, but to be honest, I think anything that is not stock or equity or fixed income counts. So in the East African context, it can be a fleet of border borders, if you want it to be that.
Okay.
It can be a chicken farm.
Okay.
anything as long as it's not equal to
a chain of Rolex stands.
Correct.
Okay.
As long as you can organize them in an organized form and people are able to put money into as an organization. I believe that passes.
Okay. If I gave you 100 million shillings today and told you invest it wisely but make it exciting, where would you put it?
I feel like you're harassing me. It's not yet 9 o'clock.
I'm telling you, I'm running on coffee and bad decisions today.
Yeah, and I think I'm not the most technical person in the room. We have David, we have so many people. But yeah, so I would real estate, rent never sleeps. And I also want to be a bit fancy, so I'll probably do a bit of crypto. Yeah, so yeah. So
maybe you can explain to me, finally, what's the difference between a tokenized token, a tokenized asset, and an actual token? Because I've failed to buy chapati with crypto.
Moses, you need to let this tokenized conversation go.
It's the one that jumped out at me. Good morning, Mr. Wangolo.
Okay, quick one. So a token would be sort of a digital currency. You can use it to purchase anything. Tokenization. You're very passionate. He's been asking me this since yesterday. I am going to look for somebody in the room and point you to them. We have Olivier. He should probably take you through that. But so a tokenized asset would be, you have land in Chebando.
Okay.
For example, we like to buy farmland. Okay. So it can be split into different parts, and you sell each of those as a digital asset. So everybody can own a piece of your 1 acre in Chebando, for example. So a tokenized asset would simply be a physical asset that is just split into digital shares so that you have more ownership into it. But again, like I said, David is in the room.
Good morning, Mr. Wangolo.
So, yes. Thank you.
You're welcome. We want to give a quick thanks to CFA Society East Africa. The Ugandans don't clap. We're the ones from Kenya. Kenya's in the house? Please. Kenya's in the house. Tanzania's in the house. Rwanda, Burundi. I mean, it's East Africa. There's South Sudan. Regardless, tumefurahi sana kuwa nawe pamoja nasi. Itakuwa siku njema, si ndio? Without much further ado, allow me to invite the President, CFA Society East Africa, Mr. Nasyomba. Keep the applause going.
Hi, everyone. For those who know me, I interact with my crowd. So if you don't say hi, I'll stand here until you say hi. Hi, everyone. Hi. I thought we've had breakfast. I saw in Nairobi, we call them kangumu. How many have eaten? She was calling it a donut, but it's not a donut. It's a hard mandazi. So allow me to start this. The representatives of the Ministry of Finance, the Capital Markets Authority, Rob Langrick and Kingston Nosu of the CFA Institute, board members of the CFA Society East Africa, fellow charter holders, candidates and members, distinguished speakers, participants and organizers, most importantly, all protocols observed, good morning. I spent time writing this. You can at least say good morning. Good morning. Thank you. I'm actually extremely proud to be standing here. And this is for the third time, for those who are coming here for the first time. And my love for Uganda, most of you know it, notwithstanding, with its incredible food aside, it brings me immense joy to witness how this baby has grown, the Alternative Investments Conference. And it's now, I believe, found its footing, and it's working with confidence. I can only imagine where the future is going to be for it. But first, I want to really acknowledge the originators of this idea. I know we come here and we have discussions, but this idea came about from two people, David and Alan. I'm sure he's somewhere networking. Your foresight in championing the conversation early is now starting to bear fruits. The alternative investments are actually taking center stage, and it's one of the ways for Africa to transform. Just yesterday, with the CFAI team, we were meeting one of the securities exchange in East Africa. And before the formal meeting began, we, of course, digressed and ended up having conversation around this conference and why it's significant and why it's going to keep growing. Now, I try not to overwhelm people, especially when I'm not in an academic conference with numbers. So forgive me for not going deep into those numbers. But one fact is for sure, in Africa, alternative investments currently outpaces what we call traditional investments. Depending on who you ask, I'm also an analyst from where I started, and in my opinion, it's a ratio of 3-to-1. To understand why, think of the landline phone. How many of you had a landline phone at home? Good. How many of you have a mobile phone? If you don't put up your hand, I can get you a feature phone. Now, the one thing you notice is Africa skipped the landline era. And we went straight to the mobile era. That's why most of us have mobile phones, but we never went through having a landline, then a mobile phone. And that's exactly what's happening in finance. We are leapfrogging traditional financial systems. We are building bold, localized solutions through channels like climate funds, blended finance, Islamic finance, private equity, carbon markets, and of course, tokenization, as you've heard. So the message is clear. Alternative investments is no longer an alternative, they are essential. And if Africa is to compete globally, we cannot cling to the same traditional ways of financing our businesses and growth. But the full potential of these instruments can only be unlocked if we build truly ready market, one backed by stronger data, better governance, deeper local capacity, and meaningful collaborations. That is why this year's theme, Enhancing Investment Readiness, resonates very well with me. This agenda is also deeply personal for me. Besides me being the CFA Society East Africa president, I also double up as the CEO of the Raising Capital. Raising Capital is a corporate finance advisory firm, and we help African businesses raise capital. I don't know if there's such a thing in English like triple up, but I'm also the co-founder of Capital Connect, and this is an SME capital raising platform currently supporting more than 700 SMEs in Africa. In many ways, the work we do at Raising and Capital Connect echoes exactly the themes of the conference: inclusion, affordability, digital innovation, and above all, trust building. As this may be my last official CFA Society event in Uganda as the CFA Society president, I want to express my heartfelt gratitude for the warmth of this community, the progress we've made, which I'm very proud of, and the shared commitment to building a vibrant, ethical, and future-ready investment ecosystem in East Africa, and for the courage we all continue to show. Again, Alan and David have shown us the way. So as we begin today, I urge you to lean in, ask bold questions. Don't just sit there and listen to what the speakers say. Question them, critique them, dig deeper into trying to understand what they're saying. Meet someone new. If you've not met someone new already, that's your homework for today. Make sure you meet someone new, and make sure you challenge all the assumptions that are going to be peddled here. Conferences like this is where great ideas are born. But it's not in the ideas that these things grow, it's in the connections that we build. Thank you once again, and welcome to the third Alternative Investment Conference. Thank you.
Thank you so much, Francis. Another round of applause for Francis, please. Colleagues, we are of very low energy. I believe we had a cup of coffee as we were walking. Another round of applause for Francis. Thank you so much. Francis is our president for the CFA Society East Africa. Now, ladies and gentlemen, as we explore the world of bold ideas, and as we open up conversations around the evolving landscape of alternative investments, from private equity to fintech to what my colleague Rudende is very passionate about, tokenized asset. In fact, if there's anything you need to pick from this conference, understand tokenization. I believe tomorrow he will be talking about it on radio. It's important that we are guided not only by our ambition and plans, but also by the vision and structure. And there is one institution that plays a very pivotal role in shaping that structure, in enabling innovation while protecting investor trust and creating a framework that allows ideas to thrive responsibly. To share a few words and officially open our conversations today, please join me in warmly welcoming the Director, Research and Market Development, Dixon, who is representing the CEO of Capital Markets Authority, to deliver their address. Thank you. You're welcome.
Ladies and gentlemen, good morning. Now, I'm trying to figure out why the energy is so low. I mean, we only have this conference once a year. So the energy levels should be a little bit higher than that. Good morning, guys. Good morning. Great. So I'm very delighted to stand before you this day, just to deliver some remarks on behalf of my Chief Executive Officer, who was unable to be with us owing to other obligations. And I'm seeing so many familiar faces. And I guess this conference always provides us a platform to, meet, share, and, exchange ideas here and there. And, meet those guys I've not seen for a very long period of time. So fellow charter holders, friends, very delighted to be here. So you'll allow me to deliver my CEO's remarks, but I think from time and again I'll share a couple of off-the-cuff remarks. At times I lose the discipline and I want to express myself. So allow me to deliver my CEO's remarks, ladies and gentlemen. So the chief guest, permanent secretary and secretary to the treasury, distinguished guests, captains of industry, fellow regulators, esteemed members of the CFA Society of East Africa, fellow charter holders, ladies and gentlemen, all protocol observed, a good morning. I'm privileged to join you today at this pivotal conference where we gather to explore the transformative potential of alternative investments in shaping the future of Uganda's economy. I would wish to start by expressing my heartfelt gratitude to the CFA Society of East Africa, together with the other partners for putting together today's conference under the theme Enhancing Investment Readiness. So a round of applause for the CFA Society plus all the other sponsors. So ladies and gentlemen, today's discourse is timely as our nation has set an ambitious but achievable goal to grow our economy from roughly about $63 billion in GDP to about $500 billion within a period of 15 years. I think your dreams should be able to scare you, right? That's quite ambitious, very, very ambitious. So this tenfold growth strategy demands innovative financing and the mobilization of capital beyond the traditional avenues. And I guess that's where the alternative investments come into play. So our nation's bold economic transformation hinges on 4 key sectors. There is agro-industrialization, which focuses on high-value processing and exports. We have tourism, expanding our ecotourism, hospitality, infrastructure, and cultural experiences. We have mining, oil and gas, which seeks to unlock the strategic minerals through sustainable extraction and value addition. And lastly, technology. So these are what I call the ATMs, okay, which are going to be the main focus of the tenfold growth strategy. So the scale of funding required to meet our development agenda is massive. Leaping from $63 billion in GDP to $500 billion in GDP over 15 years. I think you basically need to think outside the box when it comes to how you're going to finance both the public and private sectors. And I think that's where the non-traditional ways of financing both the public and private sectors come into play. And my understanding of, and just to respond to Rudende, my understanding of alternative investments, anything that's not public equity or public debt, okay? So anything outside the public. So public debt. Tokenization, I've seen someone from CMA, I think you'll probably approach them, but in very simplified terms, when you talk about, yes, they're there. So you should just walk to them. Yes, but in very simple terms, when you tokenize, you're simply creating a digital version of any asset, okay? And you can literally tokenize anything from art, land, okay? So you're just simply creating a digital version, that's it, okay? So the scale of funding will be massive. And just to give you a sense of the funding requirements, the current National Development Plan, that is NDP 4, requires about 593 trillion Uganda shillings, or roughly 158 billion US dollars to finance over a period of 5 years. Okay, so that speaks to the scale of our resource requirements to meet our development agenda. Okay, so we need to crack our heads. How do we raise this funding? How do we go beyond, what's traditional? How do we come up with innovative structures? Okay, so we literally have to think outside the box, and I'm glad that in this room, with all the technical ability, with all the knowledge, I think we should be able to come up with practical and workable solutions that will deliver our national agenda. So, ladies and gentlemen, clearly, traditional financing alone cannot meet the challenge of raising $158 billion US. It won't. It's not going to hack it. So we need to think outside the box. And so private equity, venture capital, infrastructure funds, and structured credit must take center stage. So it's critical that we explore all these other vehicles to deliver on our development agenda. But in order to attract the billions in capital required, it's imperative that these sectors, that is the ATMs and our financial ecosystem, are investment ready. And investment readiness, now from my perspective, should focus on the following crucial pillars. Number one, business development services. I think this, there's no two way about this. We need to find ways of being able to provide business development services to business owners, founders of businesses, so that we increase the attractiveness and readiness to absorb capital out there. So business development services are a critical link, transforming high potential enterprises into bankable opportunities for alternative investors. Okay, so business development interventions such as legal support, financial reporting, governance, and strategic advisory play a crucial role in bridging the gap between promising enterprises and the capital they need. Okay, so as as an example of what is being done around business development services, the Capital Markets Authority and the European Union have established what is called the Deal Flow Facility, which is hosted by the Financial Sector Deepening Uganda. And so what the Deal Flow Facility does is that it provides some business development services, and it also acts as a matchmaking party. Okay, so it matches business owners, founders of businesses, and entrepreneurs to those who have capital. Okay, and I think so far about since the initiation of this particular program, over 200 companies have actually gone through the program or have had an interaction with this facility, and about 6 transactions have been closed, and the bulk of those transactions have been in the private markets. Okay, so business development services will be critical in improving the investment readiness, improving the attractiveness of Ugandan businesses, Ugandan business owners, to absorb alternative financing. Okay, so another key pillar in as far as investment readiness is concerned is around the regulatory framework. I think what we need is a regulatory framework that is facilitative. Okay, we need a regulatory framework that will facilitate both sides to a transaction. Okay, the business owner, the providers of capital. So CMA is advancing reforms to streamline approvals and facilitate secondary markets for alternative assets. We also remain committed to enabling flexible capital raising structures, strengthening investor protections, while reducing unnecessary barriers to entry and promoting transparency in private markets in order to attract institutional participation. Okay, and a facilitative regulatory framework will contribute to overall investment readiness. And the last pillar is around attracting investors through ESG alignment. I think we're all concerned about sustainability. I think we've all seen, as an example, climate change. We've all seen the ravages of climate change. And I think as we were coming to this meeting, we passed through, there's usually a slipway around Oasis Mall, and that slipway normally floods. And I was sharing an experience from about 2 months ago when we had the floods. And for some reason, I decided to pass through that slipway and almost got carried away by the water. So climate change is real. And I almost became a victim of climate change. So it's no longer some alien concept or something really theoretical. It's real. Climate change is real, and we need to focus a lot more on sustainability. So our global capital is increasingly ESG driven, and it's imperative that we ensure that our ATMs meet global sustainability standards in order to attract institutional investors. So best practice in ESG will be important. Okay, so from a regulatory perspective, we're in the process of developing a framework around green, social, and sustainability financing. And we hope that that framework will provide a structured way of being able to tap into green, social, and sustainability-linked funding that is out there. So, ladies and gentlemen, the road to developing or coming up with a $500 billion economy will not be paved by traditional financing alone. Alternative investments are a missing link and the catalyst for transformative growth. So in conclusion, allow me to reiterate the CMA's ironclad commitment to working with all stakeholders, that is regulators, investors, and the industry, to build an ecosystem where alternative capital will flow in support of the national agenda through investment readiness. We shall continue providing the necessary support for initiatives that will unlock alternative sources of capital. Thank you, and I look forward to our discussions today. For God and for my country, Madam Josephine Osia, Chief Executive Officer, Capital Markets Authority. I thank you, colleagues.
Let's establish some ground rules. Clapping when you don't mean it is just unnecessary wear and tear. Okay? And I'm pretty sure that everybody who went to kindergarten remembers this song. If you're happy and you know, clap your hands. If you're happy and you know, clap your hands. Some applause for Mr. Dixon Sembuya. Thank you very much. Thank you, sir, for pointing me out to that table over there. I'll be sitting with you guys soon. I'll try not to ask too many explain it like I'm 5 years old questions. To everybody who is in the room, who's come for the third Alternative Investments Conference 2025, thank you for coming. Whether you're here to deploy capital, to find it, to pitch it, or in my case, decode it, we're happy to have you here. Let's challenge, let's connect, and let's build the nation that we want to see. Allow me now to invite our next speaker from the CFA Institute. He is the Chief Product Advocate. Put your hands together, like I said, when you mean it, for Mr. Robert J. Langrick.
Well, thanks for the intro, and that was a great speech, Dixon, and a perfect introduction to what I'll be speaking to. So, on behalf of CFA Institute, thank you for inviting the mothership here to this wonderful conference talking about this important topic of the future of financing in Africa. Now, I'll just pull up my presentation briefly. So, the big thing I'm going to talk about today for a few minutes is the following. When we look at Africa, all 54 nations, we all know that approximately 19%, or 1 in 5 people, lives in Africa. We also know that in terms of percent of GDP, it's about 3% of global GDP here in Africa. But when we look at the proportion of private equity venture capital funding that goes to Africa, it's only 1.4%. So the question is, why is 1.4% below 3%? And how can Africa increase that 1.4% number? And that's what I'll be talking about today for a few minutes. So let's begin just very briefly for those maybe not super familiar with CFA Institute. So, oops. Here we go. Yes, so we're the biggest finance credential in the world with about 200,000 CFA charter holders. Hands up, CFA charter holders in the room. Have a fair few of you here. There we go. So here's the breakdown across the continent in terms of where they are. Obviously, it's quite skewed to South Africa, but it's growing very nicely. We've got 3,000 charter holders domiciled in 29 African nations. Now, if we look about where we do the exams, we offer the exams in approximately, in 26 cities in 22 countries across the continent. So all the way in the north, south, east, and west of Africa. And we've been growing this quite aggressively, actually. So we keep opening in new countries. Ethiopia is our newest opening we did in Addis a few weeks ago. So we're very excited to continue to grow, and obviously there's more growth potential. And then if we look at the number of new candidates coming into the program, it's about the same number, 3,000 per year. So we have 3,000 charter holders, 3,000 new people every year start the CFA program in Africa. Again, skewed towards South Africa, but it's now growing and becoming less skewed as more people do it elsewhere. Okay, so let's talk about private markets. So we had this great introduction. Private markets, as you all know, because you're here, has boomed. A stat I love is that since 1996, the number of public companies in the USA has pretty much halved. And that's a really good indicator of what's going on globally. Companies are delisting. You see it also in Africa. You see it in South Africa in particular. I think the number of public companies in South Africa has halved since the year 2000. And in its place, you've had a big boom in private markets. So we're the leaders in private markets education globally, and we actually have 4 offerings. I think we'll be talking about this later today. We'll be talking to people interested in our programs in a side session, but we have CFA program, and we now have a private markets flavor of CFA program. We have the basic private market certificate, and then we have the more advanced private equity certificate and advanced private equity certificate. I'll be talking about this a bit later today, but suffice to say, here are the 3 flavors of CFA program. At level 3, we now have a private markets flavor. So about a third of the curriculum is focused on private markets, and we'll go into more depth this afternoon on that. Here are the kind of big buckets of it in the CFA program. So private equity, private credit, infrastructure, real estate, and so on. In terms of the certificate, if people don't want to go through 900 hours and 9,000 pages, there's a way to get that content in a more lightweight way with the certificate, about 75 hours. And then finally, the one thing missing from the CFA program is leverage buyout modeling, or LBO modeling, and we offer that in the private equity certificate. So enough of the advertising out of the way. Let's get on to the main feature here. So the key reason myself and Kingston, do you want to raise your hand quickly so people can see you? So Kingston leads the Africa business here, talking to institutions across the continent. But the main reason we're here today, really excited, is this report here, which was led by several people in this room. So we have Alan in particular, who's the brainchild behind this. This document, 240 pages, all about the growth of private markets in Africa. And we also have, we have this little document, a summary, available outside, which is 4 pages if you wish. But let's just provide a few details of the document. So why did we do this? We really want to show our investment in sub-Saharan Africa, and we're trying to build our networks as well. So that's the key reason we did it. So we're looking at what are the barriers and what are the possible solutions to lift that 1.4% number. And that's why we did the report in May, so 2 months ago, brand new report. So let's just go into some detail. I think we're probably all aware that Africa has some really good assets in terms of human capital and natural capital. This is no big secret. I travel a lot, though, around the world, and what I find really interesting is last year I was in India and China, and I noticed that China, average age 39, looks very much like the USA in terms of age. So it's middle-aged people like myself is the median in China. And then I went to India in May, and I was looking out the window and walking around and thought, God, look at all these young people. The average age there is 29. And then here I come to Africa, at median age 19. It's just unbelievable when you see it, when you come here. I was in Africa 30 years ago, so here I am again. Not been before, to South Africa, to Kenya or Uganda, and definitely you can just see it, the energy. So obviously human resources. So the good news as well is that finance is a force for good, and we've already seen evidence where finance actually improves African economies. So look no further than places like Mauritius, which has become a financial center in its own right. Look at South Africa in particular, and you can clearly see that finance is a force of good, lifting economies up. And the ESG trend as well, as we heard from Dixon, is really exciting for Africa actually, because of all those natural resources and the possibility for impact investing. But as we mentioned earlier, the issue, of course, this has not translated yet into GDP insofar as it's punching below its weight. Unemployment is also a key issue, and the reason we're here today is we realize there's an unemployment issue that needs to be solved with all these young people, getting them jobs. Now, recognize these statistics will have different definitions from different governments, and we get that. But nonetheless, some of these numbers are really big on the right-hand side. There is an issue in terms of getting people the jobs they need and deserve in order to lift the economies up, and that's a key solution that private markets can provide, we believe. And economic problems are growing, unfortunately. So you saw the sovereign debt triple from 2010. So there's not really much room for maneuver of economies across the continent. And unfortunately, development finance is drying up, especially in the current political climate. And so the continent does need to look for new solutions and sources of funding to fill the funding gap we heard about a bit earlier. When we look at the financial markets as well, it's not all puppies, kittens, and rainbows. It's actually quite skewed, quite illiquid, relatively small. So we're looking here at the number of public listed companies and the total market cap in US dollars. It's relatively small in terms of a split of the global market, and it's very skewed to South Africa, which can be viewed both positively and negatively. But clearly these numbers have room to grow. No surprise here, foreign investors on the whole are pretty wary, have been pretty wary in terms of investing in Africa for various reasons. I probably don't need to go into great detail on this, but we do recognize there are challenges when you're road showing in places like New York and London that you need to overcome higher hurdles perhaps than investing in other emerging markets. Now, we also know that credit, the extension of credit, is a critical part of the solution to the problems we face here. So when you look at the percentage of companies who have access to loan facilities on the y-axis, and then you plot it against real GDP growth on the x-axis, you can clearly see a correlation where the more credit goes to companies, the greater the underlying growth rate of the economy. So this is a trend that is pretty accepted around the world. And unfortunately, in the bottom left-hand corner there are many of the African nations. So low credit is correlating with somewhat low real GDP per capita growth rates, meaning there's a scope to increase the amount of credit available to companies across the continent. There's good news though. When we look at South Africa corporate bonds, here's a great chart from the document here. We realize there's more demand than there is supply. So when corporate bonds are issued in South Africa, they're quite significantly oversubscribed, which is a good sign. I think the issue though, well, why not just issue more corporate bonds? There are not enough quality issuers. But this is a really good sign that is demand to invest in Africa. But I think what's missing there is the investment opportunities that the global investors are looking for. So we think three things are needed, and this echoes what we heard from Dixon. I won't read these slides to you. We'll make them available later. But number one of three, fill the infrastructure gap. We heard about the infrastructure gap here in Uganda, and there are various numbers around there. But the key problem here, anyone who's been to Mumbai realizes that when you grow a city too fast, too far, you run into quite serious problems. And when we look across Africa, urbanization is happening very fast, which is a really good thing. That's what lifted China and India, but causes some pretty severe challenges that have to be solved with infrastructure. And so this is what's causing the big infrastructure gap we heard about a bit earlier. So that needs to be filled. Secondly, public-private partnerships. Why do PPP? The reason for it is the governments have really run out of runway in terms of their ability to borrow money to fill this infrastructure gap. So what has to happen is the governments need to figure out a way to bring in private money to help fill that gap. So public-private partnerships are going to be a key part of the solution here. And then finally, SMEs, or small and medium-sized enterprises, they're the backbone of the economy. Take Botswana, for instance, half of all people employed work for small and medium-sized enterprises. The problem is they tend not to have good records, even in South Africa. And so it's really hard to get credit to these SMEs. So need to figure out a way to get credit to small and medium-sized enterprises so they can hire more people and extend more jobs. So we think they're the three things needed. And so the question is, can private capital be the solution? It's very tempting, right? We saw the boom earlier in private markets globally, up to $23 trillion now, depending on how you measure it. And so you ask the question, well, hang on a minute, there's lots of people looking for investment opportunities in private markets around the world, especially in the developed centers. Can Africa be a really good place to park that money? Or that's the question we need to address. And I think the answer is yes, although it's not going to be straightforward to grow that. There has been good traction, though, I will say, from a low base. So that 1.4% number I keep talking about, basically in 2022, the last good data we have, there was $445 billion US dollars in private equity venture capital funding. $6.5 billion went to Africa. That's the 1.4% number. And when you look at the 6.5 billion, that was a boom year. So that was up 66% from 2021. So while it may be small, the good news is it's growing very rapidly. We'll just skip ahead an inch at a time, but it's not a silver bullet. So even when you're permitted to invest a lot into private markets, so many nations in Africa have certain limits on different asset classes, even when you have a generous limit, what we find is that the asset allocations tend to be fairly low. So there's some SAVCA data there. 53% of pensions allocated less than 1% to private credit, and 24% of them didn't do private credit at all. So you can't just say, oh, you're allowed to invest in private markets, go and invest in private markets. That doesn't cause people to invest, unfortunately, even though it's good, you need to have that barrier removed. Still, people are being held back there. And in the document, you'll find, I call it the headache diagram. It's the list of all the problems. It's over 2 pages. It's color-coded with a key there. And you can see all the different barriers that we have to private market investing in Africa with a rating system attached to it. You can see that Ethiopia and Zambia are pretty challenged. And you can go into the report and see this for yourself to see where the analysts came out rating it across those 25 experts we heard about earlier. What the experts think we work with is that targeted policy reforms are needed, essentially. There's some good regulation happening and enhanced regulation, but I'm just going to very quickly list the 9 most exciting proposals just to close out here. So, first of all, free trade areas. We all know that there are several free trade areas, or miniature free trade areas across Africa. We also know that they're not straightforward, but it stands to reason that when you look at the blocks around the world, you've got the USA, you've got China, you've got India, you've got the EU. Obviously, Africa's not together in a block, unfortunately, which means they can't leverage their negotiation. But this shows the potential when you look at the growth, the fact the EU was put together and now has more negotiating leverage. That's shining the path of the future. And what's really exciting is the African Continental Free Trade Area, not without its problems, but when you look at the promise, eliminating tariffs, lowering transaction costs, and so on, people believe it could boost trade very nicely. It's got a long way to go politically, obviously, but we're very excited by this trend. Visa-free travel. 25% of countries allow visa-free travel in Africa. 75% do not. Again, can't be naive. You can't just have visa-free travel. There are reasons you have visas. But at the same time, these barriers may be lowered just to reduce the friction of doing business. Reducing another visa as well, I was noticing we're taking lots of Ubers. And it dawned on me here in Africa that when I take an Uber here, I'm paying 2 American corporations, right? So Uber's taking their cut, and so is Visa or MasterCard, right? There's no particular reason for that. And so there are ways in which Africa can avoid the higher transaction costs of Western institutions by forming their own, which we're now starting to see, which is good to see. Liquidity. We met yesterday with the Nairobi Stock Exchange, who are leading the charge on the AELP. So gluing together several exchanges in Africa to reduce transaction costs and enable anyone in Africa to participate in the markets. Really exciting, and will actually overcome that liquidity problem we looked at a minute ago. Alternative venues. So, hey, it's hard to list a company publicly, so how about we go to a lower venue with lesser obligations, but we still file financial reports. That's a great idea, and so you're already seeing that happen. Ethiopia is making a SME exchange, small and medium-sized enterprise exchange, for example. We think that's a really clever solution to financing. Liquid alternatives. You're seeing the growth now of, well, you saw an ETF listed yesterday in Kenya, actually the MSCI ACWI tracker in Kenyan shilling. Great way to get global investing. You see green bonds in several places now. There are more and more ETFs. People are talking about real estate investment trusts. These are great ideas in terms of boosting alternative funding. Tax incentives. So when South Africa had the energy problems a few years ago, they launched tax incentives. And what they found is that tax incentives are a cheaper way to grow employment in South Africa than doing a big government project. So that's a really good illustration of how tax incentives can actually lift yourself up by the bootstraps. Fintech, you can't avoid fintech here when you come to Africa. We heard about the phones a bit earlier. Everyone's got a phone. And you can just see it on the adverts. It's actually, I'd say, more advanced in many ways than many Western markets. And so this is really optimistic. But when you look across the continent, there's a lot of room to launch these companies. For instance, in Botswana, there's no trading app right now, for example. So there are lots of little opportunities to launch fintechs. And because everyone has a phone, or many people have a phone, that's a really good idea to increase liquidity. And then finally, building professionals. So when we look across the continent, remember at CFA Institute, we see a lot of aspiring professionals, and we count all the people in each market. And so when we look at Ethiopia, for example, there are only 2,000 chartered accountants in Ethiopia. It's going to be quite tricky to actually grow SMEs if you don't have the accountants to do bookkeeping. So we do see a big gap and a big opportunity for capacity building. And there are some clever things happening, like Botswana is funding people through the accounting credentials, for instance. So we think this is really important because if there's a high net worth investor and their advisor doesn't know about private markets, they're not going to want to invest in private markets. There's a lack of awareness. And so we do think it's really important to build professionals. So to close out, here's a nice table. I read the report in detail, and some key highlights are here. And what you realize, no surprise, is all the markets are quite different. And here are some of the key highlights in terms of the proposed solutions by market. So strongly recommend reading the report. I think you'll get a lot from it, whether you're interested in one of these countries or all of these countries. It's a really good 240-page kind of Bible, as it were, talking about private market investing across the continent. There are videos from the authors on our microsite. I'll have the QR code in a minute. So you can see them talking for 5 minutes about each country, which is really fruitful. And then finally, here are the recommendations laid out by different segments: regulators, governments, investment firms. So there are different recommendations, but here's the themes we saw across the continent. So going to finish now. Here's a QR code. We'll make a way to figure out a way to make the materials available. But there's a really nice microsite which links to this report, so you can download it as PDF, and then you can get a copy of this 4-pager outside. But yeah, happy reading, and I hope this was interesting for you. We'll be talking later today about the educational opportunities in private markets that CF Institute provides. But I want to thank the conference organizers for this great opportunity, and really looking forward to the insights later today. So thank you.
Thank you so much, Robert. Clap like you mean it. That's our code for the day. Ladies and gentlemen, from the keynote, from the presentation from Capital Markets Authority, 10-fold growth agenda of Uganda, achieving it, key takeaway is that we are not going to be able to achieve that growth if we do not think outside of the box. The box is, we've always known, government securities and equity. So we want to think other possibilities and innovation to support and help us realize this 10-fold growth agenda. I believe this thought is also further reinforced by the direction that the CFA Institute is taking. for the CFA Society members and candidates, if you thought you were done studying, as they are seated and thinking, it looks like we are just beginning. There is more there is more that the Institute is coming up with, so the opportunity, but most importantly, the focus that we are seeing globally, that there is a shift and there is a focus to take us to the PE space, but most importantly, to focus into the alternative investment space, because I believe it means that globally we are trying to be aligned to the vision, and also to make sure that we fit within the vision that the rest of the globe is trying to follow. So this further enforces what Dixon mentioned in his presentation of thinking outside of the box to be able to enforce the 10-fold growth agenda. Allow me take a moment to appreciate the honor we have today. It's not every day that we get to have or engage directly with those shaping the economic direction of our nation. Having Ministry of Finance, Economic Planning and Development is more than just a privilege. I believe it's a powerful reminder to all of us in this room that our conversation, or the conversations that we are having around the alternative investment space, is not happening in isolation, but it is part of the bigger agenda, a vision for growth, inclusion, and long-term prosperity. Ladies and gentlemen, to help us in this moment connect to that vision and growth agenda, and also to deliver our keynote address, allow me invite Mr. Moses Kagwa, the Director Economic Affairs from Ministry of Finance, to deliver the keynote address. Thank you. Like you mean it, like you mean it.
Good morning, everybody. I'm delivering this speech on behalf of my permanent secretary to the Treasury, who couldn't be here today, but he sends his greetings. The President, Chartered Financial Analysts, CFA Society East Africa, members of the CFA Society, chief executive officers of various agencies, development partners, distinguished participants, ladies and gentlemen. It's such an honor to be here at the 3rd Annual Alternative Investment Conference to address you as we deliberate on capital allocation strategies. I would like to recognize and offer my gratitude to the board and management of the Chartered Financial Analyst Society East Africa for organizing this event to harness the opportunities in our region. East Africa is home to some of the fastest growing economies in Africa, with a growing middle class, rapid urbanization, and increasing technological adoption, but there's need for people like you to focus and direct investments towards key growth areas. Ladies and gentlemen, your choice of having this conference in Uganda was a very great idea. The Pearl of Africa has been regularly ranked among the most entrepreneurial countries in the world, where on average, 3 in every 10 Ugandans start a business annually, and is known as a global hotspot for entrepreneurs. Therefore, the theme of this engagement, the next relay, enhancing investment readiness, is a call to action to ensure that the choice of investments undertaken by our people are those that are ready to attract funding from the diverse finance providers. As we plan on the feasible ways to enhance business development, we should not forget some of the binding constraints affecting business survival that research has provided. Capital, technology, tools, codes, and know-how, infrastructure, electricity, transport and logistics, workspaces, etc., and business knowledge and environment business development services. Government is focused on addressing these binding constraints through a number of interventions, all purposed at creating an enabling environment to support the growth of the private sector. By focusing on addressing these constraints, Uganda, in terms of numbers today, stands at a steady and ready state for investment according to these statistics. Growth. For last financial year, real economic growth was 6.3%, and the projection is 7% in financial year 2025-2026, and also going forward in the medium term. But we think we'll grow faster than 7% once we start pumping our oil. Our inflation has been stable because our target is 5%, but the inflation for the year ending June 2025 was 3.9%. Our currency has been very stable, and it has, for the last year, appreciated about 1.2% against the US dollar. And when we look at the past decade, the last 10 years, and the Uganda shilling has been the most stable currency in Africa. We have been attracting foreign direct investment, and last financial year it was $3.480 billion, and this has been growing. The tourism receipts are still low but growing. Last financial year it was $1.4 billion. We have had also remittances from abroad, which have been steadily growing at $1.29 billion last year. Exports were at $10.25 billion and growing. Some of the challenges, of course, we are having, like everybody else, is the infrastructure gap. And we are looking at making sure that we have all paved roads in this country. Right now, the percentage is about 30%, but we are trying to make sure that we grow that. We have seen in Kampala, we have a lot of jam, which is really affecting growth of businesses, but we are working on trying to improve to resolve this problem by having some flyovers. We are going to start that very early. And right now, Kampala, if you have seen it, it's a construction site because most of the roads are being repaired. So very soon, I think this problem is going to be solved. Given this prospectus of the economic growth, government in financial year 2025-26 commenced the implementation of the 10-fold growth strategy, which aims to expand the economy from 53 billion, which we had in 22-23, to 500 billion by 2040. This plan focuses on key sectors like agro-industrialization, tourism development, mineral development, including oil and gas, and science, technology, and innovation, including ICT, and the creative sector. We call them the ATMs, and we think these are the ones that are going to propel growth. And on top of that, we have the enablers to the ATMs, that is mostly the infrastructure, human capital development, and security. In order to achieve the 10-fold growth, we must attain a growth rate of 7% this financial year and double digits in the medium term. the total savings must increase from 20% of GDP to 40% of GDP. And that is the same to exports. Per capita GDP will increase from US dollars 1,146 to 7,000 by 2040. This therefore presents a great opportunity to all the investors to put their funds in this economy, because you are certain of a good return by focusing at those strategic areas in the ATMs. Currently, the return on investment in Uganda stands at between 12 to 14%. Uganda, as on top of the current export earnings, such as in coffee, travel and tourism, gold, transport, cement, tea, palm oil, it has all added 39 new products to the export buckets in the last 15 years. When you look at these, Uganda is actually growing more than where it should be growing in accordance with the forecast. But we have added 31 new products. However, these are not very high value products, and we need to think about how we are going to add more value to these products so that we can have maximum returns. What does all this mean to investors and for you financial analysts? Uganda's economy is getting more complex than expected for its income level, and as a result, it's expected to grow more rapidly during the decade to 2035 than any other country. Why then invest in Uganda? There's a return on investment, return on equity of listed companies, stable and well-managed macroeconomy. Government is pro-private sector and supports private sector investment through a lot of incentives, conducive investment environment, and then the regulatory and regulatory frameworks and access to the African Continental Free Trade Area, COMESA, and East African Community. So these are the good reasons to invest in Uganda, and right now it's one of the best investment decisions in Africa with an exciting renewed mission, the 10-fold growth strategy that provides so many opportunities for the private sector. In the implementation of our National Development Plan 4, which has started this year, it requires $156.6 billion. Out of this, 69.6 is coming from the government and the rest from the private sector. So there are a lot of opportunities for the private sector to play. So we are very excited to be here and listen to you with the proposals on how we can employ alternative investments in Uganda to contribute to our 10-fold growth strategy. Thank you so much for listening to me.
Keep the applause going until he gets to his seat. Thank you very much. It's always great to have the government in the room, as well as the regulators. Mr. Kagwa, you asked about people making the case for private markets. Allow me to point your attention to the screens for a very special presentation from the CFA Institute. This one is from Mr. Olivier Fines.
Hello, my name is Olivier Fines. I lead policy research and advocacy at CFA Institute. The subject of capital formation and capital market development is central to CFA Institute's advocacy effort. In particular, we are interested in demonstrating the linkages between efficient access to capital and the socio-economic progress this permits. This connection aligns with CFA Institute's mission, which is to lead the investment profession globally by promoting the highest standards of ethics, education, and professional excellence for the ultimate benefit of society. This is precisely the angle we've chosen in our work focused on sub-Saharan Africa. This work has started in 2019 when we released our first comprehensive review of challenges and opportunities for African capital markets in cooperation with ASEA. This year of 2025, we are proud to have released our second research work dedicated to the region, Capital Formation in Africa, a Case for Private Markets. This piece of research this time focuses more specifically on the barriers to capital formation and a series of policy recommendations we address for the attention of governments, policymakers, regulators, and the investment industry. It is the result of an intense collaborative effort with our member societies in the region, all part of the CFA Institute African Advocacy Council. Our purpose was also to evaluate how the global rise of private markets, both as alternative investment strategies and as a source of funding, can play a part in Africa's economic development. CFA Institute has developed specialized educational products dedicated to private markets, including private equity, given their rising prominence in a world's economy that is fast changing into an information and data-driven ecosystem. Given sub-Saharan Africa presents the youngest population on average in the world, it makes sense to start focusing on what capital markets will look like in the future, as opposed to only consider methods of the past. Over 25 local experts and investment specialists located in 11 jurisdictions across the region lended their time and knowledge to this exercise. They brought hands-on experience in their respective markets, such that the overall analysis is a well-balanced result of bottom-up research and top-down aggregation of key messages that resonate at a regional level. The report was launched in conjunction with the annual meetings of the African Development Bank Group, which took place in Abidjan, Côte d'Ivoire, in May of 2025. The main theme of the AFDB's meetings was particularly well aligned with our own objectives, making Africa's capital work better for Africa's development. CFA Institute put together a dedicated webpage on our Research and Policy Center website, including individual videos for the authors of each market chapter. Now, what are the key messages and policy views we developed in the research report? The main barriers to capital formation that are observed across the region include the following 6. Limited structural support for SMEs that are the backbone of the economy, constraints in fundraising options, insufficient range of financial products available, the inconsistency of policies across the region, limited investor education, and underdeveloped financial infrastructure. We propose a series of recommendations in the form of policy insights, including the following: enhanced clarity and predictability of regulation, develop private market channels, needed rules on private assets, standardized corporate governance rules, use of private-public partnerships, coordination between private and public actors, and government-sponsored educational programs with a focus on SMEs. All in all, we believe sub-Saharan Africa is entering a stage of its development best captured by the term capacity building, which includes a focus on human capital, but also research and policy needs, knowledge management, and institutional relations. This concept was discussed at length as well as part of the conferences and discussions which took place during the AFDB annual meetings. For us at CFA Institute, capacity building expresses our commitment to the development of capital markets and socio-economic progress in sub-Saharan Africa. We want to be a part of this story. Thank you very much.
How to make it happen. We require these people in this room to be in those rooms when we are making these long-term plans, and then having clear metrics, holding these people that are given these funds accountable, okay, to following up with the support. Last year, I was at a conference as a panelist, and one colleague, I think, from Bank of Uganda came and mentioned he had been given, I think, about 200 billion to support an agricultural project, and only about 10% had actually been given to the members of UMA. And then the members were saying, we spent the whole year looking for that money. Okay? And the guy was like, actually took back the money to the treasury. So my concern as a private capital advisor is, what is the metric? Is it the great plan, the capital assignment, or follow through, okay, on execution, where the metric is the money has been invested, okay? The money given to Madam Ojangwala and the people at UDB should actually go to 100 companies in the course of 2025. So if that's a metric, and our colleague, Mr. Maitum, the director, at the end of the year, will be held accountable for how many companies he has actually supported, I think we shall put in place mechanisms that will ensure these needy entrepreneurs are actually supported. Then the idea of LPs, I think, is very powerful. Very, very powerful, because if Alex, the head of investment, I think, at NSSF, is responsible for allocating the capital among the GPs, I want to believe that Alex is based on the ground. He knows our realities. His conditions will not be as stringent as CBC in London, okay? Some LP in UK, in US, whose idea of an investment thesis is totally, like you rightly said, disconnected from what we have on ground. So if we can have conversations with all stakeholders, and I think Alan mentioned there is a panel I think that's going to meet in the course of lunch break, I would love more of these people to be on those panels, not as one-offs, but as permanent collaborators, okay? Then, on the front end, the entrepreneurs, we need to support them to step up in terms of governance. I will not repeat what my colleague mentioned, because it is standard fare for all of us, okay? You must have due diligence. I do that for a living. The quality of your books, you know, the management team, the investment plan, clarity around where the capital will be deployed, those are basics. But we as a country must ensure that the NDP4, okay, the capital deployment is aligned with those entrepreneurs that we are celebrating every time. And I like the idea of the tax holidays, because I think they're long overdue. I remember before COVID, I was on the board of one of the SMEs in this country. The guys grew from nothing to about 100K USD a month. But COVID came, the taxes, and the guys closed, okay? So the changes that came in this year's budget, I heard something about 3 years tax holiday for startups. Some of them are long overdue, but I think they're timely. So all these changes and coherence and collaboration should make a difference in the success of this initiative.
Okay, thank you very much, Innocent. Thank you very much, Eric, and thank you very much, Alice. I believe it's been quite a deep analysis. The conversation is just starting for the rest of the participants. We'll probably have further discussions, not just today, but across the different forums and platforms in which we engage. What's come out very key is for us to ensure we're well coordinated and we go that extra mile. Thank you very much, and we appreciate you listening to us.
One more time, let's hear it for the panel. Ably steered by Mr. Kizito Nsubuga. There's something that Alice said when it pertains to the context that we have in Uganda versus the context elsewhere in the Silicon Valley. I think a question that I should leave to everybody is, have we earned the right to make our mistakes our way? I'll leave that to you guys. You've been seated for a while, please stand up. Just before we get into our next presenter, it's a very, very interesting one, I promise you that. It's a very simple exercise. What we're going to do, stand up. We're stretching off the last panel. Please, stand up. Very simple exercise. You're going to spell CFA with your waist. Let's go. C, F, A. CFA with your waist. Please take your seats. Thank you very much. I want to speak to this table right here, because this table here is from abroad. When I say abroad, I mean across the border. No, regardless of whether you came here with a visa or not, you're from abroad. In UG, there's a particular text message that we get that excites all of us. It usually comes around September. In this country, we acronymize. I think you've seen our sponsors. UBRA, CHUMA. We acronymize in this country. But there's one particular acronym. When it sends you a message, you get excited. People here talking about NDP, the budget speech, people will even forget that one. But when the message comes from NSSF telling you how much they are giving you by way of interest that year, it excites everybody. Am I lying? Am I lying? Here to tell us exactly how they're going to deploy our interest this year, please put your hands together for the Acting Chief Investment Officer from the National Social Security Fund of Uganda, Mr. Kenneth Owera, CFA. Keep it going. This man is giving us good interest this year.
Those are not my words. Good morning, ladies and gentlemen. Before I begin, I'll start with a story. So yes, our co-MC today is Moses Rudende, and I've known him for quite some time. Earlier on, he asked a question about alternative investments and his understanding of alternatives. So I will answer him by giving a story. So many years ago, we were in university together, and I was scouting at one of the halls that was Livingstone. And around that time, we had riots, you know, similar to what we have seen in our neighboring country in Kenya. So you have the Gen Zs now, but the phenomenon has actually been happening for quite some time. So there was a strike at Makerere, and if you've been to Makerere, you know how it's organized. So you have Africa, Livingstone, you have Lumumba and Mary Stewart, then you have Micho, Nkrumah, Sibirwa, and CCE kind of in the same area. So one of the key leaders of the strike in the other axis, Livingstone, Africa, was Mr. Rudende here. And he was really encouraging us, you know, throwing stones and whatnot and things like that. And the police was somewhere at a distance. Now, I imagine at that point in time, if you are an investor, you'd probably think this is not a company to be invested in, right? But assuming someone took a bet on him and just invested 1 shilling in him, I mean, looking at Moses today, I imagine whoever had invested money in him would probably be quite comfortable today, right? From just a multiple new investment and things like that. So Moses and members, that is alternative investments, at least a portion of it. You know, you take on high risk early on, and hopefully in the long run, you can be able to get some good multiples on your money. Anyway, enough of that. So my presentation today is going to be very brief. I don't know if I can control it. I'll just make it very brief. I have about 10 minutes. I expect to use less than 10 minutes. My job is very simple as well. I'm coming in after, you know, very, very competent speakers, a competent panel, and I'm coming in as well after you've had a good meal. So I imagine I am not talking to a disgruntled group. At least you do know what the topic is about. Sorry, technology problems. Okay, thank you. All right, so at least I'm coming in at a good time where we have a good understanding of what PE is. But I just want to give the context of NSSF. And I imagine I will be speaking as well for many of the local fund managers, you know. We've had various speakers highlight the challenges that the sector has. I will speak to it from our perspective and what we see. But I would like to give a context of NSSF. So as we all know, NSSF here, and I imagine most of us are contributors to NSSF. We are the National Provident Fund. We collect contributions from the private sector. Recently, the law was amended to allow for us to collect from even the informal and basically everyone in the country. But the fact that it is likely that all the Ugandans in this room, or even the foreigners who are employed in Uganda, are members of NSSF, it speaks to one of the biggest challenges that we have. And the previous speakers have also alluded to that. The fact that, you know, as a country, we are largely informal. We have seen very many reports as well speak to the fact that Uganda, one, is one of the most entrepreneurial countries. But during the previous panel, I think it was mentioned as well that, you know, to a large extent, you know, the informality is very high. Now, when you look at our members with balances, you know, we have about 2.6 million members. Now, it is interesting because when you look at that number and you look at the number that pays tax, you know, pay as you earn, you know, there seems to be a very close correlation with the NSSF membership with balances. And this speaks to the group that we are serving. Yet our mandate is to ensure social protection. So from that perspective alone, we are a bit challenged in terms of our mandate. So we are not serving, you know, the bigger or the wider base we are supposed to be serving on account of the larger labor force. We are talking 20 million Ugandans possibly. So we are just serving about what? Maybe 10%, just less than 10%, or slightly over. So that's one of the first challenges we have. The second one is on the asset side. Now, when you look at, you know, that slide, you're looking at the impact to the economy. So when you look at our size as NSSF, at about $7 billion US, we are approximately 11% of GDP, and our investments are into broadly 3 areas. I will not bore you with that. I will focus on alternatives. An area where we play in actively is in the equity space, and that is largely public and private equity. But when you're to dissect the numbers and you look at Uganda particularly, about, I could say maybe at the moment, maybe $500 million is invested in Uganda. Now, when you look at the stock exchange of the shares that are available for trading, NSSF Uganda holds about 73% of that. So from that perspective alone, we are almost maxed out. We wouldn't want to be the only entity holding shares on the stock exchange because we believe that it is important for other investors as well to participate in that. So that presents a second challenge for us. So if you look at our balance sheet, for example, we are constrained from the liability side because in terms of our collection, we are not serving the biggest chunk of the country, which is the informal sector, okay? And then from the asset side as well, we have a shortage of investable opportunities. So I'm sure this is music to the ears of many of you know the managers at the different private equity funds in the room. In that there is an opportunity, there is a need for investment vehicles that NSSF can participate in. Now, as the fund, we decided to do something about this. And what we decided to do is to integrate backward. And hopefully we believe that this would be able to then address the dual issue that we have. So I don't know how to go back. Let me see. Oh yes, so I'll leave it there. Anyway, we decided to integrate backward. I'm sure all of you have heard of High Innovator. So High Innovator basically was a project, an initiative by NSSF to catalyze, you know, one, liabilities, try to increase coverage by serving businesses that ideally were not covered under those that we were serving. And secondly as well, to try to address the asset problem that we had. Because the statistics is telling us that Uganda is the highest entrepreneurial country, but then we are only serving just about 98,000 employers. So where are the bulk of other Ugandans? So we said, let's do something about it. Let's integrate backward, try to ensure that more businesses can survive beyond their 5th anniversary. And in so doing, we are creating members for NSSF. Hopefully, we can grow that number from 2.6 million that I showed you earlier to a number that is much higher. The other thing that ideally High Innovator would be sorting out would also be creating a pipeline of businesses that then we can be able to look at from a traditional lens of investment. So effectively, you have proven your business model, you are generating your cash flows, we are able to value the business easier. Because many a times when you come to us, we'll ask, give us your books. And as the previous speakers have alluded to, many a times, some of these businesses don't have these basic things that ideally investors maybe abroad would be asking for. Unfortunately or fortunately, NSSF would be asking for the same. Now, what did we intend to achieve by the program? Or maybe just to explain the ecosystem that we looked at. The High Innovator is a partnership with the MasterCard Foundation, who are generally looking to address youth employment and also ensuring that they are able to get fulfilling work. NSSF is coming in to address coverage, ideally in terms of our mandate, but also pipeline for investment. And then lastly, our partner is Outbox, and by no means least, Outbox, who are our trusted execution partner. So the mandate of High Innovator, which was started about 5 years ago, was three-pronged, basically. And I'll speak to those on the next slide. One is to democratize access to education. And when I talk about education, I don't mean academic. I mean, ideally, business education. I think the previous speakers, you have the report by the CFA on capital formation in Africa alluded to the fact that, education of businesses was a big constraint. So High Innovator basically was coming in to address that. So democratizing access to education. Secondly was to enhance the ecosystem. And I like the fact that we are having some very interesting discussions in the room. Because for a long time we have been accused as NSSF of not supporting private equity in the country. And unfortunately, these decisions are also not made by individuals ideally. We have committees that we have to present to. And there are certain criteria, there are certain considerations they look at. I know Innocent referred to the fact that we shouldn't have criteria that do not make sense, okay? But later on, I'll also speak to our context as NSSF, but I believe broadly as, the local fund managers in the market. But anyway, for now, our second mandate was to build capacity of the ecosystem, because we believe that it is very important for the ecosystem to be vibrant, which will translate into businesses actually being able to, one, survive, secondly, adopt best practice, and then lastly, be able to attract the capital that has not been looking at these spaces. So we hope that we could be able to achieve that, and we were also improving access to patient financing. I know the panel talked about some of the ticket sizes they look at, $100,000 to $20 million. High Innovator was looking at a ticket size of $20,000. It is amazing what the High Innovator has been able to achieve, and I'll just show that on the previous slide. But there is something that one of the panelists said that I found very important. A business that is raising $100,000 in capital. I mean, it's probably a young business, it probably started maybe 1-2 years ago. Things happen fast, you need additional capital and the like. Then you have businesses that are looking at $20 million in capital, right? Now just think about it for a moment, $20 million. I mean, this is in Uganda's case. Recently MTN raised about $100 million, okay? That is probably our biggest corporate in the market. Now, $20 million is really your solid established SME in the market, right? But then, one of the seasoned operators in the market is telling us that these guys have the same challenges that someone who started last year has. So that should be sobering for us as operators in the space. Because if someone that is seeking for capital to the tune of $20 million has the same problem as someone who started yesterday, then there is a big problem. We need to come together to do something about it. I will say this because it is a matter of public information, and as Ugandans, we probably know this very well. If you're to look at the number of businessmen who are thriving, past 10, 20, 30 years maybe, and you try to kind of track the progress of these businesses when the patriarch is not there anymore, you will struggle to actually count businesses that are still operating on one hand. And that should just tell us the amount of work that we have to do as operators in the market. So I hope that is sobering enough. I hope as I'm proceeding, we can be able to understand the amount of work that we have to do. Lastly on this is just to talk about the impact that High Innovators achieved over the past 5 years. We set out to educate as many businesses as possible, democratize access to education. The target over the 5 years was 75,000. That number that we have achieved is just over 75,000, so we've achieved our targets on that basis. We set out to work with players in the ecosystem to at least support about 500. We have just been able to achieve under that at 438. But for us, what is important is the impact in terms of just those we have been able to employ, enable to have a fulfilling livelihood, and have access to opportunities for work, either direct or indirect, and the number's been at about 152,000. I would just like to say something, because as NSSF, we are privileged to operate in a number of sectors, and we do have one of the biggest real estate portfolios in Uganda at least. We should be the biggest real estate developer in the market as well. And you know, we do hear very sobering stories as we engage with some of the contractors that we have. And this is where sometimes you think about it and you say, you know what, maybe we are just having challenges because we haven't organized ourselves enough to actually tap into the opportunities that are available. We have interacted with a number of our contractors around the people that they employ and the opportunities that are available. And I'll give you an example. We are developing 550 houses about 18 kilometers out of Kampala in a place called Temangalo. So this is going to be your organized community for the mid to low end of the market, and we have different house types there. Now the contractor was telling us one of the challenges she had, and this will be quite interesting. So we are trying to finish the project within a certain time. But one of the challenges, the biggest challenges that the contractor has is in terms of skilled labor. And we are talking painting houses. So effectively, they have put up about 350 houses. They are developing some 200 more. Of the 350, they cannot paint the houses at the same time because of a lack of skilled labor. Guys, I'm talking about painting a house, okay? Abroad, these are things that are done by the owners of the property, right? And I imagine they do a good job. But in Uganda, we cannot get more than 50 skilled painters of houses, okay? Now, you're thinking to yourself, you know, we have SMEs and whatnot, you know. Is it that there is a lack of opportunity? Or probably we just haven't organized the ecosystem, the companies to be able to tap into these opportunities. And that goes to what we have been talking about from the beginning around investor readiness or investment readiness, you know, whatever you might want to call it. Another one is just around, you know, metalworks, for example, right? And these are projects that are running in the country, Ugandan money predominantly, but we cannot get companies, local companies that can be able to deliver some of these things. So this is the scale of the challenge, you know. I do not want to believe that our problem is entirely around the lack of capital. And I'm sure Dixon, if he was around, would be able to kind of give us the stats. When you look at the market, the money market segment in Uganda, for example, prior to 2020, the market, if at all it was big, was just under $100 million. As we speak currently, and I'm sure my numbers are not updated, we could be talking in the tune of $1 billion in just a period of about 3 years, you know, from the time COVID happened to date. And that space is growing at about 20% every year. And this speaks to the scale of opportunity that is available. So I am glad that we are having very frank and honest conversations. And I would just like to move on to the next slide around what next, ideally for us as players in this space. And the context of the local fund managers around as well. Because earlier on, we were being told that, we should not have criteria that ideally is excluding SMEs and local businesses from being able to tap into the funding. But the reality of the space we operate in is that the government is borrowing money domestically at levels of 15 to 18%. Now, we have interacted with many private equity managers. And ideally, this is not to a large extent the fault of the managers, I would say, but maybe the context of the market that we're operating in. You have a situation where the government is borrowing at 15 to 18%. In 5 years' time, an investor has doubled their money. In 10 years' time, your money has grown 4 times. Now, when we compare this with the private equity managers, and I mean, it's just a reality of the market, in what period would an investor be able to double their money? Right? In how long would I be able to grow my money to 4 times that number? And I really like the example that one of the panelists gave around the growth or the time that some of these asset classes have been in operation. You look at private equity, for example, and you look at the companies referred to, KKR, you have your Carlyle, your BlackRocks and whatnot, and they have significant sums of AUM, right? But when you look at their context as well, I mean, fixed income securities are yielding what? For a long time, it was up to 1%. It was very low. In Japan, you could actually get yields were at negative interest and whatnot, So that is the context of the market they're in. And you can understand why suddenly in the 1980s, you saw private equity in the USA kind of pick up significantly. Because in the 70s, yields on government securities in the US were at the levels that they are in Uganda, the mid-teens and the high teens. But what happens in the 1980s? Private equity picks up. Why is that the case? Because they can no longer enjoy the high returns that they're able to get from government securities. Now, this is just what any rational investor would do. I wish the government representative was still around, because this is a challenge that we all have to deal with, basically. That for as long as the government is still borrowing at these levels, it will be very hard for us to see capital going to the spaces we want them to go, to affect the real economy, and to also become flexible in our investment criteria for us to get into these spaces. I will give an example of our experience as NSSF. We were trying to make a case for private credit in the market. And the investment committee asked us a question: do you have data to back that? And guess what? We did not have any data to back that. It's good that some funds are looking at private credit. Hopefully over time we can build, just that data and the like. But for as long as the government is still borrowing at those levels, it becomes very hard for you to actually see flexibility from the traditional asset managers in terms of their criteria. That being said, though, I would like to really give credit to the government. I think they have made significant concessions from a tax perspective just to try and ensure that this entrepreneurial drive can be sustained. You have very many tax concessions and the like, but for us as players in this space, for us as the fund managers, I think we need to sit together. And Innocent, you alluded to this, that it is important for the different players to sit down and have an honest conversation around what needs to be done for us to see this area of alternatives thrive. Mine is really not anything but just to kind of give us that honest discussion. You know, obviously for us as well as the fund managers, it is important that we are prepared. I know there is a famous Kenyan politician who said, nobody will stop reggae. At some point, the reggae stopped. Obviously, depending on the nursery school one went to, there was a game called musical chairs. And the idea was that we'll have a certain number of chairs and we'll always have more people, at least by one number maybe, or more than that, going around the chairs, right? The whole idea was that the music should not stop and you don't have a chair to sit on. So hopefully, at the end of the day, you know, whoever remains has a seat to remain on. So obviously for us as the local fund managers as well, it is important that we are ready in the event that the situation in the country changes from a return perspective. But for as long as that is still the case, it will always be very difficult for us to actually see local capital going into that space. Yet I believe local capital going into the space would be a catalyst for seeing more money going into that space. I think lastly, as I finish, is around the need for the different providers of capital, the different players in the ecosystem, to work together to try and just grow this space. Can we have more businesses surviving their 5th anniversaries, moving on to scale, as the panelists mentioned, moving on to even list on the market, you know, locally. And as we have more and more of those stories, I think it would be easier for us to sit here and say, look here, finally, this alternative investment space in Uganda is gaining traction. Thank you very much for your attention.
Thank you so much, Kenneth. Thank you. Another round of applause for Kenneth. I'll take a few seconds to recognize our sponsors for the day. NSSF, we are grateful. NSSF is one of our key sponsors for this event. UBRA, Country Wealth Advisors, ABSA, Gen Africa, we are grateful. We are able to have been able to do this because of your support, but also your key contribution to the subject that is being discussed. Thank you so much. Clap like you mean it. That's our tagline for the day. Clap like we mean it. Thank you, and to our esteemed participants, thank you so much for paying attention. To quickly, we are running out of time. Our next session is localizing access to carbon markets in Uganda. We've been talking about climate finance, ESG, sustainable economic value. How do we achieve sustainable economic value? I am privileged to invite Mr. Wangolo David, CFA. He's the Chief Investment Officer, Rikindo Capital. And Rudende, pay attention. Yeah, thank you. You're welcome.
Okay. Good afternoon to you all. I know I'm standing between your lunch and the rest of the afternoon, so we'll try and make this as exciting and as quick as possible. Kenneth, sitting on $7 billion makes you the most attractive person here, but certainly that money doesn't belong to you, so I know you're also the least attractive as well. It's a conundrum. 7 billion, and you can't do anything with it. We'll quickly go to the next panel, which is going to discuss localizing access to carbon markets in Uganda. Now, this is a highly conceptual asset. Definitely, a lot of it is going to be driven by our imagination rather than by what we can touch and feel. I have the enviable role of moderating an expert panel that will go through the process of discussing what the carbon markets look like globally and how we can localize that in Uganda. Of course, speaking to our development agenda of 10 times GDP. And that panel will also be joined by another colleague who is investing actively in this. So David Gunahasa, team lead, Industry 4.0, Science, Technology, Innovation Secretariat, is a big benefactor in innovation, science, and technology, and a big benefactor to Carbon Access Lab. You're welcome. A hand of applause. He has money. And we'll also be joined by Mr. Mutahi Mak, who is the venture lead for Carbon Access Lab. Now, the way we'll curate this is Mark will lead on this concept, which many of us still find highly imaginative, with a brief discussion on what exactly he's marketing and selling. Then we shall dive into a fireside chat, a brief panel here, to discuss the questions that we may have, and maybe also take questions from the audience should time allow. So without much further ado, please let me invite Mr. Mutahi Mak for the initial brief, and then we shall get into the discussion as a panel. Thank you.
Thank you. Yeah, thank you, David. Good afternoon, good morning, everybody. Last year, I was here speaking about climate finance, and I was invited again. And the brief I was given is people don't understand it. It's highly conceptual. As I said, I was speaking to Lisa, our co-MC, and she was saying people confuse ESG with impact investment, with climate finance, with the social investing and all these things. It's disappointing that CFA is a year later in the same place. My hope is after today, you don't call me back here. I want to say this for the last time and move on with what I'm trying to build. So hopefully after today, I'm not coming back to talk to CFAs about climate finance. But frankly, and more seriously, to set the stage, before I get into what the lab is trying to do, I think it would be useful to explain what is going on. So, and I'll try not to be very technical, because David is right. It's fairly conceptual. It can be highly technical. But the issue is this. Uganda as a country has what we call NDCs. NDCs are nationally declared contributions. So as a country, Uganda has declared to the world that by 2030, we're going to reduce our emissions by about 25% from a certain baseline scenario. So that's 6 years from today. That 25% reduction in emissions translates to about 37 million carbon credits, right? 37 million carbon credits. In Uganda, as of the last study was about 2023, since the whole carbon credits market, climate finance market was active in Uganda, the registered number of traded credits from this country is about 30 million. So from inception to 2023, we've done about 30 million. Now, we have a goal of doing 37 million by 2030. Now, that's the first thing to know. Our NDCs is about 37 million credits. The other thing is really around finance, right? So Ministry of Finance has a climate finance strategy 2025, which is a very comprehensive thing. And within that strategy, we have a need of about $28 billion to meet our climate action targets. So to meet the other 37, we need about $28 billion. Now that 28 billion is broken out into about 85% is targeted to come from development partners, international partners. 15% is supposed to be, and this is the role of, I think, a lot of people in this room. 15% of that figure is targeted to be collected domestically. About 85% will come from abroad, and that figure then is further dissected into adaptation, mitigation activities, and different things. So now we need 28 billion in 6 years as per our strategy, and we have to hit those targets. Now, effectively, the way you do that is through having projects that generate carbon credits. And this is the primary problem we have in this country. We just don't have the projects. We don't have projects that will generate that volume of credits. They don't exist. There has been, so the 30 million I said before has come from multiple things. The big one that a lot of people know is, clean cooking projects, very almost like, domestic substances type projects, solar lights, water filtration systems. There's been some industrial that has happened. But effectively, as per our strategy, we need to get into e-mobility, we need to get into waste management, the whole issue at Kitezi, there's a whole carbon sequestration thing there. Agroforestry, large-scale forestry, regenerative agriculture. So there's multiple projects that we can run to generate these credits. The problem is, we just don't have the projects. So then you ask, why don't we have the projects? And much of it has to do with just inability to be able to design, get those projects registered internationally, meet the monitoring standards, bring them to market commercially, meet the buyers, work with the brokers, and actually get these credits sold. So what is the Carbon Access Lab? Carbon Access Lab is an innovation where we are going to support local developers to actually go through that entire process. That process is highly technical, very complicated, but it's very necessary if we're going to meet those NDC targets that we've already declared, right? So the lab that we put together, and we're going to speak some more through the rest of the panel, is really an accelerator that's going to support local project developers. The 30 million number that I mentioned, if you track back to who actually generates those credits, much of them are foreign entities. And that's because they have the technical expertise, they have the capital, and they have the access to markets, right? So for us as local developers, we really struggle to be able to unlock the financing that's out there. Further to this, that whole point about the financing, globally, developed countries are contributing about 300 billion to developing countries to meet their climate action targets. That figure is annually for the next 10 years. So effectively it's going to be, what's left is about 1.3 trillion, although the gap is even more than that, maybe about $2.5 trillion. So the truth is there's a lot of financing that's going behind climate action, globally, locally, and regionally. And if you look at our other regional partners, including Kenya and Rwanda and some other countries around us, they've done quite a bit, significant work in actually trying to get towards the NDCs by working through climate projects. So our goal is to be able to take local companies. We're doing this as a pilot, like I said, we'll speak some more to it, and actually get them through that entire process of getting good, verifiable, large-scale projects to market and actually be able to generate carbon credits. That's sort of the background of the scene.
Hand clap, that's a mouthful. 28 billion, I only see a few players in the room. Maybe, thank you for that, Mark. Maybe just to dive into, the role of the Secretariat in this. Is this something that the private markets cannot fathom, and therefore we are looking at a situation where government has to lead? And what would be the implications of government leading, especially from a supply side of capital? When capital is available, you throw anything at it until it's fixed. So where do you kind of know that this is where we are stopping, and let us allow it to develop commercially?
So it's very interesting and an honor to be speaking here to CFAs and a bunch of finance people. And what's interesting, when Mark was speaking, I thought the same thing I've always thought about carbon credits. When people who understand the space speak about it, they just leave us wondering, what did you just say? And I can tell you I'm sitting here, and I have a fairly decent understanding, but I'm also asking myself, I'm like, Mark, what was that? And I want to give you what I think would be another explanation that helped us as a Secretariat really appreciate carbon markets, carbon credits, and the opportunity as it is. So there's compliance markets and the NDCs that Mark spoke about, where every country has a commitment in terms of how much they should sequester or reduce or whatever it is. Now think about it this way. In many of these compliance markets, what the country says is that you can emit up to level X, right? So let's say there's infinity at the top of it, and you have 10. So you can emit 10 tons of CO2 And that's fine within your production or your activity. And this CO2 can come from your manufacturing process, your travel emissions, your flight, whatever it is, right? And then anything over that, you must buy back. Either you buy permits as part of the compliance market, or go to what you call voluntary markets, and you buy credits to offset your emissions. What that basically means is you're creating a huge potential market, demand for these offsets or these tons of CO2 that you're buying from some of the other markets. So Uganda is one of the markets that could ideally issue credits that could be purchased. So that's foundationally what it is. There's somebody looking to buy tons of CO2 that you save either from your soil or from clean cooking or from e-mobility or whatever it is. Now, the challenges that we realized as a Secretariat, one is there was very limited awareness, because how do you remove tons of CO2 from the atmosphere, right? So yes, you plant trees, great, I've planted trees, can you come and buy my credits? It's not just as simple as that. Same across the board, so same across clean cooking, direct carbon capture. We have Peter over there who's built this huge biomass facility generating energy and is ideally providing a different way to generate energy from fossil fuels. All these are opportunities that exist, but how do you issue credits? How do you tap into this market? And that's what we as Secretariat are doing, and I should say very proudly that we are the first to back the Carbon Access Lab. Now, how do we do this? One, we want to be able to create awareness around what the carbon opportunity is. I don't know if you guys know this, but it's very public information. If you go to what you call the Vera registry, or many of the other registries, Gold Standard or many of the others, you'll find a number of carbon projects. In Uganda, there's probably about 96 registered today, issuing millions of credits every year. Average price per credit is anywhere from 7 to, I think Peter always argues and says you can get credits going as high as $700 per ton of CO2, depending on the methodology. Now, 90% of these companies are foreign, and to make it even worse, of these foreign companies, they're domiciled outside Uganda, which means whenever they trade any ton of CO2, the payment is made to Singapore, Malaysia, or wherever it is. You're not only losing money that could be coming to this country, but you're also losing tax revenue and so many other things. Now, the Ministry of Finance and the Ministry of Water and Environment are doing a great job with putting in place policy and regulation around this. There's a framework that came out recently that means you have to register, and of course that implies that your projects are higher value. The other thing is the huge conversation around what you call MRV. So after you have your trees, you must develop this into what you call a carbon project that's run by a project developer. In this case, the Carbon Access Lab is going to come in to support project development at scale. And then you have what you call MRV, so monitoring, reporting, and verification. You must constantly do MRV on these projects to be able to meet the demands of the buyers. That's another thing that we want the Carbon Access Lab to be able to support with. So what we're really thinking is, how do we as government come in to create, one, awareness, two, competence, so competence to do the auditing, the MRV, the support mechanisms, and then lastly, access to the carbon markets. How does this work? I don't know if you know this, but you can actually sell 2-3 years on a carbon project forward. And that way you're able to unlock sufficient financing into your project development or project implementation process. So say, for example, you want to do a geothermal power plant, you've done your feasibility, you've proven it actually works. What you then do is you're able to actually find people who will buy your carbon credits that will be issued, not the power, but the credits. And that's also something very interesting, because now you have technically two revenue sources. You have revenue on the actual product that you're generating or producing, but you have revenue on the carbon as well. So government is coming in to try and really, and I want to speak about this properly. The STI Secretariat is coming in saying, can we support foundational innovation? Can we support awareness? Can we support access to MRV, and hopefully see many more projects coming on board?
Okay, thanks, David. I'll just take it back to Mark. The Uganda context is unsophisticated when it comes to investment products, executing on these investment products, making them profitable. And this could easily be the next Ponzi, right? So to what extent would you require regulation in this market, asset quality, monetization, liquidity, without it seeming as though I'm paying Peter to pay Henry to, an endless carbon mining field, which, could just balloon into a bubble, and before you know it, people are losing money. 700 a ton, 7,000 a ton, who knows? So to what extent should regulation come in, or should we just allow you to fly with this thing the way the digital assets have, kind of run away from the regulator?
Yeah, I think that's a good question, and to be quite frank, that's why we're excited with our partnership with the ministry, right? Because just like I think the fintech space, you're sort of in this gray space where regulation is unclear. But what do you do? Does industry follow regulation? Does regulation follow industry? So in one way, over the last few years, we've sort of been walking in this Wild West. And the truth is, globally, there's been issues around greenwashing. There's been issues around transparency. Are these credits actually being generated? There's questions around who is the actual beneficiary. Many of these projects happen in communities. Are they actually seeing the core benefits of the project? So what you mentioned actually is really true and has been a problem in certain places and specifically in certain sectors. More recently, there was a whole scandal in the cook stove space. But what we hope to do is to work with regulation, right? Now, carbon is a policy-driven market. When policy changes, like for example, and I keep using this example, when Biden is in office, carbon does certain things. When Trump comes in, it does other things. Investors, as you all know, need certainty, right? It's very difficult to play in a space where you don't know what the regulation is going to do tomorrow. So globally, yes, and David talked about the compliance market and the voluntary market. There's people like, for example, the European Union Trading Scheme who are just doing their own thing because they truly believe in the science that climate change is an impact of human behavior. Now, there are those who want to make America great again that don't believe in that. But what does that mean anyways, right? It doesn't matter what the cause is, it's just we know the impacts are happening. So on one end, in the context of Uganda, there's a lot of regulation already in place. So Ministry of Finance, as you talked about, there's a national climate policy, there's a National Climate Act, I think it's called. There is now a Climate Market Guidelines 2025. There are very good policies that have already been designed, but they're not really regulatory policies per se. And so yes, there is a role for regulators to play, provided that role is complementary to help the market grow, as opposed to come from a position, which typically regulators tend to do, come from a position of control versus a position of enablement, right? Secondly, though, and another important reason why we think the relationship we have with the ministry is very valuable is lately there's a new trading scheme where countries can trade across each other. So Uganda, for example, can trade credits with Kenya. So we both have NDCs, as I talked about before, but we can generate credits here if we can do it cheaply, and we can sell them to Kenya to offset their NDCs. Now, that will require two things. One, we need to have a registry on our side to make sure we actually have those credits. When we sell to Kenya, to your question about Ponzi, we need to do what they call a corresponding adjustment. We need to remove the credits from our side so we don't double count them. So that means, but that's something that only the government can put together. As private sector, we're not going to build this national carbon registry and do the corresponding adjustment, right? So, but that is what is happening globally. And already, Uganda has interest to deal with Switzerland, with Singapore. Tanzania is already doing it. Rwanda and the Swiss have a contract. There's so many countries that are already doing this right now. Even Kenya does. So we want to work with those regulators. And there's different places for different people to play. There's a Ministry of Water, there's a Ministry of Environment, Energy, Finance, STI, potentially CMA from a position of investor protection, supporting green funds to come here and making that easy, green products. There is a very popular, I think you guys might know, debt for nature swap initiative that is happening. So we can offset our national debt by commitments to investing in climate, but we need to be able to prove transparency. So the MRV that David is talking about also becomes equally important to get away from that Ponzi situation, right? And now, because of technology, there's so many things. There's drone technology, satellite imagery. If you say you have a forest in Mbarara, we can actually track it using remote sensing. There's so many things, IoT, there's AI. There's so many innovations that bring transparency to the market, but those also still have to be underpinned by policy. So for us, we don't see policy as a threat. We see them as enablers to actually deliver on these NDCs.
Okay, now with the uncertainty of policy, I just want to go back to what you believe is a good pipeline, just to speak to this room. Because when we hear carbon, there are very few business opportunities that may come up as obvious business opportunities. Two questions. One, do you look at the business in its entirety in terms of it follows carbon from the boardroom to the sweeper, and that is the business model? Or do you look at aspects of that business that are generating good credits, even though, God forbid, they make cigarettes? I'm just throwing it out there. Just give you a bad case scenario, but has some carbon generating aspects like energy saving, or is it the entire business model? And what would tick the box of an entity? We'll start with you, David, before we go back to the venture lead in asset selection. And just to make it very obvious for this role where they can play, because it seems the only example that comes to mind is plant a forest. And people have done that quite a bit, planted trees and tried to harvest these.
Like I keep saying, I think people like Mark have been hiding this truth from us for a very long time. So you should ask him a lot more. But so there's two types of projects typically you're looking at. So some are mitigation projects that remove CO2 from the atmosphere. And there's many opportunities in that case. So you have things like clean cooking, because you're providing an alternative what already exists. So as opposed to using your stoves or your cigarettes, you're using energy efficient cook stoves. You have things like e-mobility, works very well. You have innovations like around energy generation, so geothermal, I mean, technically hydro probably is also a mitigation type of generation process. You have reforestation. There's a number of different types of projects that are able to remove CO2 from the atmosphere. You also have things like direct carbon capture. We're really innovation driven to do that. And then you have adaptation methodologies that are reducing the impact of what's already happened. So building, dams in some areas, climate smart agriculture, drought resistant seeds. Very many of the different things that we do are able to have a sort of a carbon play to them. The question is, how big is it? Because the people who are buying these credits are interested in sort of larger carbon credits issuance. So typically, a serious buyer is saying, if you're issuing 10,000 credits, it's exciting for me. Now, I'll come back to your question around, do you look at the entire business as it is as a stack? But for us, in our case, as the STI Secretariat in this case, yes, we're interested in the commercial viability of the entity, but the ability to effectively also issue credits, because that is a huge revenue source. And why we do that is because we have an interesting target. Whenever I hear government people speak about $55 to $550 billion growth of GDP, and then I started we had this exercise where we sat in a room in Ginger for I think about 5 days, and it was like find that additional 500 billion you need to create, and we struggled. We struggled hitting our heads on the wall, because let's be honest, what is the eventual growth in, say, your agri sector from an export perspective? How much more can you generate? How much more can you generate from your manufacturing sector? And in reality, what we need to do is look at innovation to drive this, and climate gives us a very good opportunity. So for example, and if you know this country's natural carbon stocks are about $800 million. This is just what you have in the trees and the lakes and all that. When you add innovation to that, you can substantially increase that. So yeah, for us, as STI, we look, yes, it has to be commercially viable, but also can it issue credits, what volume, what value, and how can we support that? Okay. But we should ask Mark more about the business, whole, the business stuff.
Speak to that, and also help this room appreciate whether this is a good spend of money in Uganda, given the myriad of challenges that we face as a country. Do you think this should be where NSSF puts their money?
100%.
Okay.
100%. Or if NSSF is putting money in High Innovator, they should lean towards climate-leaning startups or early stage ventures. But to your question, and I think David has answered a lot of it. For many companies, if you're not primarily in the clean energy space, carbon credits will potentially be an additional revenue stream, right? But either way, the foundational business, and the panel before was talking about investment readiness, the foundational business needs to be sound. So whether I'm selling clean cook stoves, that business needs to work because I generate credits from the use of the stoves, right? So it's critical that the business itself is sound. However, the methodology allows for almost any business to be able to generate credits from the activity. So I'll give you an example of this hotel. And I was commenting to Lisa at my table that when I walked in the room, I was very disappointed with the carbon footprint of this conference. The one-way plastic with these Renzori bottles. I think we've been to other conferences where they have a quail or those glass bottles. The amount of paper, the bags they've given us. All of us are going to go home with 3 Buvera, which have in the same things almost. But my point being, so I'll use the example of Sheraton right now. So the methodology allows, and I don't want to get too technical, but I'll try to explain this simply for the room. There's 3 types of credits that Sheraton Hotel can generate. There's what they call Scope 1 credits. So the Scope 1 credits will be generated from the fuel they burn. So if they have a diesel generator in the back that they run, Uganda is a bit different because our power is hydro, right? But if they had a diesel generator, we can figure out the emissions from that, right? And we run a project around Scope 1 credits. Scope 2 credits are credits that are generated from the activities. So those are things like their employees coming to work, so the carbon footprint of that journey, right? So Scope 2 credits are from the energy they consume. So number 1 is from what they burn, Scope 2 is from what they consume. So when they buy power, and that's the example I was sharing, why hydro is not a very good example is if they buy power for the lighting, for the AC, for the elevators, for heating, for washing clothes and all that, we can figure out that carbon footprint, and those are Scope 2 credits. Scope 3 are from the activities, and those are broken down further into upstream and downstream. So upstream is like I've just mentioned, when the staff come to work, what's the carbon footprint of that commute, right? Downstream is when you host a wedding, one event like this, the amount of plastic that we've consumed and all that. So we can also quantify that, and there's a project around that. So truly, human activity has a carbon footprint that can be quantified, commercialized, and actually sold and traded. But for all that to happen, there's a lot of transparency, back to your question. And there are a lot of process and systems and documentation and technical, how do we count the credit of this conference today, right? And that's the sort of technical capacity that we want to develop at a local level so we can make it easier for local project developers. So when we're looking at projects, the big question now then becomes scale, because it's not easy, it's not cheap, right? And the question is, okay, is it worthwhile to go down the path of putting a carbon project around the Sheraton Hotel from the context of how many credits might they generate against the cost of that?
Okay, you sell a case, but I'll just throw him a curveball since he's the policy guy here. Russia went into a war with Ukraine, and everyone in Europe kind of felt that we shouldn't be buying fuel from Russia. They quickly ran into a winter storm. Germany, which had decommissioned some nuclear plants, had to recommission those plants. And from tree hugging, we just saw a 180-degree shift back into, conventional energy streams, which, kind of then made the policy ineffective to track. And this is just a question back to you. Can we really develop the scale? Because you're going to throw sufficient amount of capital at this, and the government of Uganda will want to set up a nuclear plant. For any reason, just cost of energy. Or we'll want to definitely commission the oil project. For any reason, just to reduce the cost of energy. So speaking from such a high level, and the examples that you've seen of economies that can actually say, well, we shall refine, we shall reuse, we shall do all this, and they have the infrastructure to get that going, you clearly see that a lot of them have backtracked on some of these promises. So who are we to do this at scale, apart from it just being a nice-to-do project in Kampala?
One of the most interesting things is that the people who believe the earth is flat, and they argue this very, 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 very well. We have to accept that there is a lot happening as regards climate change. It's happening, and we see it, and we face it, and we go through it. the arguments around our development agendas are not put aside as such, but there's a possibility of you developing responsibly while caring for the environment. Now, I'm also very pro-development. I'm very pro, we need to get our pipeline in place. We need to get our manufacturing up and running. The beauty about Uganda is there's a uniqueness to it because, in truth, we're almost 100% hydro, right? So our energy is actually being generated, and it's hydro. So I think that's not something that we worry about very much. But I want to speak into the opportunity, right? So there's a little project that we are, because I think it's best to give you an example. There's a little project that we're scoping right now in eastern Uganda. So for those of you who've come from eastern Uganda and you've noticed how bad the degradation is. If you drive from Iganga through to Mbale, Soroti, and you look around the roadsides, so when you're in the west of this country, you look at the roadsides and you're seeing acres of very good plantations. Then you go to the east, and it's a few very miserable looking maize plants and a few miserable looking cassava plants. And this is a restoration project that's being done, one of the things supported by the Climate Common Access Lab. So I think it's over, 17,000 hectares being restored, and it's a mix of different things that they're doing. And I have a few numbers here. So they're trying to grow, I think it's 30 million coffee trees. I think it's sort of, there's an extension area they've added to it. Now, based on the projections that they have, and again, these are projections, may not be accurate, they say that by year 5, they can do up to $400 million in coffee production. And by, I think, year 25, they're doing about $641 million in coffee production. That's a really big number, right? It's coffee production. But then they're also estimating they can go from 167 million to $251 million in carbon value generated. Now, how many projects are going to give this kind of upside? And then the argument is, how do we invest in this or how do we fund it? The beauty is that all we have to do is cover the cost of project development, that's the feasibility cost, effectively. 2, cover the cost of MRV, and this may be either using remote sensing on one part, but on the other hand, there's a possibility of doing ground sensors as well to validate the remote sensing data. And we, as SDI, are actually building this. We are investing today in sensor manufacturing capacity in this country, and the idea is to be able to validate remote sensing data across some of the different projects. What that means is, 1, you have the opportunity around the hardware manufacturing, you have the opportunity around the compute that is being put in place, and 3, you have the opportunity around the carbon and the coffee. So this whole climate space can be very catalytic in terms of building out opportunity that you can build around. I'll give you one other example. A lot of the energy projects being run in the West are heavily driven around developing compute capacity. So it's large data centers. Primarily, that's actually what they're doing. It's why in the US you have nuclear plants coming back up, really to facilitate compute. Now, we know that we won't be able to afford to do that in this country, and what we're doing is building a federated edge cloud solution running on excess capacity in the hydro production locations. Now, again, there's the argument around, do we have, we proudly say we have 800 megawatts of excess power in this country. And you ask yourself, is it because we have very low productive use, or we just have so much power? It's a good argument to have. But what we're saying is that we can build edge cloud nodes across the areas with excess capacity, provide sufficient compute, and build smart, I don't call it this sort of smaller AI models that do what we need, because we have to be able to have this capacity. So who are we? We are people who can innovate a new way to do this and benefit from the climate space and develop responsibly.
Okay, I won't pretend to have understood half of that, but I will throw it back to the room if you are, you're in a headspace that is not the right one, save for the hunger. But before I do that, maybe Mark.
The numbers were very clear. Just the numbers. Look at the numbers.
It's the language, the use of it. It kind of throws you off. Anyway, to Mark, I don't know, you really have the expertise in this area. There are probably skills that you would like to onboard into this venture lab. Have you found them? Do you know where they are? Or are you going to have to train a whole new industry, which might delay your ability to execute on some of these deals, regardless of the fact that there is funding?
Yeah, that's a good question. No, we haven't found the skills. We know where they are, though, right? So the way the process works, to register, because registration is really where your project actually starts. But to get to that registration, there's a highly technical requirement for you to be able to figure out, A, what methodology are you going to use? How do we compute sort of the baseline business as usual scenario? How shall we compute the delta from, so before your intervention and after your intervention? So that industry, which is fairly technical, doesn't have that many experts, right? Back in the day when we started doing this, we were working with people from Germany. Now they've come closer. There's people in India, there's people in South Africa, there's some in Kenya. There's a few here who are not trained from here. But the idea of the lab is to sort of project manage a group of experts who can support companies through this process. So this is sort of the feasibility that David's talking about. We can help you do a feasibility study. We can find these experts who are actually registered and certified, similar to CFAs, right? There's people who are actually, they call them DOEs, designated operational entities. These are people who actually are registered and verified to be able to do this science. So depending on what your project is, we can help you figure out, okay, does this make sense? How do I write? There's a document called a PDD. It's very technical. Project design document, how do you write that? The expectation is that for you as a carbon developer is not really to be able to write it. It's highly technical. It's about a 70, 80-page document, and it's full of math. But once that is done, then we'll support you also to figure out how to do the registration. A big part that's sort of on the ownership side of the developer is really around the monitoring and verification, because this is ongoing post your project being registered and you're starting to generate credits on an annual basis. We have to do verification and monitoring to get around the issues of transparency. So there's something to learn internally. So right now, locally, yes, there's a few resources in terms of skills. Many of them at this stage are going to come through potentially consultants. Our hope is that we can work with a whole slew of different industries and build local in-house capacity at different levels so that we're able to do that. A real reason why none of this is happening is A, it can be pricey, 2, we don't know how to do it. So this relationship with STI for us is very innovative because they're saying, you know what, this is an innovation that makes sense. Let us see how we can seed you guys to get it going. If we can, at the end of a 12-month period, demonstrate that we actually have meaningful projects from Uganda that are actually generating credits. They have buyers. The finance piece comes in. Are they at scale? Can they grow? Then we can actually scale it further. So we shall be looking for local partners, but at the same time, many of them are potentially going to come from international, even local consultants who truly have the technical expertise to deliver on this.
I just want to add, in addition to what we're doing with the lab, we are also actively investing in tools to help start the process to identify carbon projects. So we just signed a contract with an entity called EverCity to launch what you call a carbon origination platform. What this will do is if you have, let's say you have an acre of trees and you think that you qualify to build a carbon project, you can get into that platform and design, start the process of building your project document. So you step-by-step gamified process, very simple, and you can generate an initial document. And then what we'll do on the back of that with the lab is probably look at where we need to aggregate projects. So using the blockchain, we could aggregate projects and be able to allow you to be part of a larger project if it's too small in terms of the volume of credits you're issuing. The other thing that we're doing is also actively working with EverCity and the HBAR Foundation to see if we can support what you call social safeguards, because carbon projects must have impact, and you must, one, measure that impact, but also ensure that the recipients of these projects get the money. So again, if you go to some parts of this country, there are big organizations running reforestation projects. They're planting trees on farmers' land. And the argument becomes food security. Are the farmers able to actually plant food if they're planting trees? And unfortunately, the true value that they pay these farmers is very minimal. In most cases, it's actually nothing. In fact, you have politicians today taking pride in saying, I'm giving you trees. So what we're saying is there should be mechanisms to ensure that those farmers or those individuals do receive a return on those projects. So it's something else that we're doing as well to support the entire process and make sure it's more impactful.
Okay, in the scheme of things, it doesn't get any more alternative than this. Maybe at a later opportunity, you can reach out to Mark and David, pick their minds on how this is going to be, made practical. Of course, these are assets that are growing and developing, and we are glad, to support as the CFA Institute in providing the requisite financial expert. but there will be technical areas that you can support the society with and partner with them, just to grow the capacity of people who'd like to grow into a new space. If I were younger, I think this would be a space to take on, but I'll save that for Mark at this point. So I'd like to thank you for listening to us. If there are any questions, I don't know, Moses, I don't know if there are any questions before you allow us.
By show of hands. I think they'll send you an SMS.
Yeah, I guess Mark will be back next year, so
Yeah,
let us
inshallah,
take it
inshallah.
as that. Thank you very much, ladies and gentlemen.
Please give it up for the three wise men. Shortly, we're going to be breaking off into, there's going to be a breakaway panel and a panel that stays here. Okay? If you have been asked to move to the breakaway panel, so pension scheme, CMA, that's happening in the next 5 minutes. Before we get into that, we have another video on global insights into tokenization and digital assets, again, from Olivier Fines at the CFA Institute. Selector. Please direct your attention to the screens. Again, thank you for coming to the third Alternative Investments Conference 2025. And thank you to CFA Society East Africa for congregating us here.
Hello, my name is Olivier Fines. I lead policy research and advocacy at CFA Institute. The development of digital finance over the last 5 years or so has taken the finance industry and the regulatory community by storm. Not to mention as well governments and treasury departments all over the world who are gradually coming to terms with the impact this new fintech industry can mean for financial markets and economic growth. From our perspective at CFA Institute, we call this phenomenon the digital transformation of financial services, which has been a rather chaotic development, a grassroots process rather than a top-down evolution led by incumbent institutions. So the question was, is this a fad or a structural change for the industry and regulators? Digital finance is a complex ecosystem that mixes a number of different concepts, instruments, and processes, from cryptocurrencies and stablecoins to smart contracts, NFTs, non-fungible tokens, and more recently, the rise of tokenization of real economy assets. We started our foray into the field of digital finance first in 2021, and then ramped up this effort along with the rapid deployment of processes based on some form or another of distributed ledger technology, exploring its subcomponents one after another. Those subcomponents have included an analysis of valuation methods for crypto assets, or the design and possible launch of central bank digital currencies. We also explored the critical problem related to custody and safekeeping of client assets, illustrated by the infamous story of FTX in 2023. The most recent and probably most interesting variation of digital finance development has been the concept of tokenization. Tokenization is a derivative of the concept of asset fractionalization using a digital process. Tokenization effectively results in a digital representation of traditional assets using distributed ledger technology. Tokens both define assets and specify what can be done with them. The records of the underlying assets are integrated with the rules and the logic governing the transfer process of the assets. We have just released a 2-part series on the topic. Part 1 is an introduction to the process of tokenization and presents a practice analysis based on a series of case studies presenting a variety of assets and approaches. Part 2 is an analysis of policy and regulatory implications of this development. when considering the world of investment and fund management, tokenization promises inherently to transform what is a linear setup across the value chain of intermediaries to a decentralized operational model using a distributed ledger. The main potential benefits of tokenization we observed concerned efficiency gains in clearing and settlement processes, programmability and automation of tasks related to transparency, risk and compliance, and fractionalization and market access to non-traditional asset classes. However, there are also important limitations to consider. First off, security risks related to fraud and limited investor education. Second, regulatory challenges in relation to a clear lack of international coordination. Third, market structure not fully operational, causing fragmentation and poor liquidity. Fourth, access to private markets and illiquid strategy is not obvious from a fiduciary standpoint. In July 2025, the market for tokenized assets represented around $24 billion in value, half of this for private credit assets, while there were the equivalent of $240 billion in circulation in the form of stable coins. As a comparison, the global value in dollars of all cryptocurrencies has reached over $3 trillion that same month. Part 2 of the research, which we have released in April of 2025, delves more specifically into the legal uncertainty and regulatory challenges caused by digital finance and tokenization processes. In particular, it reviews the fundamental issues and difficulties in assessing and applying personal property rights, cross-border recognition and compliance, right of enforcement, and jurisdictional remit. Answers and solutions to these questions will need to be found either by the industry through standards it could propose or by policymakers themselves. The future of digital finance as a structural shift in how financial services operate depends on it. We intend to play an active role in this process. Thank you very much.
Ladies and gentlemen, thank you. Any questions? There will be competent people to probably answer those questions. Any question? Thank you so much. As mentioned by Rudende, our next session is a split. Just 1 minute, I left. Sorry about that. So the next session we are having is opportunities in digital assets. And it's a continuation from the presentation that has been made by Mr. Olivier from the CFA Institute. That was a recorded session, but it was meant to be a preamble to the next panel discussion, which is on opportunities in digital assets and tokenization. I want to also note that this particular session will happen concurrently with the Capital Formation LP Forum. That will be a side chat. We want to note that this is an invite only. Let me just read the names. Sorry, they just sent me the list. So this is an invite only session, and it will be, we are inviting Capital Markets Authority, all pension funds in the room, Uganda Retirement Benefits Regulatory Authority, NSSF, to walk to, there's a team that will guide you to the next room to concurrently be able to discuss, or you have a meeting about the issues on capital formation and LAP forum. I just wanted to also note that the purpose of this conference, we've been trying to allude while we were advertising, that is we want to be able to produce an investor alliance, or we have real outcome, so that we can have a forum where investors can meet to discuss aspects to do with local or foreign capital mobilization and how we can further our intervention or footprint into infrastructural assets, or how to realize our investments in the alternative investment space. So this particular session was asked for institutional investors. So CMA, Capital Markets Authority, I see you in the room. Uganda Retirement Benefits Regulatory Authority, also our sponsors, one of our key sponsors of the event is in the room. All pension funds, I'm aware there's Makerere University Retirement Benefit Scheme, Parliamentary Pension Scheme, and others, and the CFA Society. Please, we'll have 5 minutes to invite you to a breakout room to be able to discuss that. So while that is happening, the panel that will remain in this room will be moderated by Reginald Tumusime, the President, Blockchain Association of Uganda. Who better to discuss the aspect of digital assets and tokenization other than the President of Blockchain Association of Uganda himself. So at this particular moment, allow me invite Reginald to come and take us through the session. While if I have mentioned your name, please organize yourself. And so we'll have 5 minutes to do the separation, so to speak. Yes. UBRA, Capital Markets Authority, pension funds in the house. You have a breakside discussion. There are topics that have been prepared for you on the other side of the breakout room. Allow us to do this in 5 minutes. Yeah? Okay. Just a minute. Yes, please. Not yet. Let them break out. I'm trying to look for that list. Thank you. I need her though. She sent me a list. I can't remember. I opened it, but I got lost in it. I have it, yes. UBRA, NSSF, Capital Markets Authority, Makerere University Retirement Benefit Scheme, Parliamentary Pension Scheme, Rikindo Capital, in the breakout room. Thank you. NSSF, I can still see you in the room. Yeah. So ladies and gentlemen, the next sessions, whether in the breakout room or here, are expected to be completed within 30 minutes, and then we'll break up for lunch. Thank you. Okay. Okay. Okay, continuing with our program, I believe I'll be moderating for this room. Ladies and gentlemen, may I have your attention, please? Thank you. Yeah. Okay, join me, ladies and gentlemen. Can I have your attention, please? Mark and team, can I have your attention, please? Thank you. Yeah. Alice and team, can I have your attention, please? Thank you. Okay, so let us proceed. Selector, I need you to mute that music now. Thank you so much. So let us proceed with our program. Allow me to invite Reginald, Mr. Reginald Tumusime. He's the president of Blockchain Association of Uganda, and he's going to take us through the next session. We'll be diving or picking up from where Mr. Olivier left in discussing opportunities in digital assets and tokenization. I believe Mr. Rudende will be in this particular room given the key interest he has in the topic of tokenization. But allow me welcome Reginald. You're welcome.
Thank you, everyone. My day job is also to run Capital Survey, which is a bespoke investment bank supporting governments, different governments, and SMEs. So I'll start with a very small preamble of one of the things we're very passionate about at both the association and the farm as well. So according to a recent report that was issued by Bridgewater Associates, which is one of the largest hedge funds in the world, titled The Changing Sub-Saharan Africa Growth Trajectory. In the coming decades, Sub-Saharan Africa will contribute about 25% of the global working age population. And in fact, have more people of working age than China in about 10 years to come. That said, there is need to have a corresponding shift in productivity in Sub-Saharan Africa. For instance, GDP per capita has been relatively flat compared to other high emerging centers such as India. If this demographic explosion can be accompanied by a pickup in productivity that has played a role elsewhere, Sub-Saharan Africa will become the next major engine of growth in the world. And just to put this in perspective, currently Sub-Saharan Africa contributes about 3% of global output and about 5% of global growth. This will obviously increase just based on the demographics. But that said, if we raise our productivity to 3 to 4%, if we raise our productivity growth to 3 to 4%, which is similar to the growth rates we see in India, and we do this for the next 25 years, our share of global output and global growth would grow to 10% and 20% respectively. And for this, we believe at the Blockchain Association that technology will play a very big role. And so our mission at the association is to raise our people's productivity levels by leveraging technology. That said, we still have issues around our private capital markets. And the question we keep asking ourselves is, do we have the right structures that can connect the developed world allocators of capital to on-ground practitioners in Africa? And that's our mission at Capital Survey. We facilitate investments in Africa, and we've done this through our private credit SME growth fund, where we raise money from the global north, and also corporate finance advisory to governments and high growth SMEs. Well, for purposes of today's panel, we'll focus it on the opportunities we see in blockchain as one of the key emerging technologies. And to join me on this panel is a group of very interesting people, as you'll see. You're very lucky, for those of you who've stayed in this room, because what you're about to learn is very life-changing. And so I'll invite Suleiman Murunga to join me. Suleiman is incidentally one of our founding board members at the association, but his day job is to run Moda, a B2B payments company that is innovating in the digital asset space. He does annually almost $400 million in volumes, and is across almost 8 markets in Africa. I once ran a startup with him as well, so we're very close friends. Welcome, Suleiman, and he previously also was the CEO of Pegasus. Secondly, I would like to invite you, Abel. Abel is a fintech entrepreneur and the CEO of a company called Itwe Solutions, and also one of the largest P2P traders in the digital asset space. Welcome. If I read your numbers, Abel, I think we'll invite the Revenue Authority in the room, so I'll just keep that. They're quite threatening. Again, I would like to be joined by my good friend Peter. This is a very incredible, I'm not sure young man, but he is young man, who has really taken Uganda across borders. He's the co-founder of Manjulis Energy, and he's also he's a World Economic Forum top innovator for both humanitarian and resilience initiatives and circular solutions. A lot of the work that he's done is around renewable energy, and you'll see towards the end of the panel, we'll present a very interesting use case on tokenizing carbon credits. And last but not least, my good friend Mo, allow me to call you Mo, so that everyone is inquisitive to know who you are. I invited Mo yesterday and he had to fly in last minute. He's based in Dubai, and he's the CTO of the BSV Blockchain Association. And together with Manjulis Energy, after a successful Kampala Blockchain Summit last year, we connected the two people, and the two entities have been working together on a tokenization solution of carbon credits. Thank you, gentlemen, and now I'll join you. I'll start with you, Peter, so that we break the ice. First of all, who are you? What kind of work have you done previously before you met me to interest you in tokenizing your work? So just share your story in very few minutes, 2 minutes max, and we'll dive into your work with more and get a bit of perspective on the recent feasibility study that you did. So I'll just start with who you are and sort of give the crowd an idea of the kind of work you do, so that we appreciate the role that tokenization plays in the real world. Thank you.
Thank you very much. Thank you, everyone. It's on. All right, it's on now. Okay, great. Awesome. It's usually red where I am, so it's green now. Great. Awesome. So, good afternoon, everyone. Good to be here with you all. I'm Peter Benhanyeko. I'm from Uganda. My background is in aerospace engineering.
Peter, could you move your mic a bit closer?
Yeah,
Nice.
awesome. Can you hear me all now? Hopefully. Great. So, Peter Nyako from Uganda. Background in aerospace engineering. Spent a couple of years working at a boutique investment bank, focusing on climate finance, renewable energy financing. And for the last decade and a half, I've been managing a company called Manjulis Energy, and we've been converting agricultural waste into electricity and generating carbon credits from the biochar that comes out of our waste byproducts, which we utilize in things like fertilizer additives as well as green concrete. We've also worked in the renewable energy credit space linked to solar. And on the alternative investment side, we've been essentially forward selling our carbon credits and our renewable energy credits to enable us to raise the investment we need to build our power plants. So we've been working in Uganda, and we're also investing in other places like Asia, Southern Africa, and Europe. Great to be here. Thank you.
Thank you, Peter. See, I told you. Mo, what's Mo in full? Who are you? What do you do?
Hello, everybody. Great to be here. My name is Mohammed Jaybar, and I'm currently working with the BSV Blockchain Association based in Switzerland. And I have a background in banking and finance, delivering high-level programs to revolutionize technology in the banking sector. I've also been involved in the blockchain industry, starting my own company, ELAS, in developing bespoke blockchain solutions to help transform businesses and improve efficiency. But here I am to talk about what the BSV Blockchain Association has been doing in Uganda. Very excited about all the developments here with the strategic partnership that we signed with the Blockchain Association of Uganda and Manjulis Energy at the back of 2024. And some really great progress has been done working together with the team locally with multiple workshops, seeing how we can use distributed ledger technology to make a difference in the region and to demonstrate this on the global scale. So I'm very happy to be here with you all.
Thank you, Mo. Before we delve into a very interesting use case for both you and Peter, I would like to get a few housekeeping rules. Do we actually know what tokenization means in the first place? Suleiman, what does tokenization mean? Give us a broad view of what it means and examples of different asset classes that can be tokenized. Talk about things around cybersecurity as well. Those are some of the key concerns that we see in the market. And then we'll delve into one of the use cases. Thank you.
Okay, Reggie. Thank you. Good afternoon, everybody. If I'm to give tokenization as an example, or to bring it closer to home, in simple terms, I would say tokenization is just the digital representation of any good or service. So the underlying good can be digital, it can be physical, but it is just the digital representation, because right now we know how to represent various assets using paper. So your land title, your logbook, so on and so forth. But now tokenization means getting that same asset and digitally representing it in a way that can be easily recognized on a global scale.
Interesting. Can we tokenize art?
We can tokenize anything. We can even tokenize votes.
Nice one. Okay, so, and just to give you a little bit of perspective of what tokenization can actually do, allow me come back to you, Peter and Mo. I know that I think a couple of days ago, you released a feasibility study, Mo, that was, on the work that Mangilis is doing, that sort of makes it easy to tokenize carbon credits. Could you give a bit of perspective on that, Peter? Where you are compared to where you were, a year ago. Have you seen any value in tokenizing the carbon credits out of your work? And then Mo can then delve into the technical aspects and sort of bring it back home. And then we'll relate it to other elements such as stablecoins as we progress in the discussion. So over to you, Peter.
Awesome, thank you very much. I'll begin by kind of breaking down what all this is. So if you think of waste, right? So Uganda has about 20 million tons of agricultural waste every year, which can generate 2 gigawatts of electricity, same as all our hydro. But once that electricity is generated, you have waste of that byproduct, which is biochar. It's basically black ash. And that can be used as fertilizer or combined with concrete instead of sand to make it a green concrete. And the carbon dioxide, the smoke coming out of the chimneys, you can actually capture that, chill it, liquefy it, and blend it with that same concrete to make it cure faster. And that whole process, every time you have a ton of product moving from A to B, when you go through the technologies Mo will talk about in a second, it essentially allows your investor who's buying the carbon credits, the renewable energy credits from the amount of solar generation you have done, the amount of removals coming from the amount of biochar you put in the soil or in concrete. If you're able to essentially tokenize that whole process, there is no question that you have actually gotten the work done. So it brings that, great opportunity to essentially securitize it. So what we have been doing is the whole process. Agricultural waste to electricity, biochar to fertilizer, biochar to concrete, solar power alongside it, and capturing all the waste that coming out of it. Essentially what we've done previously is working with buyers who are also financiers and engineers who can understand. So we haven't previously had to go through the tokenization process, but we've sat down and calculated what the future generation figures will be and made our forward sales based upon that. But right now, with the support of BSV, we will actually be tokenizing that whole process. And I think I'll pass it on to you to elaborate further.
Thanks, Peter. And yes, it's been an honor to be involved in this process because there's definitely a transformation underway in rural Uganda. And with this transformation, there is farmers that are transforming their agricultural waste into renewable energy sources, which is sustaining the local community and Mandulis Energy's sustainable development goals. Now, despite the positive environmental impact that is obvious to everybody, one challenge still persists, and that is, how do you prove, how do you verify, and how do you monetize these carbon emission removal and sequestration activities in a way that enables trust into international markets? So, as I mentioned, we got together and have a strategic relationship with the Blockchain Association and Mandulis of Uganda and Mandulis Energy, and that got underway this year. We kicked that off with the BSV Blockchain Association, working very closely with the Mandulis Energy team on the ground. We ran multiple discovery workshops. We really wanted to get into understanding the current challenges on the ground before we just dived in and developed a solution. So what we did was we really got to understand the people that are involved in the process, so like the field operators who are collecting data, the farmers that are involved in providing this agricultural waste. We learned about the systems that are being used, so the data collection tools which are being done by the field operators. And then we were also learning about the hardware that's implemented, so the IoT sensors, the smart meters. And it was about getting this information and understanding that, hey, there's a lot of good things that are happening in this proven circular model. There's a lot of data points, but then we go into where the limitations are, and that is that it is quite manual. So we have the data points, but the restriction and the friction and the limitations come from where it is manual. And this is totally what the entire carbon credit industry is actually facing at the moment. It's a lack of trust, being able to verify the provenance and chain of custody of what has occurred. So we have come up with a solution that does not disrupt the operations that are occurring on the ground, because they are quite good. And the data points that are coming on the back of that from the field operators and the IoT sensors and the smart meters is very useful. So what we want to do is we want to automate this so that it is generated in real time, and each individual person and each hardware device becomes a verified digital identity. And that verified digital identity means that every single time an action has been recorded, it is coming from a trusted source, not an anonymous source. So then that becomes the asset, and that asset then generates all of the activities that are undergoing can be enriched in tokenization of a carbon credit. And the entire chain of custody from the very beginning right until the very end can be demonstrably verified. It's immutable, it's recorded, and that is what's going to open up new revenue models to come back and bring back into Uganda, and the ability to add smart contracts for distribution of how that gets spent depending on how the data was accumulated opens up a plethora of possibilities.
Thank you. Very interesting stuff. So in other words, there's been a lot of losses and lack of trust in the international market as well, that tokenization for Mandulis Energy will help improve. Let's bring the discussion a lot more closer to the world of finance. We all know that one of the mandates of the Africa Continental Free Trade Area is to reduce the bottlenecks, concerning trade, cross-border trade, amongst countries in Africa. And we have over 42 currencies in Africa. Abel, do stablecoins play a role in sort of reducing the bottlenecks we see for cross-border trade? And in the first case, what are stablecoins do stablecoins qualify to be called tokenized money? Do we have an opportunity in Africa? What's the adoption like? A bunch of questions in one, but sort of get us up to speed with the opportunities we see in the stablecoin adoption in Africa. Thank you.
Thank you so much. Very honored to be here. Maybe I was listening to these guys and they were talking about tokenization, and I think to bring it home, if you remember electricity, yeah? They used to put at your gate an electricity bill. And these days it's all about paying on mobile money, then you type in the number that they give you, and then electricity is there. So in that sense, that has been tokenized, yeah? Another thing that has been tokenized is money. So most people don't know, maybe just the definition that the telecos gave, but ideally what happened is we would transact with money, we still do, but the process of getting it into mobile money became tokenizing money. It's just that money was tokenized on a database. On our side of stablecoins, money was tokenized on a blockchain. I hope I'm getting all of you. So with time, obviously, we shall see water being tokenized, the basic things in life that we use being tokenized. So I figured I would just clarify with practical examples. So what are stable coins? So stable coins, just think about money, yeah? Imagine if mobile money, let me use that, was working on the internet. So mobile money works on USSD, yeah? It works on their network. But the day that they plug it into the internet and it can be transferred globally, by globally even beyond Africa, I know it can be transferred in East Africa and some countries outside of East Africa, that would definitely, it could be termed as a stable coin. So it's money on your phone. I mean, we see mobile money messages and we know that it's money. How do we redeem, or let's say, how do we withdraw our mobile money? We go to a mobile money agent. So my background has been in running a cryptocurrency exchange, yeah? So think of it as a Forex bureau, for that matter. You have stable coins and you want cash. So you give us the coins, you transfer them. Same way you transfer mobile money, you require a phone number. For us, we call it a wallet address, yeah? Somebody gives you the wallet address, equivalent of a phone number, equivalent of an account number. You send the stable coins. In this case, there are plenty of stable coins, but let's use a stable coin called USDT. I'll explain further. Transfer it, we give you money. Then we keep the stable coins until somebody else comes and wants to buy the stable coin from us. So, Forex bureau style, yeah? I hope I'm with you. So stable coins are basically money. But the beauty about them is that they are backed up. And what are they backed up with? A stable coin called USDT. Let's say another stable coin called USDC. As you can see, their name is USD. Yeah? So they're backed up by the dollar. So let's say one token or one digital figure of USDT is backed up by $1. I hope you're with me on that. So that's what makes them a beauty. So in the African market, stable coins basically, they ease FX, access to the dollar. I think the African market struggles with that. Some people may not. I think in Uganda we are privileged to have so many Forex bureaus and things like that, but go to a country like, going to Lagos, accessing dollars, even moving a big amount of dollars out of their country is quite difficult. So in countries such as those, even us partly, that's where people, instead of buying the dollar, it's the cash itself of the dollar, you rather buy a digital representation of a dollar, which can be accepted globally. So it basically eases transacting with the dollar. I think I can stop there.
Yeah, good question. What's the penetration like in Africa? So let's assume we talked about USDT, Tether, or USDC. And for context, USDT and USDC are the most popular dollar-backed stablecoins in and we've seen a lot of adoption in Africa. What's that number like, Abel, in terms of penetration?
Good question. So I'll use my friend Sule. Sule's numbers. I mean, when he was coming on stage, they said, I think you've processed $500 million.
You already people left, right?
Yeah. So the penetration. So first of all, most people think this market is very small, but the numbers will say different, as you can see. I mean, 500 million is not easy. We, according to the KPMG and Chainalysis report of, I think, 2023-2024, Uganda was ranked as the 126th in a stablecoin movement of volume, and towards 2023.
That's globally.
Yes, that is globally. Sorry, it's in Africa. It was ranked as the 126th. Yeah. So towards 2024, we became the 35th in the volume that we are moving. So there is a significant. I mean, it's a big leap. Yeah. So, and the volumes look like, at least, so the data is also not present, but from where I see it, I am imagining its daily movement could be between $500,000 to maybe 3 million, yeah, in the Ugandan market.
Is that on a daily basis?
That is on a daily basis. That is how much. That's why we're able to get to values like 500 million. So there is definitely adoption, and the adoption is coming from the point of imports. So Uganda's import value is around what, 10 billion, and if you're buying goods in China, I don't know whether we have business people in the house, but if you're buying goods in China, Dubai, and the likes, you definitely need the dollar to transact. And but then when you go to the bank, you will notice that banks charge between a very good bank, yeah. Let's say Absa charges 0.3% for dollar deposits. Yeah, that's quite high for your normal Chukubo person who wants to just buy things in China. So besides that, when you hit the money in the bank, it will take probably 1 to 3 days to reflect on the China side. And most people in China take WeChat, Alipay, things like that. So what happens these days is people, remember, access to dollars. People buy the digital dollar, they sell it for RMB, the Chinese yen, and then they're able to buy, to pay their suppliers in China with their local currency. So I don't know whether you're getting the flow of funds, but that's practically how it looks like. So on that 10 billion that is in our import value, we obviously just cover, from where I sit, my opinion, this is not data collected by big firms. I do think we are covering like 5% of that 10 billion. Thank you.
I know recently a report came out, and Yellow Card, one of the largest African operators in the digital exchange space, put the number at 9% adoption for stablecoins in Africa. And that number is among the highest globally, so things are interesting. Suleiman, I know we've been at the association level engaging with regulators. I was happy to hear that yesterday the Financial Sector Stability Forum sat in one of their inaugural meetings to forge a path forward to regulation of digital assets in Uganda. And one of the things I keep hearing is about the Pan-African Payment and Settlement System, PAPS. Is that enough? Is it primed to make stablecoins of less importance in the African context? And I know you've done a lot of work engaging with Afrexim Bank, which is one of the key sponsors of PAPS. What's your opinion on PAPS?
I think the stablecoin discussion is a completely different dimension altogether. And the Pan-African Payment System recently launched a currency marketplace because one of the challenges they were facing was, okay, the African continent has been using SWIFT as a payment method to move money between African countries. I'm sending money between Kampala and Nairobi. We share the same border, but money first goes to New York. It leaves Uganda, goes to New York, then comes to Nairobi. So it would have been easier for me to just put that money in my pocket, get on a flight, and cross the border. So they said, let's transact with African currencies directly. I send a payment from Uganda to Kenya, and we cut out the dollar. So PAPS was implemented. However, when they started implementing the system, they started getting implementational challenges. Okay, if Suleiman in Uganda is sending money to Kenya, he has Uganda shillings. When the payment goes to Kenya, what currency goes? Is it Uganda shillings that goes to Kenya? Or does he first change Uganda shillings to Kenya shillings? If he's first changing that in Uganda, who is doing the FX? Is it the bank in Uganda or the bank in Kenya? Who is taking the currency risk? So these challenges came to the front, and we started asking ourselves, how do we solve this? And the currency marketplace was formed, whereby we said, let's bridge currencies and create a marketplace where African currencies can trade directly on a centralized exchange. But when we implemented that and put it into the market, we got another challenge. Okay, within regional blocks, East Africa, Kenya, Uganda, Tanzania, there is liquidity. There's a lot of cross-border trade. Their borders are being shared. But when you move out of a regional block, now someone in Kenya paying someone in Nigeria, some Nigerians have never seen a Kenya shilling in their life. They have grandchildren. They have never seen a Kenya shilling or a Uganda shilling. So how do we convince those Nigerians to accept Kenya shillings and vice versa? No one wants to hold the others. Everyone's asking for dollars. So that then presented the challenge to creating that unified block on African currencies. Now, in order to solve that, that's now where the stablecoin conversation came in, right? Because in each and every market, like Abel has mentioned, there are deep dollar, which are now being replaced by stablecoin liquidity, which means that between the Uganda shilling and US dollar, the market is deep, there's deep liquidity. Between Naira and dollar, the market is deep, there's deep liquidity. But Naira, Uganda shilling, there's no liquidity. We're not trading, so there's no liquidity between those two currencies. Now, to use SWIFT as a bridge still goes back to the old conversation. But if you bring in a stable coin, like one of the ones Abel mentioned, USDT, USDC, whereby you have a market, Uganda shillings, USDT, Naira, USDT, then you can pair those two markets, use the stablecoin liquidity to create a bridge between all the different African currencies and have instant liquidity. And because stablecoins move at the speed of internet, stablecoins are doing to money what WhatsApp did to messaging, whereby sending a WhatsApp, there's no difference between me sending you in the room a WhatsApp and me sending someone in China a WhatsApp, whereas there would be a difference if I was sending an SMS. The cost is different. So stablecoins move at the speed of the internet, and so that now creates instant liquidity on a global scale. So the stablecoin conversation, whereas PAPS is a payment system, just like SWIFT, but stablecoins are internet native programmable assets.
Nice. Very interesting stuff, isn't it? To the next topic, which is very interesting, which is usually avoided, cryptocurrencies. I recall close to 7 years ago, actually more than 7, about 9 years ago, I took leverage. I used to work in a bank, my former employer, Standard Chartered, and I took leverage to buy 3 Bitcoin at the time. And I looked like the fool in the room. And I think at the time, each was about $2,000. Today, each Bitcoin is $118,000, the last I checked a few seconds ago. We all know that the Trump administration has, in a way, legalized Bitcoin and at least the top cryptocurrencies, to the extent that they're thinking of having a Bitcoin reserve already actually happening. At the farm in Capital Survey, where I work, we have a rule. All our excess liquidity every year is allocated to Bitcoin and other key cryptocurrencies. and the CFO is in the room, he can attest to it. We've been in cases where it's bailed us out from our working capital cash flow issues. So these are things that are real and are happening. And I just wanted to ask you, Suleiman and Abo, before we jump back to the other side of practical things that a few people would understand better, is I'll start with you again, back to you, Suleiman. What's your view on cryptocurrencies? I know that there are real issues, cybersecurity, KYC issues, fraud, and these are real issues we're dealing with at the association level, working with the Bank of Uganda and the rest. What are your views on cryptocurrencies? Is it wise to invest in these things? What do you see in your exchange, in your OTC exchange? Thank you.
The first thing I say when people talk about fraud in crypto, I say there is no fraud where there is no money. If you hear there is fraud somewhere, just know there is money there. There is no industry that has more fraud in Uganda than land. But I never hear that conversation, oh, don't invest in land because people are scamming each other every day, they are buffering, never. But for some reason, crypto, everyone's talking about fraud. But it's because there is money. Billionaires are being minted every day in this industry. And that is because it's a new asset class. I remember just before COVID, I was on the flight to Nairobi and I met Kenneth. Unfortunately, he's left the room, but I met him and I didn't know he was he was in that department in NSSF. So the person who introduced us told me, I said, let me pitch here. So those days I was still trying to get people to get into crypto. So I talked to him the whole flight, 1 hour, reached luggage, getting our bags, even going to the Uber. I was still there pitching, Kenneth, you need to buy crypto for us. You need to buy it, put in 1%. I think by that time, Bitcoin was about $12,000 per coin. And I told him, just put 1% of NSSF money. And rightfully so, he made a very sound decision not to, because that time the market was still too small. But since then, we have seen a 10x growth. That means if he had put in 1%, he would be talking about $7.7 billion, not $7 billion. So that means we lost out. But today, the market is completely different. BlackRock is in. Vanguard is in. Most US top pension funds and European pension funds are in. Regulation has been passed in most markets. So the market has matured. This is the asset class of the future. For me, I like to look at things from a long-term perspective, not micro, but macro, obviously looking at the micro to some extent. And the fact is that there's a generational shift happening, whereby perceptions of security and assets is changing. Wealth is going to transfer from Generation X to millennials and to the Gen Zs and so on and so forth. Millennials are the last generation that perceive safety and security in traditional assets, such as gold, precious metals, land, etc. But these Gen Zs, for example, in Kenya, on the streets every day chasing someone, I will not mention his name, but they're on Twitter every day, they're on Instagram every day. For them, they know digital things. So when they make money, it's only going to be natural for them to invest in digital things. And so you'll start seeing a lot of value being accrued in digital assets, whereas for us, the millennials and the old generations, for us, we did land and gold and all that kind of stuff. So that is my take on where the industry is.
Okay, thank you for that. So I actually encourage each of us to think about these things. These are real things. And obviously, one of the key risks is volatility. And that's where a lot of these funds, you'll never get NSSF, at least not now, investing in digital assets because of the volatility, the underlying volatility. But obviously, as the market matures, you have a lot more funds flowing in. He talked about the BlackRocks and Bitcoin ETFs and Ethereum ETFs. So I think a lot more liquidity flowing into any new asset class, the professionals would know, would sort of bring price stability over time. So you still have an opportunity to make some alpha and hedge against even political risk. I actually expected that to be one of the advantages. Today, if you own Bitcoin on your wallet and anything happen here,
get the next flight, and wherever you land, provided they have liquidity, you set up a new life. Those are things to think about. But back to you, Peter. I know Mo mentioned something very interesting about the lack of trust in the carbon credit industry. And that was a bit confusing, at least for me. What does that actually mean?
I mean, it's there are different kinds of carbon credits. You know, you've got renewable energy credits that are linked to the generation of electricity from solar power. That's pretty straightforward because you know from your meter how many kilowatt hours, megawatt hours you actually generated. However, when you go to deploying biochar fertilizers into the soil, it's difficult to know how much biochar you put into that soil. When you look at planting of trees, it's difficult to know how many trees were planted and where they were planted. And so you find that what happens nowadays is, you know, consultants come with a clipboard, they'll take a few photos, interview people, and collect that data in person. What that does is, even despite that, you have a lot of people, many of you in the room probably respect, who are already, you know, investing. You got JP Morgan, Swiss Re, Zurich Re, Microsoft, Google, etc., putting in billions towards carbon credits already, even with the lack of trust. But now when you go ahead and use satellite mapping, you use drones to map exactly what's going on. You take photographs in infrared, in ultraviolet. You basically figure out exactly what's going on the ground. You can basically add that trust. And if you get that data every single second, pretty much, the amount of data is so huge that you have to use other technologies to basically, you know, track it and verify it. And that's where distributed ledger technologies like blockchain become very, very interesting, to give that trust so that the market can only grow even bigger. And when I think of the opportunity for Uganda, for example, just from the existing agricultural waste volumes, Uganda is, I think, third in the world for bananas right now, about 11 million tons of bananas grown every year, 80% of which is waste. Total agricultural waste in Uganda, which is easily gathered, over 20 million tons. And if you look at what that can generate, you know, another 2 gigawatts of electricity. That's, you know, about $500 million worth of renewable energy credits every year. If you look at the waste that comes out of that, the biochar going into concrete or into the soil, with the use of such technologies and verifying that, you can get a much higher price. So without, you know, using clipboards, we sell it maybe $150 a ton, but the prices will go right up to about $700 a ton when they're high quality credits. And even at just half of that, you're already going at over $6.5 billion a year potential from Uganda's agricultural waste after electricity generation into biochar. So when you look at such numbers, imagine just renewable energy credits and biochar credits in Uganda alone giving you an NSSF worth of new capital every single year. That's what we're talking about here, and no one in the nation apart from you all understand, you know, volumes of money at that kind of level. And considering that bankers in investment banks around the world are already investing in that, when that trust comes in, it becomes very interesting.
Because you mentioned something very interesting, Peter. Are you saying just from banana waste, we're losing $500 million worth of carbon credits?
5 billion.
$5 billion?
Yes.
In the context of Uganda?
Yes, yes.
Those are mind-boggling numbers. Are you sure?
Absolutely, I just did the maths.
And so, because I recall the opening remarks by the representative of the PSST from the Ministry of Finance. These are numbers that could easily take us into very high income levels as a country. So the work that we did with Peter, we saw these numbers, and I think then it wasn't this higher number, probably half of that, and we said, why don't we partner and tokenize the work that he's doing and sort of scale it? And so are you then saying that the opportunity to tokenize your carbon credits, or anyone who is in this industry, then makes it easy for the off-takers to sort of trust the numbers because of the fact that it's publicly available data, very mutable? Is that what you're saying?
Absolutely, because when there is no question what has been generated, when that trust doesn't rely on anyone's mistakes, as you get with what you all are working on now in the blockchain space. It means you get what are called high quality credits, high quality renewable energy credits, high quality carbon verified credits, high quality carbon removal credits. And the higher the quality, the less it relies on mistakes, the higher the value.
Because imagine a world, Peter, Suleiman, and everyone else, Abel, where we could create some sort of tokenized marketplace. So I buy my USDT or USDC, buy my carbon credits from Peter in the primary market or over the counter, and trade those internationally. And so this is the kind of world where we're headed. And like Suleiman said, those who hold capital today will have to hand it over to the millennials and the generations below. Where do you see them allocate this kind of money? And so these are real opportunities, and the reason I'm very passionate about the work we've been able to do with you is it takes the discussion away from stable coins, digital currencies, cryptocurrencies, and it really brings it back home to things people can easily relate with. Suleiman, I need you to explain what smart contracts are. The reason is we have a number of fund managers in the room or practitioners in the investment management space. And I know that there are 5 levels that they go through: client acquisition, the actual investment management, control frameworks, the operations themselves, and client servicing. And I see a use case around the investment management space as a practitioner myself, because we could be able to then create smart contracts to manage, portfolio rebalancing, for instance, and any other corporate actions such as taking dividends. But before I get into all that stuff, what are smart contracts? In a very layman's language, what do smart contracts mean?
So a smart contract is simply the digitization of a set of rules. So for example, if we're having a transaction where I'm the broker and I've brought together a buyer and a seller, right? Traditionally, we'll have a paper contract which will set out the terms. This is the value of the property, my commission is 10%, and my commission is to be paid as soon as you've been paid, or 7 days after you've been paid, etc. So what a smart contract does is that it gets those conditions, those rules, and it puts it in a piece of software, right? That is on the blockchain. And so what that enables all parties to know is that if I'm to interact with this smart contract, right, which is on the blockchain, then I will be bound to these rules. And so I don't need to trust the counterparty or anyone else. I just need to trust the blockchain. I just need to trust the software. And that then brings in a new dynamic. It opens us up to the ability to trade globally without needing to carry out lengthy due diligence and verifications, because I don't need to trust the systems in those countries. I'm just trusting this smart contract. So if this smart contract is representing a specific type of yield in a specific type of market, then I know if I put my money using digital assets into this contract, then it can't get stolen and the rules can't be changed because it's on the blockchain. And this then opens up the ability for international capital to flow anywhere at any time based on specific rules that everyone can easily verify and understand.
Very interesting. I actually have an idea. We should talk to the Social Security Fund and have the investment process automated using smart contracts. And one of the other things we could also do is, for those of age, we could also have the smart contracts sort of say, look, your age X, your benefits are due. It sort of creates an easy way to do these things and these decisions internally. And obviously, I see a correlation between emerging technologies across board, because smart contracts could easily also have a parallel in the world of AI and all these, but I don't want to get into the discussion of AI, otherwise we'll leave quite late. But Abel, I would like you to touch on the difference between permissionless and permissioned blockchains. And the reason this is important is it provides an opportunity for large corporate institutions who would like to try testing such distributed ledger technologies to begin to innovate in a very safe environment, hence the whole permissioned discussion.
Thank you. So we are moving into an age where countries are considering a central bank digital currency. So I actually wrote a paper about Uganda's central bank report, which is on my LinkedIn, going to BOU, on the consultancy paper that they put out, I think, late last year. But so financial systems have, okay, at least in the blockchain world, have permissionless and with permission. And I would say currently what that looks like, okay, at least in the traditional sense of finance, is mobile money. Mobile money is very, like, they're the ones who pull the plug. They're the ones who can reverse the money. And they have control of their system, which is still a database, yeah? And same thing as banks. Banks have the ability to reverse transactions and things like that. And I do think that's where governments, that's the approach I think governments can take to, in the event that they're actually building a digital currency, because I mean they're looking at customer protection, preventing fraud. So definitely that is an avenue. They would have to build software, they would have to build a blockchain, they would have to build to make sure money transfers are secure. Then permissionless looks like decentralized. So in our world, we have something called wallets. Yeah, I think you've heard my colleagues saying wallets. So wallets are basically like your bank app. It just stores the money. The way you have a mobile money wallet, similar, same things. Just this one works on the internet, period. And the permissionless looks like there's something called the decentralized wallet, and basically you control, they call it private keys. You control your passwords yourself, and rather than a company in the background controlling your passwords. So here your money is really your money, just like the way when you have money in your pocket, it's actually your money. When you have money in the bank, yes, it's your money, but the bank is controlling it. The bank can freeze it and things like that. So I think that's the best way I can put it.
And I thank you, Abel. And just to buttress on what you said, I'd like to compare a permissionless environment or blockchain to the internet, and I compare the permissioned ecosystem to the intranet. Long before internet became very popular, big corporates like IBM at the time were creating their own little internets within a controlled environment. So your intranet, so to speak, is like your permissioned ecosystem, and now your internet is permissionless to a certain extent. So the narrative around central banks creating their own digital currencies, for me, is a form of intranet. Let's test this thing in a controlled environment, but eventually, just like the internet, I think it gets out of hand into a permissionless ecosystem. So we'll need to wind up, and to wind up more, I would like to get your opinion outside carbon credits. What other work has the BSV blockchain as a platform supported to sort of tokenize? And then we'll have just one 30-second piece from each of you guys, and then we'll close. Over to you, Mo.
Well, I think the most relevant thing to mention, coming from the technical lens of what blockchain is if there's only one thing to take away from what blockchain is, it's the first line of the Bitcoin white paper, which was released in 2009, and that is, it is a peer-to-peer electronic cash system that is set out to solve the double spend problem. So in terms of trust, it means that Now we can have two peers that don't know each other, that are able to interact with each other without needing to know who they are, without needing to have an intermediary or an arbiter in the middle of that, which obviously adds another layer of trust and costs and processing time. So you remove the intermediaries, and then you can trust that when you're receiving the Bitcoin token, that you can be confident that it hasn't been used elsewhere. And that is actually the key thing that it differentiates the carbon credit solution that Mandula's Energy will be implementing on blockchain, is the same characteristics. Because if you look at the carbon credits that exist on the market today, they are essentially just certificates and backed by database entries, and probably needs one or more than one party to verify and provide backing that yes, it has not been used or double spent, and you know, which is obviously like the greenwashing and adds a layer of fraud to that whole process. So all it is essentially is leveraging the most revolutionary aspect of blockchain technology, which is two peers interacting with each other and having confidence that there's no double spending occurring. So that is where the real value is going to come from these carbon credits being tokenized on the blockchain on a single global ledger that everybody can see and verify. So there's no two sets of ledgers, two sets of books, and there's no need for a middleman. And then once they are, you know, not in that token, it has the entire provenance, and then once it's sold, then the record of that state is marked as sold, and it cannot be unsold. So that's the real revolutionary of blockchain. In terms of use cases, anything you know, that can be applied that needs to remove trust and allow two peers to interact with each other, that is where blockchain really shines. And there's a lot of you know, with the work that the BSV blockchain is looking to do in Uganda with the Blockchain Association of Uganda. We are definitely keen to explore more opportunities and work with local businesses and investment firms in furthering this technology. As the BSV blockchain is a not-for-profit open, and our objective is to see blockchain technology being adopted and used. And definitely in the proper application of it, it will definitely bring an advancement and revolution towards the businesses and the opportunities that occur in Uganda.
Okay, thank you. Final remarks, Peter, 30 seconds.
Thank you very much. So I invite you all to, if you're ever on holiday to Murchison Falls, pop by and see our living lab where we have tested a lot of these things at a small scale, which we're excited to share and see grow. Things like negative priced infrastructure made from concrete. Things like negative price clean cooking, people earning when they cook with technologies. Things like negative price organic fertilizer for farmers, where farmers are paid to use climate smart you know, additives. Things like zero priced electricity for households. And things like, you know, zero cost interest for the distribution of electric vehicles. And more crucially above all that, our ability to secure what essentially replaces equity investment through the forward sales of carbon credits. We've tried this out, you know, in multiple places, you know, including supplying zero price electricity to public institutions like hospitals and schools. With blockchain and the ability to kind of scale that up, there's definitely a case study for you all to look at and see how you can get your expertise from the CFA and plug into the opportunities available out there and see where it can take the market. Thank you.
Thank you, Peter. Over to you, Sule. Final remarks, 30 seconds.
Well, what I can say is, for the members in the room, the cryptocurrency and digital asset space and market is open to everyone in the world. It has now grown to $3.7 trillion, and it is accessible on a global scale. There's a company called pump.fun. You should write that down and just look at it after. Pump.fun over the weekend raised $500 million in 12 minutes. 12 minutes. Went to the market to raise money within 12 minutes. There are some people who saw it, said, let me go brush my teeth, I'll come back and buy. By the time they came back, done. The allocation was finished. Which means that the dynamic has completely changed now. If you have something to sell that is of value, you can put it online and people will see it and capital will move at a click of a button. So there was a panel that was on before, someone was saying, we're in Ugandan market, capital markets is suffering and this, that, the other, there's not enough capital, the liquidity is low, etc. Africa leapfrogged the landline, went straight to mobile. I want you to also think about it the same way. We might also leapfrog this whole thing of capital markets locally. And if you can tokenize something in Uganda that has good returns and the fundamentals are safe and sorted and secure, you put it online within minutes. The kind of capital we're raising here locally is very tiny compared to what is in that overall industry. So this will then maybe spur a new spark in the overall capital markets industry.
Thank you.
Thank you.
Thank you, Sule. Abel?
All right, so maybe you're seated there wondering, Ponzi, bubble, things along that line. So for statistics, so Visa processes around $14 trillion of transactions annually, and crypto, in particular USDT, processes 26 trillion annually. So getting all those people to leave the coin, the currency, and to move to any other alternative method, it's quite difficult. So I think, like my colleague has said, crypto is an open space. Maybe I wanted to go back to the term volatility. I think volatility for me is it can be a good thing in a regulated environment. It's just funny how capital markets left the room, but one of the reasons probably most of us don't have shares in Stanbic and the likes, which are the public listed companies, is it's not volatile. Personally, I have shares, but every year somebody has to call me and be like, man, first go for the AGM and you get that package they give you. I'm not thinking about volatile. The price has gone up, I've gained profit, even the dividends are small, but if there was volatility, we'd see traction from betting businesses to the capital markets, So and there we're helping the economy rather than money being blown in. You're waiting for Arsenal and Man U to, who's going to lose. So, I think, thank you.
Thank you. To close, I think from the Blockchain Association, for us it's really impact. It's a non-profit. And to speak of a use case, one of our members raised, I think, about $60,000 in a few days for his non-profit work. He takes care of refugees somewhere in the eastern part of this country. And through his work, he was able to decentralize his fundraising process. He put his initiative out on X, created a public ledger, public accountability for the money and what it was to do. And in minutes and days, he raised over $60,000 in Bitcoin for people who are passionate about the kind of work he does. And that's the stuff we love to hear. So anyone interested in learning more about these kinds of things, and as an association, we're happy to help. But more on the private side of things to close, one of the things we're looking at the farm at Capital Savvy is we're working with a group of tech people to tokenize gold. Gold is one of our key commodities in Uganda. We export, it's one of our largest, if not the largest export commodity in this country. And we are a gateway from Congo and other neighboring countries for this kind of trade. So imagine a world where we could tokenize gold and put it out there in a market and raise significant amounts of money into this country. What would that do for us? And also, let's get into the habit of learning as much as we can as young people. I spoke of productivity at a macro level. I think if Africa is to leapfrog, like Suleiman said, one of the things we need to deal with is access to information, knowledge, so that this tide, we're in a very new season, these opportunities are very cyclical. They typically take 50 to 75 years to show up. We're in a very new world order. pie is shifting to the east. Eventually, sub-Saharan Africa will be the last frontier of growth. So to the extent that we leverage access to internet and knowledge and information to learn as much as we can, to take risk, I think it will be very good for us as a country and as a continent. Otherwise, thank you so much, my fellow panelists, and for the audience for being very, very patient with us. Happy to be here, and we look forward to networking later. Thank you.
Please keep your applause going for the panel that was ably steered by Reginald Tumusime, President of the Blockchain Association of Uganda. Okay, we're going to break for lunch now. I'm assuming that everybody received a lunch coupon. Did we all receive a coupon? Right. Our lunch will be by 7 Seas Restaurant. So we'll expect you back in the room at 3:05. Again, thank you for coming. Okay, we're breaking for lunch, guys. Don't everybody move at once. Thank you. There are many, but we shall get through them. Bank of Uganda, Capital Markets Authority, Blockchain Association of Uganda, of course, Deposit Protection Fund of Uganda, UAP, Trade Development Bank, Esatel, Genafric, Stanbic Bank, SBG Securities, Carbon Access, Shona Capital, Ministry of Finance, Planning and Economic Development Uganda, Matt Abacus, Absa Bank, ACCA, Cornerstone Asset Managers, Uganda Retirement Benefits Registration Agency, the National Social Security Fund, Country Wealth Advisors, Capital Savvy, and Autos Africa. We're moving on. Our next panel is an interesting one because we are looking at why alternatives matter. Yes, we've come to the Alternative Investments Conference 2025, but why do alternatives matter? And who better to tell us than the fund managers themselves? Please put your hands together because now she's wearing many hats today. Not as my co-MC, but as the moderator of this panel, please welcome once again the portfolio manager at the Deposit Protection Fund of Uganda, Lisa Oyela. If you're happy and you know, clap your hands. Thank you.
Ladies and gentlemen, good afternoon. I hope you had a great lunch and a great break and also took the opportunity to network. Could I have your attention, please? Thank you. Throughout the conference, we've been hearing a lot about the tenfold growth vision and how we can no longer afford to ignore the contribution of the alternative universe in achieving this tenfold growth. The PSST, or representing the PSST Ministry of Finance, he mentioned that in this vision it's anticipated that 60% will be funded by government, but the remaining percentage, it's expected that the private markets, for example, will continue to contribute to that space. Ken also mentioned the contribution of NSSF to GDP, but I just wanted us to take a holistic picture. Institutional investors, and these are pension funds, insurance companies. I think it's estimated that institutional investors contribute to, I think, over 17% of GDP. So we cannot afford to ignore the contribution of institutional investors to our growth or capital market development. And yet, only 1% of this capital is allocated to alternatives investment. So like Moses has said, the next session we want to focus on why alternatives investments matter, a fund manager's perspective, but most importantly, we are viewing this from an institutional investor perspective. Why are we having only 1% of capital being allocated to the alternative space, for example? So join me in welcoming the distinguished panelists who will be sharing their thoughts on this topic. And to introduce them, I want to start by our first panelist in this session will be Mr. Ibrahim Buya. Ibra is the Senior Portfolio Manager at NSSF. NSSF is, he manages, or is part of the team that is managing 26 trillion of assets under management. I think there is no discussion of allocation of capital without NSSF in the room. So we would like to hear his insights into these statistics, but also into the matter. So Ibrahim, you're most welcome. You can please take your seat. Ladies, the tagline is, clap like we mean it. That is Mr. Buya. Our next panelist for this session comes from Gen Africa. He's the country head, Gen Africa Asset Managers, responsible for over 1.5 trillion assets under management. Please, ladies and gentlemen, join me in welcoming Mr. George Mulindwa. Thank you. And our third, this is going to be a heavy panel, but we'll try and keep it brief. There are a group of people who don't like to talk a lot. I'll invite Miss Linda Nsarwe. She's a Senior Investment Officer responsible for trade financing at Trade Development Bank. Linda, you're most welcome to join our panel. And ladies and gentlemen, last but not least, allow me invite Godfrey from Old Mutual. Godfrey is a portfolio manager responsible for over 4 trillion of assets under management. Godfrey, you are most welcome, and you're our final person to join the panel. Where is Godfrey? Yes. Thank you. Ladies and gentlemen, I hope I'm audible. We want to begin with the basics. So I mentioned that with all the key contributions that we have from institutional investors, or we expect from institutional investors, because they are a big driver in our market, we're only seeing a very small contribution or percentage of capital allocation to the alternative space. Allow me to pose to the panel. Why should institutional investors be paying attention to alternative investments today? I know there's a lot that have been spoken about, and then why should we be focused into this space? Why should we be concentrating or looking into this universe? And I would like to ask Ibrahim, the man who controls the biggest share, to give us his insights.
Thank you so much, Lisa. Good afternoon, everyone. Alternatives, I think they've been explained all day. They are quite an asset class that everyone sort of relates with every day. But the question then she poses is why is that there isn't too much money going there. But I guess there already is a lot of money there. The alternatives are easy in a sense that it's what you see every day. And as you're investing money in alternatives, it appears that you're solving problems that people relate with every day. If you look at our country, say Uganda or East Africa as a region, or the whole of Africa, and the needs that are explained every day to any fund manager trying to support the growth of the economies, to support, create employment, sort of motivate our fate and make it better as a country, as a continent, it motivates investments in alternatives. So the theories are there that come from the developed world, the benefits in terms of the promise of returns, the promise of some sort of stable cash flow, the promise of inflation hedges and all that kind of stuff. Albeit, if you look at the performance within the region, it doesn't seem to be very attractive. For some of you who are either involved with private equity or real estate or some sort of alternative asset, anything that you see involving a lot of lawyers, a longer conversation, yeah? Or that brings a bit of engagement in the boardroom, you call it an alternative asset in a sense. You just dump everything in that family. So the promise is there, and the benefits visible are also there when they are done, but the risks also seem to be quite high. So as a result, I think the traction is yet to come in a country where there are easier options, yeah? As I speak now, or a few minutes ago, TB results have come out, and they are very attractive. They are not so much hard work. So that sense in terms of attractiveness, if you compare the risk and return, has made them a bit of a hard story. At NSSF, we are actually one of the largest investors in this asset class in the form of real estate. But I mean, I don't know how many of you look at the numbers, try to model in terms if you are trying to optimize to see where to put your money, where you'll get the best reward for whatever you're investing. There is a sense that at institutional level, these assets are yet to perform as they do for us at a retail level. So there is that need of balance to try and maximize the social causes and the benefits vis-a-vis the real return rewards that we come up with. I'll leave it there, Lisa, for now.
Okay. Thank you so much, Ibra. I think while you were making that submission, you mentioned we have easier opportunities right now. So the Treasury bill results have just come in. They're about 15.2%. If you apply a 20% tax, that's probably about 10 point something, and that is what you're calling easy returns. But most importantly, you've also mentioned that the technical work or due diligence process that is involved in this, and the fact that in our market, we are yet to see the results. So we are desirous to enter into this space, but maybe we do not have physical evidence that we can cling on for us to be able to even venture or leverage more in this asset class. I want to ask George what his perspectives are in these regards, especially these three key issues that have been highlighted by Ibra, but also most importantly, is what we are seeing in Africa the same with the rest of the globe? So you can compare with us what we have in Africa versus a global perspective regarding investments in alternatives. You're welcome, George.
Thank you, Lisa. That's quite a broad question. So just to reiterate, from Gen Africa Asset Managers, we are regional managers, and locally, I think you got the figure just about right. We're managing money, but this really is not our money. This money has owners, it has expectations, it has wants, it has needs. So if I may just backtrack a little, the space that we're in, or the money that we're managing, it has not been around a long time. We're an industry that is 10 to 15 years old. And the basis or the genesis of this industry was largely risk off. So the one instruction that we have is do not lose my money or I'll fire you. So, I mean, we come to these conversations and everyone here is fairly technically competent in finance theory, but the reality of the funds that we manage is that they're very, very risk-averse funds. Because one, they're fairly young, two, this capital, I mean, even NSSF has not been around 40 years. It's also fairly a young fund. To speak specifically about the need that we see now, and it's improving, the owners of capital are more tuned to allocating some funds to alternatives, which has also pushed us to try and innovate, try and come up with solutions, areas, listen to other fund managers, PE, VC, and all that. If you're talking about Africa versus the rest of the world, talking about what Ibra mentioned, just from a fixed income perspective, there's a huge disjoint. You cannot compare the rates of government borrowing, or at which cost of capital for government in Uganda versus Europe or America or wherever. These guys at less than 2%. 4%, 5% is quite alarming in these economies. Uganda, you're dealing with 15%. So there's that dynamic which separates, I guess, local from global. So you have global capital really flowing towards innovation, and there's a lot of money lost at innovation. You have a lot of local capital flowing towards safety, where the rule is do not lose my money. And that's why you see there's a lot of interesting ideas that come out of societies that are supportive of innovation. While here, Ibra cannot allocate to a VC, cannot allocate to a startup, because he will lose his job, or the owners of the capital will just have him for dinner. So that's the dynamic that we see. But in terms of need, I think this is a very good forum. We are waking up to the need of supporting innovation, and this is as mobilizers of capital, we're starting to have these kind of conversations. Thank you.
Thank you so much, George, for that. You also confirmed that this is where we are currently. So we have capital flowing towards safety than taking a bet to risk on opportunities that probably have a lot of hard work that is involved, but also not so clear, outcome. But also you have mentioned that the trustees, I believe, who have a fiduciary duty to protect these institutional funds, are also very cautious on the aspect of preservation of capital. But I just wanted to ask another manager in the market. So how, one, what innovations, I know for a fact that UAP or Old Mutual has a product underway or something that they are working on in this particular space. So probably to ask Godfrey, what has motivated you and what are the risk versus return perspectives looking like for this particular investment venture, but also most importantly, how are you managing the investor attitudes of the boards of trustees in terms of emphasizing the need for capital preservation? Godfrey, if you may offer your insights, please.
Yes, so thank you, Lisa. The conversation around alternatives, when we are approaching it at Old Mutual, we do get to recognize that yes, fixed income will remain a dominant asset class in terms of allocation within the region. However, taking the discussion broader, the challenge across Africa is, I think of the product, basically the investor education, the trustee understanding and appreciation of the return dynamics and the risk dynamics across alternative investments. Then two, you have the regulatory aspect. But combining those two, the bigger problem is how we get to bring on board the retail investors and also the non-traditional institutional investors. And these have actually gotten to partner with us across Africa on the different investments that we've done in the infrastructure space, in the private debt space, and the private equity space. Now, traditionally, when one thinks alternative investments, we've seen capital going into private equity. But currently, there's a whole global shift to private debt, and that's where the bigger opportunities that can actually match what we see on the fixed income yields. And some of this private debt is both the typical debt, but also with a couple of equity structures within that. So at Old Mutual, we have invested close to $2 billion across Africa, but within Uganda, because of the regulatory limitation of having funds or having these investments be domiciled in Uganda, we are setting up a structure that is going to allow for participation of the different investors and trustees. And this is without them having to go through the DD or the due diligence that comes across when you're trying to invest in this particular space. And we are structuring these investments to be able to give you a yield or return that is comparable or competitive with the 10-year bond, which is basically where you would benchmark the duration of many of your investment books. Now, looking into the future, when you look at how the typical 40-60 allocation has evolved across the globe, it has long shifted to more or less a 50-30-20 play. So there's a 20% going into alternative investments across the globe. And for Africa to grow or to get to where we need to be, when you're seeing Dangote putting a refinery now to supply for countries, not just the Nigerian market, when you're seeing a couple of real estate properties coming up in Uganda, you're seeing different infrastructure or opportunities coming up. If you do recall, the Bujagali project was earning 18% on the dollar. The Mombasa port is yielding close to 15% on the dollar. The opportunities do exist that are even beyond what we see. The challenge is, how do we structure that as fund managers looking into the future to be able to get the investor participation without necessarily having them have that competence that we have? And that's what we're trying to bridge now.
Thank you so much, Godfrey, for that. Linda, at TDB, what are your views? How are you making your footprint into this particular universe? Are there products? What are the opportunities looking like for you? Thank you.
Okay. All right. So thank you. So at TDB, we're very happy to be playing in this particular space. I think one of the opportunities, or one of the many opportunities that we see around alternative investments, is the mere fact that in Africa, there are a lot of gaps that you identify, be it infrastructure gaps, trade financing gaps. And I think during the presentation in the morning by Rob, he was sort of explaining the difficulties that Africa has in terms of actually attracting capital inflow. But we already have in-house Africa capital that is within different funds, be it NSSFs or any other sort of funds or investments, pension funds, for example. And it is important as Africans to also create solutions for this money so that where we're looking at financing gaps, we also have investors like the likes of pension funds, the likes of social security funds that can actually come and have a play in this. But I also understand what Ibra and the team were saying around issues to do with risk, and how when you look at pension funds, when you look at trustees, they're very weary when it comes to risk. But then when we were looking at it also as TDB, having had a lot of experience and skill in trade finance, we have seen how trade finance performs as an asset on our balance sheet as a bank, and it performs really well. And in terms of the risk return that is being sought by investors, it fit in perfectly. And as a result, we decided to come up with a product of our own, whereby instead of just having trade finance sitting on our balance sheet as the bank, we can also create a fund that we can offer to investors to participate that is suitable for what they're looking for from a risk perspective. And there's so many ways in terms of which you can be able to even go around the paperwork that you're talking about, Ibra. We have already done that. So the fund, the trade fund that we are currently managing is a regulated fund. So for you to then get the licensing around the fund, you have to go through so many hoops with the regulator until you are then registered as a fund. And the paperwork is already there, the prospectus is already there, and there's also a watchman that is always sort of looking and seeing if you're actually really operating the way that you're supposed to. And as a result, we've created a fund that has worked really well for investors across the spectrum. We sell this fund to institutional investors, so even the pension funds that are risk averse are starting to warm up to this fund because private debt or private credit is an alternative investment that is fairly new in our markets, and it takes probably a lot to get to explain and for them to also understand that the risk profile is exactly what they're looking for. The fund now has got 62 investors, but these 62 investors are representing so many other institutional investors, underlying investors who've gotten investments from sovereign funds, asset managers, pension funds, and some high net worth individuals. So it is possible to create alternative investments, and private credit has come into this market and looking much more attractive, and like what Godfrey was saying, also generating the sort of returns that the trustees and all the other investors are used to in the traditional assets, but coming with more benefits like diversification and even low risk in most instances, yeah. Mm-hmm.
Thank you so much, Linda, for that. I just wanted us to shift our focus at this point in time. So we have been speaking about the existing challenges for institutional investors to appreciate or have a footprint into this particular asset class, but we've also had perspectives of new products or available investment opportunities that are available in this particular space. While the rates are attractive, easy investing right now, it's easy for us to choose to invest in fixed income because in this particular section of the market, the returns are definitely very high compared to our peers. So it's easy for us to go to that. But just to be more futuristic and talking in prospects, and I want to ask George, what can we do, or what are our key roles as investors, as fund managers? Are we doing, or what is supporting our focus in the future to look into allocating more funds into this space? I'm coming from a position where we've mentioned that our growth is expected to almost double medium term, and all of this is being hinged on oil production, and of course if we have oil production, exports will improve, and then local revenue will improve. So in the future, or prospectively, the nation is expecting to have a lot of the need to borrow domestically will drastically reduce. So it means that we should be looking forward and being able to plan on how we can manage our challenges right now. So just to invite George, how can we beat this challenge that you had mentioned? Yes, it's not our money, but we have a duty to grow our market, but also what needs to happen for you as George in Gen Africa to be comfortable to put more into this investment universe?
Wow, it's very broad questions. I will speak to something you've mentioned. So one, we have and are still building a lot of capacity in terms of financial resources. Previously, if NSSF was not interested in an opportunity, that opportunity was not going to fly in the local market. During the lunch break, we were discussing ex-NSSF, the next maybe 4 or 5 funds are now closing in on $1.2 billion in terms of capital. Just that alone means the opportunity or the possibilities grow. 10 years ago, a ticket size of $1 million, $2 million, you would barely get anyone looking at that ex-NSSF, of course. Now, that's not an issue at all. So that capacity has come in. So in a forward-looking sense, there's a lot more domestic mobilization of capital. There's ability, there's a skill set which has really developed over the years. Again, during the break, I talked to a couple of regulators, and we were just trying to understand why would a PE fund not set up in Mauritius and set up in Kampala. There's, at that level, still a bit of structural issues around tax, around understanding of the law, how to attract capital before you can regulate it, as opposed to regulating it before you can attract it. And these are very real things that have to be addressed structurally, because the capital, I think we now have, and we're building. But there's still a lot of structural adjustment that needs to be done at regulator level. I think there's a lot of education with the owners of capital, who we call the trustees. We don't have an issue with that anymore. But we must, within ourselves and our bosses at the CMA, have an environment that can support the deployment of this capital, which has now been mobilized. So looking into the future, I think we are ready to diversify a lot more from where we are. The law says we should invest in funds that are set up in Nairobi or Kampala. Most of the funds are set up in Mauritius. Why? Well, I don't know. The gentleman from the CMA seemed to suggest that he knows. So there's small things, really, that we could iron out and really unlock the possibilities of deploying this capital. The opportunities are immense. We're a young country. Everywhere you look, every sector is in need of capital. Health, education, infrastructure, whatever it is, could use locally mobilized capital. So we're really excited. And where's the CMA table?
That's right there.
Hi, CMA.
Yeah.
Over to you, Lisa.
Yeah. Thank you so much, George and Ibrahim. Just to pick up from George, what are those structural challenges or reforms, so to speak, that we need to put in place to make this more easy? I just want to take an example and say we all have heard about this investor alliance or consortium that our counterparts in Kenya tried to form. It's called the Kenyan Pension Funds Investment Consortium. It's called KENFIC. I think it's a forum that, unfortunately, or fortunately, whichever direction you look at whether it was a success or not, but I think it was not investor driven for them, but it was another entity sort of mobilized these investors to come and create something like that. So we have entities that have done alliances like that with the expectation that if there is a deal on the table, instead of walking to NSSF and pitching, then you go to another scheme that has probably less than 100 million US dollars, for example, or 20. You just meet all of these investors in one room. Of course, there's a difference. The implementation can be debated. So if it's presented to them, who then does the due diligence? You mentioned the issues of lawyers and how sometimes that can become technical. But I just want to direct this to you, that what are some of those structural issues that need to be put in place? But from you, Ibra, I also want to, because we always mention NSSF, and at some point, we've probably overly relied on NSSF to be the one that drives us growth. But remember, they also have a duty. So is it that if there is a way we can form a consortium, some of these become easy? I'm just preempting, reading into your mind. But if not, or if so, you provide us some insights. But most importantly, from your viewpoint, what are some of those structural issues that need to be in place that will make you as a fund manager feel more comfortable to probably allocate capital to this, or maybe it will boost us growth into this particular space?
All right, thank you so much, Lisa. I want to pick on from George and state that we are a very young market. And sometimes as elites into this industry, based on what we've seen elsewhere and the fact that the globe is now, you live with it every day, we forget and assume that we are it. Yeah? But we are a very young market. The markets go through stages of development, like a human being. And as a market, actually, I've been around for quite a while. 10 years ago, this market was doing about 50 billion in government bond auctions, 50 to 80. You're doing $1 trillion plus now. Deals in other sectors of this market, they were very small deals. They're not so many, but they were very small. We should appreciate what the market is going through. The attractiveness of alternative investments is massive. It's easy to sell the story, as I've mentioned. It's quite relatable. But in essence, alternative investments are complicated. They are more difficult than any asset class I know of. And therefore, even before you talk about technical capacity and everything, my argument would be that you need very specialized funds as a way to basically unlock value in this asset class. You've mentioned the partnerships, but that's what a fund can achieve. Like she's mentioned, TDB is doing the trade finance. If you have an infra fund, for instance, if you have a real estate fund of some sort, these people then get the skills, yeah? They develop the skills, like the PE funds have done, now moved into private debt. They get the skills to sort of penetrate these markets. They get the skills to influence policy. They get the skill to create relationships and networks. So the path for Africa, or for us as a country, I believe, is not NSSF alone doing pension towers and doing Aluoa, and there, or maybe someone investing in KJE alone. The path, I think, is through funds, because funds as a whole, if the investors funds or groups, as you've mentioned, will be able to extract some or get rid of some of the process issues that exist with this asset class. Now, beyond that, if you look at alternatives as well, they are very liquid, yeah? And as you mentioned, someone is mentioning a 20%, for instance, allocation to alternatives. But if you look at the noise that comes from these other asset classes, let's say fixed income and equities, if you allocate 30% or 40% to alternatives, you could easily visit some of the pension funds in the region, such as NSF Tanzania, NSF Kenya, to discover what it means, yeah? So the story has to be done in such a simplistic sense, but in a sense that recognizes our challenges, that recognizes our process or our path. We ain't a mature market. There are opportunities, but these opportunities will need some sort of specialized structures to unlock them. Thank you.
Thank you so much. While I am on you, Ibra, and as we wrap up this session, for me, it ties it nicely to hear what segment of the universe are you most optimistic about, especially 3 to 5 years, medium term. And I'll run through the panel to get their insights on that.
Thank you, Lisa. I think the obvious one is private debt. The story is old in the mature world. I think private debt is easy. It's going to be a very easy alternative. I think we'll see many of us preferring it to banks because the banks have the regulations that limit which sort of risk they can add on their books. But you'll see most of you, maybe 2 years from now when we come back here, when so many smaller funds or large funds have come to you and you've given them money. Why? As he hinted on so far, globally, they seem to be outperforming traditional fixed income in some cases. So if people can give private debt money, most likely it's an extension of fixed income, but let's say private fixed income. Let me use that word for abuse of notation. So we'll see more money allocated to private debt over the next couple of years. We'll see more pension funds also pretending to understand real estate as well. Some of the schemes that you own, they will pretend to understand it and sort of migrate into it over the next couple of years. And then perhaps it will be, if it works out, it doesn't work out, it will be a tricky thing. But let's see. But I think private debt followed by real estate will be what we see more.
Thank you.
Infrastructure as well.
Okay, thank you so much, Ibrahim. And to invite Linda, what segment of the universe are you most optimistic about? But also, if there is any that is not yet here, what do we need to get people to allocate more to that particular universe to get us to achieve it?
Okay, sure. So I'm with Ibra on this one, definitely private debt. I'm happy to say we've already started it, and we have a track record that shows that this actually performs. I mean, for a dollar fund, that is currently earning at 9.5% for 12-month rolling return net of fees and expenses. I think that is quite phenomenal. For those that are interested, I've also put some fact sheets in the TDB bags just to see a bit more in terms of the fund, but the fund has performed really well. So for me, private debt, being my day-to-day experience with private debt, is definitely an asset class that is upcoming. Of course, in mature or developed markets, it started a long time ago, but we're sort of playing catch up. And the good thing about private debt as well is that whilst maybe you compare it to PE, where people are a bit less comfortable because you have long lockup periods and you don't know what's happening in between, private debt gives liquidity. So in our fund, we say if you want your funds, you can get them on 3 months' notice. And already that gives someone that comfort that if I can be able to even just test the liquidity of the fund to see if I want my money back, do I get it? And then they put it back, whatever the case may be. But private debt is definitely the new thing. And on to your question, I think there's more that can be done within private debt. Because as I've mentioned at the start, there are so many financing gaps within Africa, trade finance being one, which is where we're playing. There are other financing gaps within Africa, even infrastructure gaps, etc., and funds that actually support, through a private debt structure, funds that actually support some of these, coming at different tenures, but with some form of clear exit, then help really in terms of creating these new assets and getting the local African money to actually support the economic development of the continent itself. Yeah.
Godfrey, Sam, so to tie this up nicely, what universe are you most optimistic about? You probably mentioned private debt, and I'm starting to see that across the panel. That is probably a shared perspective. But also, what other, what initiatives, because we have Capital Markets Authority in the room, we have representation from Ministry of Finance, but what do we need to get there to also be able to lift up allocation or look into other options that could be close to private debt, for example, but also start by mentioning which section are you most optimistic about, why, but then what can be done more for us to support this vision of seeing pension funds or the funds that you manage allocate more to this asset class?
Thank you, Lisa. I'll say this first. In the question of what needs to happen, we've seen the cracks develop in some economies. We saw Egypt, we saw Zambia, we saw Ghana. At a certain point, the trustees, the investors in this room, will get to witness a form of crack in Uganda's debt, just like we saw Kenya last year. And at that point, the narrative, the discussions that started a while back, that will have ensued till then, those will start to crystallize, and we shall start to see increased participation from the investors here. Now, in terms of private debt, it's not only the vanilla private debt that you could see because of the Basel III coming in, and then you see banks having to de-risk their balance sheets and therefore create opportunities for us on this other side to take off, to have some easy access to the private debt markets. There is private debt that is linked directly to infrastructure, to things like the marine side, to things related to real assets. And in that, we need to see the government, Minister of Finance here, provide definite guarantees, because they're the majority owner or custodian of most of these assets that we could potentially invest in. Say, for example, if you want to invest in a marine project on Lake Victoria going to Kalangala, in terms of the MV, you find that at a certain point you need to deal with the Ministry of Finance. From the regulator, you find that a couple of things need to happen. Investors, so Ibra spoke about the 80 billion to 1 trillion journey, but you see there was an increased participation of the foreign portfolio investors coming into that space, in addition to the local market. We need to see the CMA make it easier for us to actually attract funds beyond the Ugandan landscape. And that also, on the flip side, means you have to give us the ability to invest funds beyond East Africa. Because if we don't invest beyond East Africa, there's a bit of a topsy-turvy situation. They will not be able to easily see the capacity of what we have here and be able to bring them into that space. If those two things do happen, then that particular private debt pool could easily have the same growth rate as we've seen in terms of the participation from the fixed income side. Thank you.
Thank you so much, Godfrey. And last but not least, I'll invite George to offer his insights on what he's most optimistic about and what needs to be done in the landscape, in the ecosystem, to be able to support our vision or need to be able to tap into this market.
Well, thank you, Lisa, once again. In terms of optimism, or what do I see, there's what I would like to see, and there's what I can predictably see. Yeah. I mean, I foresee participation, of course, in private debt, and the fund managers will ask for preferably a guarantee on that private debt and a return of 200 basis points above government securities. That's the space that we're in. Why is everyone saying private debt across the panel? Why is no one talking about venture capital? So what I wish could happen was, or is, a more critical look at the ideas coming out of our young entrepreneurs. I know there's something happening at STI. We're all disjointed. There's all this domestic capital, but government is running a program. The fund managers don't know about it. There's so many ideas that could benefit, and I know IBRA funds I think at a CSR level, fund some of these innovator level ideas. And I wish more money could flow towards that, towards new ideas that have potential to really transform whatever space they're in. The blockchain guys were here. If they came to us to have a meeting on Monday, I don't think any manager is going to put any coin in their funds. But that is something, they spoke so much sense about efficiency, about so many things that could change. So to answer you, I kind of, from a pessimistic perspective, can see what's going to happen in 3 years, private debt with a guarantee. And best case would be that more funds would flow towards more innovation, towards more ideas. I think we have more capacity to support that from a capital perspective. So that's my view, both ways. Thanks.
Thank you so much, ladies and gentlemen. We thank you to the panelists for such great insights. And clap like you mean it is our tagline. I think they have done pretty well. They've been very honest. A few key takeaways that stood out for me. If there's anything you've picked out of this session as a board of trustees, as a potential investor, is to walk in tomorrow and start researching about private debt and how you can tap into this space. I think it's not by chance that 4 random people probably are optimistic about that space, so I think that's a good takeaway for me. The other is that the opportunities within the alternative investment spaces exist. A few members have been speaking about what they're already doing. The risk-adjusted return numbers have been spoken about. To note that. Another key element, Capital Markets Authority, you were mentioned, URBRA, you were mentioned. I think development in this space is a joint forum. We need to be jointly looking at this together, so there are structural issues that we hope capital markets fully represented here can take key takeaways on how we can develop the market. Uganda Retirement Benefits Regulatory Authority, but most importantly, the trustees. When they say attitude, we hope that this is one way to your heart to try and change your perspective of how you have been looking at this alternative space. It is possible. People are doing it and people are earning from it. Thank you all so much once again for being such a great audience. And thank you.
How's everyone on this side? I feel like we've been neglecting you. You guys are good? Yes, I'm sorry. And also everybody staying that side. At the end of the day, you have Batman neck, so let's twist our necks this way now. How's everybody on this side? You guys are good? You guys are good? If I may be so boorish and ask you guys to indulge me, I'm going to ask Aisha at the back. Aisha, there's something I need you to project onto the screens over here. We are fast finishing our program today. We have one more panel, and that panel is going to be focusing on the direction, the way forward. People like to say way forward at the end of every conference and summit. What our way forward is, and that's coming up shortly. But if Aisha can project what I wanted her to project, if you will indulge me, pull out your smartphones, please. And capabilities you can put back in the pocket, but pull out your smartphones, please. Our friends at TDB have something for us, but it requires you to use your QR scanners. Think of it as seeing if you were listening. That's the QR code right there. Please scan it with your phones. Okay. QR stands for quick response. So if you use your camera, it will open up a link. When you see that link, you click on it. Click the link, please. Have we all clacked? You've clacked, eh? Can we click the link? Are we there? You see what it brings up, eh? Yes, put in your name. Small KYC. Then when we're ready to start, are we all, I just want to make sure everybody's there. Yes. Please come forward, they can't see you over there. Everybody's ready? Madame Sarwe, on the back end, are we good to go? All right. It's a quick quiz. 5 questions only, multiple choice. I don't know why they called them objectives back in the day. Multiple choice. All you have to do is answer, we move on. I'll give you a bit of sassy. Let me give you a tip. The faster you answer, the more points you get. They're reading on their phones. Yeah. We've all answered that. We move to question number 2. Who was listening? Who wasn't listening? There are too many financiers in the room, though. I'm sure everybody has to get this answer. But there's the 15, eh? Then the 6, the 8, man. How many investors in the TDB Trade Finance Fund? Your time starts now. Boom. Were they listening is the question. You were listening, eh? Don't look at me. Look at your phone. Answer the question. We're seeing it in real time.
Some didn't manage to log in. Let's see. 36. No, we have a lot. 36.
Let your fingers do the talking, please. Answer on your phone. This one, this is for me. Speed counts.
Speed counts.
Yes.
If you want to win big, you must be quick.
Yeah, you must be quick. Okay, next question. The proportion. Uh-huh. This was about 3 panels ago, by the way. 3 panels ago. I don't know if you guys remember. That's where that answer was.
Yes, I think Rob presented on this in the morning.
3 panels ago.
Yeah.
So
we're expecting Rob to get it correct.
We'll find out soon enough. We're all there? Next question, please. The 10 who failed it, see me after here. The estimated trade financing gap in Africa, according to AFDB. You're answering on your phones, my people. We're all there? The one that doesn't. Let's answer. All of them make up, except which one? I see the table of CMA seems to be very happy. CMA, definitely, if we don't have the winning table there. Alan, are we good? Muzuri sana. We thank you for your participation. Usually, we can have the, would you like to see who has won? Lynn. We can go back end and see who actually won the quiz. So while they do their tallying, don't worry. They're doing their tallying at the back. And then we're going to see who has actually won. Are we ready for our tally? 1 second. A quick thank you to our sponsors. As you are listed on the screens, BOU, CMA, Blockchain Association of Uganda, MOFPED, Genafric, ACCA, ABSA, Autos Africa, MRBS. We like to acronymize in this country. Capital Savvy, TDB, UAP, Country Wealth Advisors, UBRA, NSSF, SBG Securities, Carbon Access, Matt Abacus, Strona Capital, DPF, and Cornerstone Asset Managers. Okay, here we go. Let's find out. I can see on the screen right here. Isaac, don't look. It's coming. We have a special prize for whoever has won. Also, after this next panel, we have a session with the candidates, the prospective CFA candidates, if you could stay in the room after the next panel. The next panel is going to be led by Lynn Tukey from CMA. Lynn, now is your time. Please put your hands together for Lynn.
Hello, hello, good afternoon. Good afternoon. Much better. My name is Lynn Tukey. I am the Communications and Public Relations Manager at the Capital Markets Authority. That is the authority that is responsible for developing and regulating the capital market space, as many of you may know. It was set up by an act of parliament, and we're here to protect investors. Very honored to be standing here today. I think someone mentioned that this is an enviable role to perform. And I must say, to speak amongst mathematicians, finance people, you name it. Mathematics was my worst subject in high school, but I am here speaking to mathematicians, so please clap for me. This is an alternative investments conference, but I've heard a couple of people speak about that, saying that we are no longer an alternative investment, so to speak. We are essential. So does that mean, Alan, we're going to change the name of this conference soon? Huh? Please allow me just give you a brief about some of the latest regulations that we have put up as a Capital Markets Authority, and just to speak into the development, and maybe you can get to appreciate what we're doing in this alternative investment space. Just in January this year, the CMA gazetted the licensing and approval regulations, which recognize and allow a light touch regulation for PE funds. This is expected to encourage domiciliation of funds and allow pension schemes to invest in this fund. So the regulations recognize funds structured as companies or partnerships. The other is together with the URSB and working with CMA and IAVCA, we've been able to gazette the partnerships regulations, which recognize and register PE funds as partnership vehicles. This is aimed to address various concerns around the winding up of the funds. And most importantly, the government provided tax exemptions on PE funds, that is to say exemptions on stamp duty and income tax. And the very latest regulation that's coming up on in September this year is the regulatory framework on the ESG related products. So please, let's clap for that, because at least there is some movement happening. Allow me to get into this panel where we're just, again, going into the direction, what's next after all this is said and done. And first off, allow me invite Mr. David Wangolo, the Chief Investment Officer of Rikindo Capital. Please clap for him as he comes onto the stage. We also have Rob Langrick, who is the Chief Product Advocate at the CFA Institute. Let's clap for him, please. Francis Nasiomba, the President, CFA. Please clap. Clap until they can sit. Clap until they can sit. This is not easy, my friends. If you're not clapping, I'm coming for you. Clap like you mean it, please. And lastly, we have Mr. Alan Loetabe, the Director, Investments at the DPF Uganda. Thank you very much.
The panel is constituted, but without me, there would not be inclusion here. So can we please clap for some inclusion? Because what is this? Women empowerment. Way forward. And we'll just keep it brief. Yeah, Alan? After all this is said and done, in basic language, what are alternative investments putting to the table, and how are we solving the Omuntu Wawansi, Omuntu Wabulijo challenges? Because all this is, I have had a lot of complex English in this room, I'm sure you people can agree, but what do we take home to solve for the people out there? Because this means nothing if we're not solving an actual need. Yes.
Good evening, everyone. Friends, money is coming. I wanted to echo my minister. But on a more serious note, I'm just delighted to see a vision that we had almost 4 years ago, that Uganda was being left behind. Rwanda was better organized, running ahead of us. Nairobi is big. It doesn't need to do too much and everything works out. Mauritius saw the vision 20, 30 years ago. South Africa is massive. And when you look around, Uganda is, we do things differently. And my concern was that if we don't start, we will find that the gap to climb is even much bigger. And so this conference was designed to try and keep us in the game. We know our government may have other priorities, but it doesn't mean we don't need to talk and perhaps catch up somewhere. So for me, we can start with clapping for ourselves. I had not seen the audience from this side. I was in the back, but seeing it from this side, I see we've made progress in the diversity of who is in the room and what we can discuss. But when I'm looking forward, and from what I've heard, people have spoken to, my next tasks are about 3 for the next 12 months. At the top of my mind is the ministry. Too many people are speaking to the ministry. Everybody is offering guidance. Is it reasoned guidance? Is it helping? Is it disjointed? My next task, at least for the next year, is how do we simplify the message to the ministry so they understand what we are talking about? And I know they can help, but too many people are feeding information. So for me, policy level awareness, and I'm happy that the Director Economic Affairs has said he's going to give us space to have that conversation.
Wow. Let's clap for that.
The other one is on the investor level, which we are having. The problem I recognize is the key decision makers on pools of capital need support. And the other thing that we are going to be working on is how to centralize or share investment review or due diligence, either through a secretariat or a consortium. I think it's going to be an important thing that we figure out how to do for Uganda. And I think for me, if it's one deliverable for next year, that would be it, to get it done. Beyond that, we just to keep encouraging and teaching capacity building. This is a complex subject. I don't expect anyone to do a deal next year, but we can continue to build the capacity and knowledge.
Yeah.
Thank you.
Definitely capacity is needed. Francis, what would you say are the next steps for us so that it doesn't all end in this room? You can just, yeah.
There you go. Can you hear me?
Yeah.
Yeah, thanks a lot. I think first is to appreciate the progress of what the conference has done in the last 3 years. It started as an idea, and initially I think I was having a conversation with one of your colleagues, and we were talking about the first time we had this session, it was a bit all over the place. We were talking about everything, blockchain, crypto, and all that. And that's the challenge that is around alternatives there. It's very wide. So I think for me, for the next steps, is to start getting into action. When you are at the breakout room, there is one action that Alan came up with, and I think if there's anything we need to come back with next year, it will just be that. If there's one win, it will be that. And that is to convince the government, the lawmakers, the policy shapers, that it's important that alternative investments are ingrained in how we invest. So pension funds are the biggest investors in most of our markets, and they need to start also being able to look at alternative investments, and it's wide. So they can look at very many different things, from cryptos, gold, climate, private equity, and all that. So the biggest win next year for me would be if we come back and we say that there is a regulation that says a minimum of, let's say, 5% of, let's say, pension funds are invested in alternatives. For me, that would be the biggest win. So I don't know, Alan, if we can do it. I think I saw someone calling out CMA, hi CMA. In Kenya, we say hi cousins.
Hi CMA.
I hope you are there, you are the regulators. So I think many of the decision makers, the policy influencers are here or have been here. If we can figure that one out, I don't know how much that will release to the alternatives. Yes.
Thank you very much. And David?
Thanks. Thanks, ladies and gentlemen, for today, for spending time here discussing these things. It will be very hard to easily translate what my colleagues have said into actionable points, but I'll stress that we need to work with government. Otherwise, we are not moving the right direction. There has been a lot of angst about, government taking the largest allocation. But also, we must understand that government finds it very expensive to manage this debt. I mean, close to 30% of tax revenues collected go to interest, payment. That is, guys, that's a national Ponzi. What are we doing? That money is supposed to go to, development expenditure, but it's going to interest payment. So in this room, if we are seated and wondering that government does not fail, I think there's something lacking there. The only faith and credit that I know of is that of the US. They can call back their money from any country. anywhere in the world. This one of our government and many other governments really needs us to think carefully and creatively about moving into investments that are not necessarily traditional. I'm not saying I don't have faith in my government, but I'm just wondering if investment managers vote to place 90% of the money, and someone could even say it's easy work, it just shows that maybe the culture has not shifted yet. And for us to claim that the taxes that we pay ultimately go to paying interest and not reducing the debt obligation, 30%, then what are we really changing in the room? Why are we voting for this allocation? Year in, year out. I think for me that's the biggest. Working with government and putting our money, where our mouths are in terms of what is this risk that we are facing with such a huge allocation to government securities. It is a political point, but it's also an economic point. So you can choose your side, whichever you.
Wow, just to say, David, I work for the government, so no comment there. We shall swiftly move on to Rob.
Oh, thank you. I'll keep this pretty brief. I'd say I was in a meeting a few days ago in Kenya, and someone explained to me something quite crisp. They said the reason you invest in private markets in Africa is because 60-40 doesn't work anymore. And then he explained to me that if you go back to 2022 and you look at the performance of Kenya government bonds and you look at the performance of equities, they're both pretty correlated. So you're really not getting any diversification. They'll go up and down together, have done in recent history, which is really dangerous, as people have alluded to here. When I think about the 9 recommendations, or buried inside that big document that I spoke about this morning, there's a list of things you really can't control, and there's a list of things that you can. So things you can't control, for example, the move towards the African free trade area, that's way above the pay grade of anybody in this room, really, although you can encourage it and support it, or the reduction in the need to have visas to travel between countries. These sorts of decisions take a long time, they're very political, and it's kind of not this industry's role, perhaps, although you can support it. The one thing you really can control in the near term, though, is education. This is not easy stuff, private markets investing. Looking at credit risk on small companies, for instance, and doing small company valuations is a different toolkit. And so I think as much as you can encourage that and select that in your staff, the better. That's a practical way to move the ball forwards. But yeah, there's a decent risk in this. I think one piece of news that we arrived yesterday or last night overnight, then I saw the news that in the USA, all of a sudden, or maybe not all of a sudden, there's now going to be a rule where people can use the 401k, the retirement accounts in the USA, to invest in private markets, which is probably the single biggest moment in recent history in global private markets investing, that change or proposed change to USA rules. It'll cause a huge push towards private markets there, but that's not been an overnight thing. They've been pushing for that for several years. So that illustrates the sort of timelines you're dealing with in terms of driving change at the government level. But yeah, as I say, number one thing in your control today, right here, is education.
Yeah, I agree so much. And education, speaking of education, we have so many financial literacy programs that have been set up by some of our government agencies, even private entities. From where I sit, actually, you'll see that there's so much ignorance when it comes to investing in our alternative market space. I mean, you have seen the examples, for example, Capital Chicken, Veta Plan, and there are some people in this room who I can actively say could have invested in some of these. So you think there is no money, right? That's what we're crying. But actually, when an investment scam comes up, who is investing? You guys. So education is paramount. I don't know if it's also ignorance for some of us in this room, but some people from even high offices were investing in such, schemes. So the money is there, the capital is there. I probably think what we need to, double down on is the financial literacy bit, especially for those in other parts of the areas.
that could actually remain unreached. I want to give a moment to some of us in the audience that I realize some of us haven't asked a single question, especially since we started the day. If you have a burning question or a contribution, now is the time, because this is the last panel. And maybe Moses could help me with the microphone. Anyone? As we have our parting shots. Yes, there's one in the back. Right there. Any other question or contribution? We're looking at what is the way forward. What next? Before we go back and convene next year. Okay, 2, 3. It's also an opportunity to ask our panelists here. Yes, Alan.
Good afternoon to you all. Mine is about derivatives. Like, we have a current problem in the country where coffee prices are plummeting. And we are seated in this room as the financial elite of the country. Question is, what can we come up to localize, to give solutions to these farmers, not to abandon their agriculture, like their coffee farms? For the case of derivatives, for example, the Chicago Mercantile Exchange, derivatives that can help a lot in trying to do what? To stabilize these prices, rather than us relying. I've seen the Capital Markets Authority, the Uganda Stock Exchange, COMEX, but still, we need derivatives to try and lock in prices, to stabilize prices. Otherwise, a kilo of Robusta is now 5,000 UGX.
Yep, thank you very much for that question. I'll just have 2 more and then we shall answer. There's another hand there. I think there were 2 hands. There's another here.
Thank you very much. Just a few comments. With the knowledge and intelligence in this room, one of the biggest challenges we have here in the country, and actually on the African continent, is the very high rates of borrowing or lending, not just to the governments, but also to the big corporations. What is our contribution to that in terms of bringing those rates to be competitive globally, as we discuss even the alternative investments? The other one, which is also a comment sort of, there was an issue about the population of Africa in the report, of Uganda being a young population, and actually Africa as a whole. And others have talked about the risk of not having the population dividend that is expected, especially based on where most of our young people are involved in border businesses and other businesses that may not contribute the way we desire them to. What is our contribution to that debate in terms of policy and guidance? Last but not least, thank you, the organizers of this conference. I think it is very good. Just adding my voice that after the conference, I think we should always write out our policy recommendations and we formally submit them to the different departments of government. Thank you.
All right, thank you. Thank you so much. One more and then we close. I hope there is no burning question. We'll close with that one.
Thank you very much. Good evening, everyone. My name is Soed Zirabamzale. I work with Shona Capital. Last week, I read in a New Vision where everyone in the country was celebrating how Uganda Revenue Authority had hit its assigned revenue target. The previous panel also stated that in the next 3-5 years, probably private debt is going to be a very, very big opportunity, as it has been. Of course, maybe the opportunity is growing bigger. we work with SMEs. URA has been very, I can call it very strict in terms of revenue collection. We are investing in these small SMEs. I had 2 scenarios where they issued agency notices to some of our portfolio businesses. The business had 60 million on the bank account. They took the entire 60 million. My question was, I've invested in debt. The business has received a payment from their customer, 60 million. You've taken it all. In the mind of government, how is this business going to survive the following day? Because it affects us directly as investors in the private debt. Because they will need capital to operate the following day. But the entire working capital that they have received has been taken away. So as a CFA society, as capital market authority, how do we get these people to understand that actually it's beyond just what you're getting today. Let's look at sustainable solutions. So I think for them, yes, they will hit the targets, they will come, they will need the revenue, but how do we get involved? Do we need to go to the offices and educate them that actually this is how business is run, that it's okay to take 25 million of the 60, leave the business with the 40, so that it can be able to run the following day, you'll be able to get more revenue out of it. That's my biggest worry, and it's affecting largely people who have invested in private, some of these SMEs. So personally, I would be glad to hear from you. Thank you.
Thank you very much. I think that wraps it. In a minute, we shall just address some of those questions in our closing remarks. But also, I just want to reiterate, we first talked about mainly agriculture. And you know, the ATMs, our focus as the government of Uganda is to move from the 50 billion to 500 billion. That's $500 billion. And we're saying $500 billion. And we're saying, really, how can we leverage these sectors? We have agriculture, we have tourism, manufacturing, and science and technology. And he has mentioned one, which is agriculture. So how are we as alternative investments players embracing that, so to speak? And he also talked about the policy recommendations that we can give to government. What are some of those? I think Alan talked about those as the most, the next immediate steps. And then lastly, about the SME sector, just wrap up, and then we shall be able to conclude. Thank you. I think I'll start with you, Alan.
Okay, this is why I hate being at the top of the alphabet. I think in this room we haven't focused a lot on derivatives, not because it's a neglected subject, but it's a highly covered subject in another sector. Within the banking sector, the biggest users of derivatives are actually in the agriculture space. Coffee, cocoa, fish. I know people in the forest assets who are trading carbon, as my colleagues were sharing, are very big users of these instruments. Largely because the requirements, want to get an account are stiff. You need to commit $100,000 on an account to be able to start discussing with the bank. So a lot of smaller businesses are not able to do that. I know some of my colleagues in a few who are in the VC space have a US company that helps them to do micro derivatives. But from an individual, if you are an individual farmer, that may be a step too far for you to start dabbling in some of these things. So what I can share is that derivatives are used. It may not be as apparent in other areas of the country, but they are largely used within the banking sector, but for agriculture. The big coffee exporters, the big fish exporters, cocoa exporters, tea exporters, use them to lock in their prices. And again, how do you tell that they are using them? We look at the exchange rate we are seeing on the ground. Right now, when I walked in, it was what, 3,580? 2 years ago, we were 3,900. That movement is not driving itself. There are other underlying people doing different transactions. But what we see when we go to buy dollars on the street is that the price is almost the same year in, year out. So something is happening, and I think for me, we just have to be mindful about it, and it may not be in this room, but something is happening. I briefly want to touch on the question around the garnishing by URA of money on accounts. I think we have to acknowledge that there is a way URA has operated for many years, and this matter has been brought up many times in many audiences. In the most recent reading of the budget, there was a change to protect early companies or to protect startups in their first 3, I think 5 years. Such that these things then do not happen. They are protected from paying some of these taxes for their initial formation years. The only challenge is that for older companies, you still have to bear with that issue. It will remain one of those issues that, again, we need to engage with the ministry and the Commissioner for Tax and the URA to appreciate. It's not that it's not that government doesn't understand, it's just that government works slowly. So it won't work on your timeline. It has a cycle in the way it operates. So sometimes we may have to bear some of these issues as we deal with the conversation and speak to them. So I'm not going to help you with a quick solution, but just to let you know that there are some solutions that have happened. They may not help those that set up last year, but they may be helpful for those who are setting up now. And right now, as I'm speaking, a strategy is coming to my mind that you may want to close your company and open it again, such that then you benefit from that startup.
You had.
So
Right.
thank you very much. Let me pass on to my colleagues to speak to some of the other questions.
Thank you, Alan. Francis?
Thank you. So for me, I'd like to address some of the questions. One, I think I'll start with the policy recommendation. From this conference, and Alan will correct me, every time that we conclude, there's always a policy paper that goes to the different entities, and I think we've seen some of the changes happening since we started with the conference. So that happens, and it's going to happen with this one. So let me also go to the taxman. The taxman tends to be like, they go to the same school across different countries. So the mechanism you've mentioned happens significantly a whole lot. And I think Alan says they move slowly. Sometimes that movement may not happen. The reality is for the taxman, the intention is to collect taxes. And many of them, they've not run businesses. So the most you can do, one, is figure out a way in terms of negotiating. But also most importantly is just to know that maybe the next best way is the business community having adequate advocacy to the government on other mechanisms. I don't think it's a battle you can fight alone as a business, or even us as just the alternative. It's a bigger battle, to be honest. I want to conclude with the issue of the coffee, which is tied to the commodity exchange. I see problems in two ways if you are in business or if you are employed. One, it's an issue that the government needs to change something, which means the law, which means you need a whole lot of advocacy. That's why we are here. That's why we are going to do policy papers. So that's one way. You influence government to change some of the laws to work in the way that will help the business communities. But secondly, and this also touches to the question about the population dividend, The opportunity can either be there to be taken by the government, who moves slow, or by ourselves, either being entrepreneurial or from our place of work. So, to the famous words of JF Kennedy, sometimes we may need to think about what we need to do ourselves, not what we expect the government to do, because we may wait for very long. And to conclude, maybe we need to ask ourselves, who's government? Many of us here are government because we sit in those offices, we influence those policies. So I'm just seeing my moderator there, she says she's in government.
Thank you so much, Francis. David, do you want to say something?
Just one thing. I'll just go back to the question of private capital formation and why we have such a lopsided economy. If we're not intentional about taking this pension money to private business, then we'll not build wealth. And if you can't build wealth, you will not build the tax base. And if you can't build the tax base, then you have agencies, notice, you have all sorts of chaos in the business environment. So the question then remains back to the room, how do we allocate money to private business to thrive, build wealth, and build the tax base? If that is not done, even what we are collecting today in this big pension money, we are not really evaluating the tax and inflation risk on that money. First and foremost, we are borrowing largely from foreign investors. I think you understand in this room what that means. It means we are not in control of that exchange risk and inflation risk that is inherent. So if you dollarize your returns over time and really critically look at them as an investment manager, very few people can really say there is performance. And that only goes to people who have lasted long with these funds, not people who are in and out. So you can really see the trend, and it has to build the picture that we are investing in the wrong areas if we are not actively building private capital to invest in business. It can't be said enough, but the equation is not from tax, it's the other way around.
Thank you so much. And then lastly, before we can close.
Yeah, I'll keep it brief. I think that when I heard about the ATMs this morning, the 4 ATMs, I must admit, I felt that that was a good foundation, but I'm not convinced that would get you to the number that was talked about. I'll tell you why. Because 3 of the 4 were net exports, basically. Only one of the 4 was services or consumer, the digital. So I think that's a great platform to start, but you're going to need more than that. And so I think the real question to ask is, what is Uganda's true comparative advantage? So when I look at something like ecotourism, for instance, just as an outsider, it's very impressive. I can see why people come to the part of Africa, and it's truly distinctive as a global product, a global tourist offering. And I think at the end of the day, though, you've got to have the young people's ingenuity to help the young people get jobs. A great example I always use is, we all know that Ghana is the main number 1 producer of chocolate in the world, but it was Dubai that came up with Dubai chocolate, right? They don't have the natural resources for that. That was their own ingenuity. And then they want Instagram talking about Dubai chocolate. I'll probably buy some in 2 days' time as I go to the Middle East. My kids love it. So that's a great example of just the ingenuity when you create something from nothing, basically. And so I think that the ATMs are great. They're a good start. I think the young people need to unleash their creativity and think about how to truly build something distinctive. And I think the mobile revolution, the leapfrogging, it's got to be something related to the mobile technology, and really letting them think through how can they build something globally attractive.
Thank you so much, Rob. A very big hand clap for all our panelists. And that brings us to the end. I am really very grateful again to the CFA Society for creating such a platform for us to have such insightful discussions. Just also to say that the discussions don't stop here. In October, we'll be having an East Africa Capital Market Day, where we'll be having all security exchanges across East Africa meeting in one room. And so please come. We'll be also sharing most of those as they come in on our social media pages at CMA. But otherwise, thank you so much. And may we please take our seats. Thank you.
Ladies and gentlemen, That's our tagline, clap like we mean it. I think this has been a nice wrap-up to our conference. A couple of announcements. Our last session is dedicated to candidates, CFA Society members. We have the CFA Institute, we have colleagues from the CFA Institute, and we have a specific session that has been dedicated to the CFA Society members. So if you're a prospective candidate, if you are a member looking to study CFA like my co-MC, Mr. Rudende, this is the opportunity for you. If we have inspired you, you used to fear mathematics, but now you've realized that it's achievable. Please, you do stay behind in this room, but we have a working tea, and after the working tea, departure will be at will. Please do not leave without taking the tea. Before we close, allow me extend or appreciate a few people, there are not many, who have been very important or pivotal in organizing this conference that you were able to attend today. Earlier in the presentation, Mark David, could I have your attention, please? He's the man I'm actually going to thank, so I needed him to be attentive. So in the beginning, they mentioned that the vision of having an alternative investment conference, specifically hosted in Uganda, was a vision that started by Mr. Alan Luitabe and David. Ladies and gentlemen, I think they deserve a huge hand clap. It's one thing to have a vision. I would request them to stand up. You've seen them along, David and Alan. It's one thing to have a vision. It's another thing to realize it consistently for the last 3 years. Thank you so much. And it keeps growing, and every day we are getting to the next step. Today we have had an organization of investors, and we are going to write a policy paper and be able to progress that. 3 years ago, that was not the case. So I think we need to recognize them. Our sponsors for the event, you are too many, but we are very grateful. I'm not going to mention, but the media team could just flash them on the screen. All of you are sponsors for this event. We are very entirely grateful for your support during and before in the organization of event. Another round of applause, please. We clap like we mean it. We are ending. Our CFA Society board members who are present, you could stand up for recognition. So this is also a shared vision, and they've made sure that they attend in person. Board members from the CFA Society, thank you. We are very grateful, and there is an organizing team that has been on this, I think, for the last almost 9 months. Ruth, Eric, the person behind the social media, the socials. Please stand up if you're in the room. I know most of you are outside. Joanita, I see you. I really want to thank each and every one of you. You've been a great team. I have had the privilege of being a project manager of this team, and I think we've done a good job. Thank you so much. And co-MC, Mr. Rudende Moses, you did an awesome job. Please stand up for recognition. And I do hope after this you can explain tokenization tomorrow. If you don't talk about it, I'm coming for you. I'll be listening. So thank you to our co-MC. To the rest of the members here, ladies and gentlemen, as we come to the close of this impactful alternative investment conference, on behalf of my own behalf and the organizing committee, and on behalf of Moses, we would like to thank each and every one of you for your time, your insights, and your presence. Over the past sessions, we've explored powerful themes, from unlocking value in alternatives to managing downside risks and tapping into emerging opportunities, like my colleague Mark talked about, carbon markets and issues of infrastructure. The quality of our conversations, the openness of our panelists, and the depth of engagement from all of you, the participants, have made this more than just a conference. It's been a meeting of minds and shaping the future of our investments in our continent. Let us take these insights forward, like the last panel alluded, to challenge the status quo, reframe strategies, and champion investments that are not only profitable for us, but also resilient and impactful. We thank you once again, and we look forward to a continued dialogue beyond today, and most importantly, to hosting you for this very prestigious conference. Same time next year. You've been an awesome audience, and we appreciate you for your time. Thank you so much. Members, please stay behind, and we have a working tea and departure as well, just to emphasize that. Thank you.
Mr. Nwosu, it's a pleasure to be with you. CFA members, CFA candidates, charter holders, thank you for staying so far for the third edition of the Alternative Investment Conference. I hope it has been useful to you. Here we'll be doing a little bit of talk about the future of the investment profession for those of you who are here, and just to speak to some of the initiatives that CFA Institute is working on to enhance the investment profession globally. You already know us, CFA Institute, we're a global organization, a not-for-profit, and our mission is to promote financial excellence. We help to we want to lead the investment profession globally with the highest standards of ethics, professional excellence, as well as education for the ultimate benefits of the society. We are a 200,000 member society, in organization. Many of you are part of it. And we have societies across 160 markets. One of them is CFA Society East Africa, who is hosting us today. And we work with universities, about 800 of them across the globe. Point this way? Okay. So today, we're just going to be talking through some of the important things around the investment profession. As you can see here, this slide shows us what the investment profession technically covers. There are 4 sides or 4 categories you can bucket them into. There's the buy side, the sell side, the advisory and corporate, which is where most of the people who work as CFA charter holders or members, where their job functions really lie. And you can see from the yellow bubbles there that portfolio management is the biggest one. That is where most of the CFA charter holders do work. And on the second is the sell side equity research analyst. And also you can see from there that other ones at different levels, private wealth management and private equity, which is what we've been talking about today. But what really you really want to take out from this slide is to show you the breadth of what CFA program or CFA charter holders cover in terms of their work roles. And the distinguishing factor from CFA and most of the other organizations, like maybe those focused on risk or those focused on accounting, is that we are not just a one size or one career focused firm. CFA charter holders are able to work across different disciplines across the world, and they hold different positions. So that is one thing that makes the CFA program and CFA charter holders to be unique in the investment industry. Here we're looking at the number of CFA charter holders across firms globally, the top ones. Of course, most of them are based in the developed markets. And I think this slide needs to be updated because the current highest is the Royal Bank of Canada. That has the highest number of CFA charter holders. But just some little stats for you. And if you want to know more, on the CFA website, you can find live stats about the number of CFA charter holders at different firms globally. This shows us the breadth of job roles that CFA charter holders or candidates and members work at. You can see from the slide, the accounting and auditor is usually the first one. And why is this the case? Most of the time, people, when they want to come into the financial profession, tend to work at the big fours, right? And even from our engagements with asset managers in South Africa, we found that they have this thing where people tend to go through the CA route, and from there they move over to CFA charter holder. And it's the same thing that happens in Nigeria. Most of the people who are CFA charter holders or accountants would do that first and then go on to become CFA charter holders. And also another reason why this happens is because people who are accountants and auditors, after working for a few years, then start thinking about career change. And CFA program is usually the natural qualification they go to make that pivot to another job in finance. Second is equity research analysts, and of course you find risk managers and FPA analysis as well in terms of the job roles. An interesting thing I saw here is the bottom is IT. 1% of CFA charter holders are information technology people. I mean, it just shows the breadth of people who tend to change career into finance and trust CFA program as their go-to to help them build the body of knowledge they need. So today we'll be talking about 5 quick things. Who has the CFA charter holder? Who has the CFA charter? Why they embark on the CFA program? What does CFA program cover? Most of you know that already. How to take the exam, and we'll be covering briefly the latest innovations in the CFA program. Here this slide is funny. It shows Gray's Anatomy of Finance. I mean, if you know the Gray's Anatomy textbook in medicine, it's kind of one that is very popular for those who are in medical field. There is also a drama called Gray's Anatomy, which covers like the personal and professional lives of, of interns, of residents, and their relationship with supervisors in the medical field. So we tend to position CFA program as the Gray's Anatomy of Finance. And you see on the left some of the books that people who would normally want to study or get the knowledge they need in finance and investment, they will naturally go through these books to read about financial accounting, alternative investment, economics. And these are books that are written by renowned scholars, Damodaran and Fabosi and the rest of them. But what is missing is that they have this individual knowledge, but there is no way to test what they have. There is no way to actually know that they have the knowledge that they claim to have. What CFA does is to bring all this body of knowledge together in an organized format, in a curriculum that is regularly updated to meet global standards, and candidates can read it, understand, and they are tested at the end, and employers then are able to have trust in the quality that those employees that they are potentially going to hire would bring, because they've been certified by an organization that they trust. This slide shows the pass rates of CFA program over the years, from 1963 to 2004. And as you know, the program covers 3 levels, 1, 2, 3, and the pass rate varies. For level 1, usually it varies around 50%, sometimes lower. And you see how the pass rate has trended down over the years. One reason is because we've extended our curriculum over the years to accommodate more updated content as the global financial industry evolves. And it also shows, and also because many people from other disciplines who are not finance, accounting related are coming into the finance profession and wanting to become CFA charter holders. But that doesn't take away the fact that the exam is one that requires resilience. It's difficult to pass and requires a lot of discipline. And that is reflected in the global pass rates. Did I skip one slide? I don't think I did. Here just shows a quote from one of the current CFA charter holders about our industry has so many different types of products, and CFA program covers every different area. So it just shows the breadth of what CFA program covers when you study to become a charter holder. What does the CFA program cover? Many of you know this already. It's divided into 3 levels, 1, 2, and 3. Level 1 covers investment tools. Level 2, the asset classes. And level 3 covers portfolio construction. And here you can see the breakdown of different levels, what the percentage of each content in each level. You can see that level 3 is different because it goes further than what you have gained in level 1 and level 2 to now speak to the aspects that have to do with asset management, portfolio construction, and the likes. How can I take the CFA program? This is an example of how the CFA program is administered currently. For those of you who are older CFA charter holders, you would have written your exam at test centers, paper-based tests. What we reflect here is a reflection of the evolution that has taken place as the global economy also changes and we embrace more online testing mechanisms. The exam here, you see people sit in the hall, in the little cubicle, their ears blocked out for noise. It's usually quiet and focused learning. And it helps to preserve the integrity of the exam. In fact, that there's no way people can cheat. So these are the part of the features that helps people to trust CFA exam. And I think Rob also mentioned in his initial slide when he spoke that there are 26 centers in Africa across 22 countries. And we are continually going to be adding more centers as the need arises. The computers-based testing, self-schedule exam whenever you want, 4 windows for level 1, 3 for level 2, and 2 for level 3 across the year. The exam length is 4.5 hours in total. There's a break in between, and the questions are broken down as level 1 has 180 multiple choice questions, and those are A, B, and C. People will tend to look at that and think that just 3 options, you stand a 33% chance of passing, but that is not really the case. Globally, we have about 1.5 million candidates that have written level 1, and if I would ask, how many people do you think have had a perfect score? CFA level 1, 100%. So I'll guess, anyone? 0, okay. Who else? I didn't hear that. 2% of the 1.5 million, okay. Who else? One more, just one more guess. One more guess. Perfect score at level 1. None. Okay, I'll save us the time. 2 people have passed CFA level 1 with a perfect score out of 1.5 million trials since we started. Just 2 people. Not 2%. and I mean, the 2 of them, from my understanding, one is an Italian who wrote his exam in 2021. I mean, we all know what was happening in 2021. Lockdown. So he's locked down in his room, studying for CFA exam all through, and he cleared it. And later in the year, somebody else did it, another lady from Singapore in 2021, both of them in 2021. So I don't know if we will wait for another pandemic and another lockdown to get someone to get a perfect score, but that's just what the data tells us. Level 2 has 88 multiple choice questions. Again, it's not that easy because the exam format is different. It requires a lot of reading before you attempt the exams, and there are 4 questions after each item set of vignettes, which are 22 overall. And level 3 has constructive response, where the candidate has to do a lot some writing for half of the exam, and 50% of it involves multiple choice. And this is incorporated because employers are saying we want our candidates to have communication skills, so they want to see them write. But across the 3 levels, what you will find is that the different ways in which we test candidates would give confidence to the employer and even to the candidate as well, that if you have gone through those different levels with the different testing methods and come out on the other side, you will be proud of the achievement that you've had in passing the CFA exams and earning the charter. Finally, the latest innovations that we've had in CFA program, there are 6 of them that we'll be speaking to. The first is the expanded eligibility. We have expanded eligibility from 1 year before graduation for university students to 2 years. Why have we done this? We've seen from data as well that most of the people who pass level 1, majority of them are usually university candidates. Again, why? They are already in study mode, they are studying. And at the same time, we're trying to prepare the next set of investment professionals for the future. So, I believe there's a 4-year curriculum, 4-year university education program here in Uganda. After year 2, from year 3, university students can begin to write the CFA program. We've also introduced practical skill modules. These are modules that help candidates to get DEX-ready handy skills that they can practice as they go on to write the exam. Some employers have also given feedback that candidates finish the CFA exam, but when they come into the job, they need to be taught how to apply this. And we've incorporated this into our modules. At level 1, there is financial modeling and Python programming, the basics. So candidates can, after writing the exams and before the results are released, begin to understand how to build a 3-statement financial model involving the income statement, the balance sheet, and the cash flow statement. At level 2, there is an analyst skills, which has been developed by, I think, the former head of research training at Morgan Stanley. It dives into valuation, the different techniques of valuation, how to get a target price for a firm, as well as going deeper into Python. And at level 3, we speak more to the portfolio development and construction and all the mathematics, all the data that has to go with it. So candidates, after writing their exams, have the opportunity to learn all this for free. It's part of what the curriculum and what they've paid for. The third aspect is the incorporation of Bloomberg analytics into the curriculum. Bloomberg, as we all know, is one of the foremost data providers for the financial services industry. Across the curriculum, we have incorporated Bloomberg concepts so that candidates can begin to learn the commands as they are preparing for their exams. And whenever they have access to the Bloomberg terminal, it is not new to them anymore. The fourth one is how we have streamlined the curriculum. We've also seen over the years that many of the people who are writing the CFA program already understand the basics of finance, of economics, of statistics, and we have taken those basic elements and put them as part of prerequisite reading. They are not tested, but candidates have the opportunity to read them. Then the core of the program is now, the core of the studies is now in the program for candidates, and those are the ones that are tested. It doesn't make it easier. It just gives candidates more time to focus on the core aspects, but they also have the opportunity to read the basics if they want to. Fifth is the practical skills, practical packs for level 1, 2, and 3. And these are additional mock exams that we have developed for candidates to prepare for the exam. Again, we were in South Africa last week, and we were speaking to some CFA candidates. One of the feedback they gave was that they prepare with some of the other materials. I mean, although they are good, someone mentioned that the mock exams or the tests that they are writing or they are seeing in those exams are not directly replicative of what they will see on the live exam. And for that, we have these mocks. Even though there are 2 mocks currently in the curriculum, these are additional mocks that candidates can purchase to keep themselves busy and as they prepare towards the exam. I think there are 6 of them for level 1, 4 for level 2, and 2 extra for level 3. And we recommend that you do these mocks a week before the exam. Just take each one per day. And we find that people who do that stand a higher chance of passing the exams. And of course, it's paid for, $299. And finally, level 3 pathways. We have created some form of specialization for level 3. Rob will call them flavors. When you think of flavors, you want to say, is it ice cream, or maybe go to the ice cream shop and thinking of vanilla or, or strawberry, but not that. It's more of specialization for candidates who are working towards the level 3, where they can choose what path they want to go through in terms of building their careers. As we've seen today, private markets has been a top focus, and is something that is becoming more in tune in the global finance world. So candidates can choose which of the specialization they want to focus on at level 3. In addition to CFA program, we've also developed what we call an investment foundation certificate. And this has been developed for people who want to be part of the investment profession, but do not want to make the big commitment to start with the CFA level 1 exam. It is also for people who work in the investment profession, either an asset management firm, an investment banking firm, but are not front-facing professionals. So these are people who are in HR, who are in IT, people who are product management. They need to understand the language, they need to understand the basics of finance, understand what a stock is, what a bond is, so they can communicate better with their clients, with their colleagues, with the bosses that they serve. This certificate has been developed for them, also for students who want to have that bridge between what they are studying at university level and then coming into CFA program. So we are currently running a promo on it on Africa, where we've reduce the price to 50% for firms that want to buy it and purchase it for their employees. And it covers, oops. Oh, I don't know how to go back. Oh, that's it. So the curriculum is divided into 6 topic areas. I mean, less mathematics involved, but more about more information to understand how the markets function, understand financial instruments, understand the basics of micro and macroeconomics, as well as ESG and sustainability. The next thing we talk about is private markets and alternative investment certificates. We've heard, it was launched in 2023, and we've heard a lot about why this is important. in the sessions that we've had today. One of the things we also found out in the report that we recently published, that aside from all the problems we see, Africa having just 1.4% of the private equity stack globally, knowledge is also missing. And hopefully this certificate helps to bridge that gap. It provides content that people who don't want to go through CFA program to learn about private markets, they want to just have a sole focus on it, can use this. The curriculum is divided into 5. It covers private equity, hedge funds, commodities, and the likes. And there's a final assessment to test the knowledge that candidates have gained while they are studying. Another key feature of this is that it is not just theoretical. We have engaged with industry specialists to be co-authors of the program, of the certificate curriculum. They are bringing practitioner insights into the curriculum. So when you're studying, it's relevant to what is happening in the globe currently. The method of learning is self-paced, but we've added some multimodal elements to it. So there's text, there's video, there are financial tools, there are case studies that helps the learning to be more interesting to the candidates. And at the same time, there are discussion boards on there which help the candidates who are studying to network with peers globally, because as they are studying, they are putting down notes, they are writing about what they are saying, and you could also respond to them. So you're learning from others, interacting with others, but also building your global network. The final one we'll be speaking to is private equity certificates, which is also relevant to what we've been talking to in this conference. Again, in the previous slide presentation, Rob mentioned that one of the aspects of CFA program that is not, one of the major things that is not reflected in detail in the CFA program is LBA modeling, and we have incorporated that in private equity certificate. It's been developed with one of the top private equity tuition houses, which is Financial Edge. I've partnered with them to develop this program. 12-month access, it's 100 to 125 hours. Unlike the CFA program, that's 300 hours. Candidates would study at their pace, and they can learn everything that has to do with private equity. Intermediate certificates, and at the end of the day, they get a badge that they could post on LinkedIn to show that they have earned the certificate. And this just shows what team members will learn. Basically, it's private equity techniques, financial modeling is incorporated there. And I think the last slide shows the various elements of what the private equity certificate covers. You know, the essentials, private equity, the general partner perspectives, and of course, we test to make sure that the candidates understand the concepts that they are studying and help them to be able to be trusted in the delivery of the job that they are doing. So these are some of the ways that CFA program is responding to the changes in the industry and trying to make aspiring and even current financial professionals to be future ready, to be relevant in the industry, both for today and for tomorrow. And it is important that we take a look at these resources and maximize them as much as we can for the benefit of yourselves, for the benefit of your employees, and for the benefit of the future of finance. Thank you very much for listening. Have a wonderful rest of your evening. Bye. I'm not sure if we're to take questions, but I'm happy to. Oh, great. Thank you. So myself and Rob will handle the questions. There's a mic here.
Okay, my name is George Otieno, CPA from Kenya, Nairobi. I'm a candidate level 3. Okay. So I wanted to find out whether I saw at the point when I was registering for the exams, there were those particular options, but I found there were extra added questions based on the extra cost which you had incurred. So I was asking that, is it possible that if I had opted for option 1 to register for exam, I can add some cost so that I can have the benefit of doubt to have these extra questions and marks. I went to the system, and the system could not allow, given the fact that I had already registered, maybe with the initial cost that was a bit a bit low. But perhaps I also want to be very appreciative because this is the second time I'm sitting for my level 3 exam.
Yeah.
I'm doing a retake, but I've seen there are slight better changes for what I interacted with the system, and I want to congratulate you for that, for the changes which you have made to that particular system. It's a bit user-friendly, and I really appreciate that. Perhaps this time around I'm going to make it to this other side of the equation. Thank you.
We wish you all the best, and we hope to see you in your charter. Thanks for the feedback. Rob will answer the question.
Oh yes, you can choose to purchase Practice Pack after you register. You go to your tile, you log in, and then you can choose to get the extra mock exams if you like, all the way up to exam day. Yeah.
Great. Another question over there. Rob, down there.
Thank you very much for the presentation. My name is Johnson, and I'm a level 3 candidate. My question is about fees. I think when I started the level 1 exam in 2022, there has been, I don't want to call it an exponential increase, but there has been a year-over-year increase in the fees that are charged for the CF exam. I want to know what's the reasoning behind those fees and why you decided to separate the practice pack, the additional practice pack.
Yeah, thanks, Johnson. I'll grab this. There are 3 reasons. First of all, we launched level 3 pathways, so the 3 flavors that Kingston mentioned. So that means it costs us more money to deliver that, write the questions, and then grade the exam, basically. The second reason is the addition of practical skills modules. So with level 3, for the 2025 exam year, so starting in February 2025, level 3, you're going to have a selection of 4 different practical skills modules, so that we kept investing. On the practice pack, you don't need the practice pack to pass the exam. We didn't have it for forever, and we added that. We didn't, we didn't suddenly charge for it. That cost us a lot of money to build questions, basically. So we didn't want to lift the price for everybody because we don't think everybody needs practice pack. So it would have been unfair to just lift the price on everybody, but instead we say, look, if you want it, you can pay for it. But if you don't want it, you don't have to pay for it. So these are the reasons.
Thank you, Rob. Any other question? No questions. Enjoy your evening.
Oh, we have one more.
Mine is a comment.
Okay.
My name is Alfred Kabuchu. I'm a CFA charter holder, and I completed more than 10 years ago. I just wanted to share with the students who are here that what you are doing and the presentation you have just heard is actually very, very good. It gives the students a very good chance at performing very well and passing the exams. I think at the time when we start the program and the exams, the information available for us was not even, I think, 15–20% of what is available. So whoever is doing the program, this is to encourage you that you have one of the best chances to pass the program, and it is possible. Just do what is necessary and you'll do well. Thank you very much.
Thank you, sir. One more question behind you, Rob.
Hello.
Hi.
My name is Mebo. I am a level 2 candidate. Just a quick one. Is there, you see how we know that there are certain online prep providers, for example, Macmeldrum, Wiley. Is there a way to let us know of any prep providers that provide physical classes? For example, let's say in Uganda, I've only seen like one, Matt Abacus Business School. Are there any other that are accredited by the CFA Institute? And can that be made public knowledge for like the rest of us? Okay.
So the accredited prep providers are on the website. You can always go there and see the ones that have been accredited. But in terms of others, off the top of my head, I would not be able to tell. But we know of Mark Abacus in Uganda, but I would suggest go on the website. The list of accredited prep providers are on there for you to see.
Thank you.
Finako in Rwanda, yeah. There's one question here.
Thank you. I think mine is simple. I'm Derek Manjimu, and I'm sitting in August, just 33 days to the exam. But I was wondering, when answering, can someone skip some questions and come back to them, or it is sequential, like you have to follow 1, 2 as you keep going, or you can come back, pick the simple questions, come back to, the hard questions. I'm not sure, but I think it's so simple.
Is there any candidate who has done the exam recently that can help answer that?
Hi.
Yeah.
So you can actually skip.
Yeah.
You can flag the question and come back to it later.
Yeah.
Yeah.
And don't forget to come back. Yeah.
Professor says don't forget to come back.
Any more?
Hi, good evening. My name is Edwig Nasaka. I'm currently a candidate for level 3, sitting in Feb. You showed the graph of the performance for the previous years, and recently we got performance of East Africa in particular, and the results were demotivating, I should say. The question I wanted to put to the Institute is, with those results, is there a possibility that you could consider reducing the costs for the repeating candidates, especially if you choose to repeat, for example, in the next sitting, for example, if I'm doing Jan, I fail, and I want to redo the exam, and the costs are very high, So is there a possibility that the Institute can consider reducing for those who choose to resit immediately, given the failure rates? Thank you.
Let Rob will answer.
Yeah, we have that question a lot, and there are definitely exam providers that do that. We unfortunately don't do that. We don't offer discounted retakes. We do for investment foundations, I believe, but not for CFA program, unfortunately. The way that will work is we would probably have to lift the price of people first time and then reduce the price of retakes if we did that. We don't want to lift the price to make way for that.
But there are options to defer the exam. If you're not sure of the preparation level before your actual seat, you have the option to defer to a further date, of course at a fee, but at a much lower fee compared to resitting the exam. So maybe something to explore.
Along with the Access Scholarship, right?
Yes,
financial
scholarships
scholarship.
as well. Let me speak to that quickly. We have a number of scholarships that we kind of provide to help people who struggle with fees. There is the Access Scholarship, which helps to remove the registration cost for the exam and reduces the fee significantly for candidates. It's open access. You go on the website, you register for the relevant window. Your application will be assessed, and then whoever is chosen will be granted the scholarship. We also have regulatory scholarships that we offer to regulators across the globe, including those in Africa. So if you work for a regulator, if they are not currently part of that program, please speak to them to reach out to CFA Institute to be part of the regulatory scholarship program, because we offer scholarships to regulators which they pass on to their employees to help reduce the fees for CFA program as well. Okay. Please ask your questions.
I also wanted to add to Edwig's point. If you look at the recent results for May, I think the global results, I think they are within the 44 to 56% range. But when you look at the East African region, it's much lower. I think it's 20% for level 2 and 15% for level 1, which is really scary for the candidates that are just starting out because we have a much lower pass rate. So I don't know whether you do any regional analysis to identify those trends and how to really support candidates, for example, from frontier markets or emerging regions to really up that score. Because for me, it was really a scary statistic.
Want me to take that, Kingston? Yeah, we don't disclose that data, so I'm not sure where you got that from, because we don't disclose that. So we have lots of people speculating on what the breakout of pass rates is. We do find that one of the biggest drivers of the pass rate in terms of between candidates will be English as a second language. And so that typically penalizes people in East Asia. So whereas people in countries that have English as an official language or widely spoken tend to do better on the whole. I will say one big tip though is the thing not to do: don't defer your exam. There's a massive correlation with much lower pass rates when you defer the exam than if you don't. And then on the study prep itself, basically once you've got 2,000 questions correct during your study for any level, the odds of you passing increase very significantly. And then when you look at the hours, the average hours of a pass is about 300 hours. So it's all about diligence. The study process is a key driver. But yeah, the only kind of big thing going on there is ESL, English as a second language, can be a depressant. Yeah.
Yeah, and if I'll add to that, in terms of special considerations for people from maybe a certain region, I mean, you'd agree with me that the CFA program is globally recognized. If you, as someone from East Africa, go to anywhere in the world with saying you're a CFA charter holder, everyone understands that you've gone through some rigor and discipline, and you are never disadvantaged against a CFA charter holder in any of the other developed markets. So we want to maintain that standard, and we wouldn't want to reduce the standard for anyone, irrespective of where they're coming from globally. You know, I've had a friend who, originally Nigerian, who moved from Nigeria to Canada, and he mentioned to me that he's a CFA charter holder. He was in a meeting, and you could tell how he's not being respected or his voice is not being heard. But when he dropped his card and they saw that those 3 letters after his name, it's like, whoa, that the ambience changed, because people tend to understand that, oh, this guy is not ordinary. He has something on his head, right? So that is the standard we'd like to maintain for the CFA program globally. So in that wise, it would be unfair to any other region to maybe do something to reduce the quality or make it easier in certain regions. So it's globally consistent. Is that all? Okay, thank you very much, everyone. Have a good evening, and we wish whoever is candidate here all the best in your upcoming exams. Take care.